Hello and welcome to day 2 of Dappcon. I have the pleasure to introduce to you Garm Lucassen, who will talk about GloDollar. He's co-founder and CTO of GloDollar, and we'll talk about why GloDollar should be the stablecoin of choice for you, even if you don't care about the 10% of the people in the world who live in extreme poverty. Welcome, Garm.
Thank you, Daniel. Hello, Berlin. Good morning. Like Daniel said, I'm Garm Lucassen, and I'm co-founder and CTO at GloDollar. And today we'll be talking about ending extreme poverty with a stablecoin, or why you should be using a different stablecoin, even if you do not care all that much about ending extreme poverty. So first things first, we're backed by Sid Sijbrandij, the CEO and co-founder of GitLab, and GloDollar is created by the Glo Foundation, which is unlocking new sources of money to end extreme poverty. That's our sort of mission. Our vision is zero extreme poverty, and that's sorely needed because currently about 10% of humanity actually lives in extreme poverty. So it's 700 million people. And extreme poverty, well, that's the worst kind of poverty. That's people that are living on less than $2.15 per day, and that's already purchase parity towards the US. So in actuality, it's much less. And our goal is to, well, lift all of these people above extreme poverty by using the proceeds of stablecoin revenue. And to that end, we've created GloDollar. It's a stablecoin, it's centralized, it's 100% fiat-backed. So that means that for every GloDollar that's out there on chain, there's also $1 in cash or a US Treasury backing it in our reserves. So that's very similar to both USDT and USDC, and that's become a massively profitable business model ever since the interest rate environment changed. So Tether has self-reported to have made 1.5 billion in net profit in the first quarter of 2023. And that's just like a handful of dudes in the Bahamas, and they're absolutely raking it in. It's a massively profitable business model. We do the exact same thing, but there's one big difference. We donate 100% of our treasury revenue to a nonprofit called Give Directly. And that means that by choosing GloDollar instead of the competition, you are reducing the number of people living in extreme poverty. If you've never heard of Give Directly, they're basically the leader in running basic income programs. They've got over 10 years of experience, and they've already transferred over 500 million in direct gifts to people in extreme poverty. The way it works is people in countries like Kenya, Malawi, or Liberia, they get $40 a month for a very long string of time, like 3 to 5 years, or sometimes even more. Basically, they go to a village that they've identified to be living in extreme poverty, and then they tell every single person in that village, you're going to get this basic income, and there's no strings attached. It's a beautiful, elegant model, and it's also massively scalable. All they need is more money in order to do more good. We're a huge fan of their model, and we'd love to see it scale a lot more. And we're not the only fans. You might know Vitalik. He's also a huge fan, and back in 2021, he actually donated quite a bit to Give Directly, $4.3 million. So what that means is if you choose GloDollar, you can basically embed philanthropy in your savings or in your DAO holdings or in your organization's treasury without necessarily needing to donate anything directly. You can be like Vitalik. Isn't that great? This is how one of our community members very elegantly put it. So I've bought some Glo, now we just hold it. Yes, that's the basic pitch. But of course, there's slightly more to it, and I'd love to dive a little bit deeper into why you should actually be choosing GloDollar for your own stablecoins, even if you do not necessarily care so much about ending extreme poverty itself. So basically, we looked at the current landscape and we've identified 3 existential threats to crypto that we believe GloDollar has the capacity of neutralizing. So I'm going to dive into each of these individually a little bit deeper. First being the stablecoin duopoly between USDC and USDT. They own about 85% of the stablecoin market. Secondly, stablecoins are effectively public goods, but they're controlled by shady for-profits that do not have the best intentions for the ecosystem at heart. And finally, real-world impact and adoption. How are we going to get there? GloDollar might be able to help. Let's dive a little bit deeper into each of these, starting with stablecoin duopoly. So right now, USDT and Circle own about 87% of the total stablecoin market capitalization, and they're earning approximately $13 million per day by being these duopolistic market leaders. That's not necessarily bad in and of itself. Making profit is great and definitely encouraged, but I think you can argue that a lot of the value that's being created and a lot of the yield that's being created is due to the ecosystem embracing these stablecoins and not necessarily because they're doing so much in and of itself. Now, it's kind of an aside because what's really at risk here is ecosystem stability, because if we have these very concentrated duopolistic stablecoin market leaders, there's a risk to the ecosystem in if, let's say, there's a hard fork or another event in which the ecosystem wants to change something, then USDC and USDT actually have massive market power to bend those changes to their will. And that's an existential risk to the ecosystem, we believe. And in the past, we've seen that when there was the client diversity issue, that we could actually overcome this problem if the community bands together and does their best to try to bring the concentration down to less than 50%. So we believe it would be great if we can get these graphs to shift a little bit and to have not 2, but 3 stablecoins that all have less than 50% of the market share. So if you agree that GloDollar should be the case, or sorry, there's a bunch of other stablecoins out there already that have tried to do the same before, right? So there's, for instance, Paxos' USDT. PayPal recently launched a stablecoin, but they've never really gotten a strong foothold in the market. And we think that's probably because they're basically carbon copies of one another. And we've tried to design GloDollar in such a way that it really has unique selling points that give it a chance to actually compete in the marketplace. So there's 3 aspects to that. First being GloDollar embeds philanthropy, which is a great cause that you can support and makes sense. Because we are a foundation, we are not incentivized to do weird stuff with the underlying dollars, so we should be inherently more trustworthy. And then thirdly, we've also implemented some smart contract optimizations, which make it approximately 15% cheaper to transfer GloDollar versus USDC and USDT. So if you think that breaking the stablecoin duopoly is a good idea, I'd love to ask you to start voting with your wallet, start vote GloDollar. But that's not all. The second item here is stablecoins are public goods, which are currently controlled by shady for-profits that do not necessarily choose for the good of the ecosystem, rather for themselves. So first off, let's look a little bit at why stablecoins are a public good in the first place. A public good essentially implies that you experience benefits of something being present, even if you do not participate in that something yourself. So in a crypto context, that means that even if you do not use stablecoins yourself in a day-to-day basis, you do experience some benefit from them. That sounds a bit vague, and I totally get that, because it's very hard to really notice that when things are going very smoothly. But when shit hits the fan, it becomes very obvious. Earlier this year with the USDC deep pack, you really noticed this, that even though if you wanted to trade not through stablecoins, but through non-stables. Only liquidity was provided through stables. So if liquidity on the stablecoins dried up, then no more trades were possible at all. And that can then really cascade and cause panic in the marketplace, as we saw for a number of very stressful days. So maybe stablecoins itself aren't necessarily public goods, but stablecoins very much are. Now, unfortunately, we cannot 100% count on stablecoins being stable. There's endless headlines of tether, fear, uncertainty, and doubt. Won't get into that. But even Circle's USDC is incentivized to seek risk. There was a beautiful profile in Fortune last week about Circle, and I thought this line was particularly telling, where USDC was initially started with the best of intentions of being a public utility. But because it is a private enterprise and they are incentivized to make profit for their shareholders, it clearly became a private enterprise product over time. So we need a stablecoin managed as a public good for the good of the ecosystem stability. Again, enter GloDollar. We have a business model without profit incentives. I do not need to seek extra risk because I will never get rich off of it. Because of the non-profit business model, we are also transparent by design because we are seeking out regulation and we are going to need to be compliant with, for instance, non-profit transparency rules, which should make us more trustworthy and allows us to really manage GloDollar as a public good. So vote with your wallets, please vote GloDollar. Third, real-world impact and adoption. So crypto often dreams about wanting to transform the world and onboarding the next 1 billion people in the process. But if we look at the current statistics of what's actually happening, things aren't looking so great. Like search interest is lower, daily active wallets is lower, gas fees are very low this week as well. So the trends aren't looking very optimistic at the moment. And often what you see in crypto is that we then tend to focus inward. We tend to start building infrastructure or technology for the ecosystem itself and then hope that the additional excitement within crypto will sort of allow us to bubble outward again because people hear about it and they want to join. But I think there's also a really strong call now for us building more consumer apps and to look more outward. So making an impact on the world in a way that does not necessarily benefit us as crypto insiders very much, but rather also touches other people on the planet. So here again, GloDollar is uniquely positioned to help us focus outward to grow adoption and impact. GloDollar is in service of an objectively good cause. Ending extreme poverty is not very controversial. People tend to want to support it somehow. Even if they don't, they will talk positively about it. And we see that a lot with non-crypto people we talk to about GloDollar as well. Like, very often we hear remarks such as, oh, this is actually a crypto project I understand and I would like to support. It's one of the few crypto initiatives I care about as a non-crypto person. And I think finally what I think is also very important is it's infinitely scalable. So because it is such an elegant design, we can really bring this to be larger than the existing stablecoin market. And if we are able to grow a sufficiently large social movement, you will see that we can actually grow the crypto pie in itself beyond the existing market cap. So again, if you think that real-world impact and adoption is important, please vote with your wallets and vote GloDollar. So to recap, before you buy Glo, you own USD, maybe USDC or USDT. After you buy GloDollar, you still own dollars, but someone in poverty also gets a basic income. So it's a donationless form of doing good in the world, which is an innovative way of funding good initiatives on the planet. Like Gateaux put it, so I've bought some Glo, now we just hold it. Absolutely. but also there are reasons for you to want to embrace GloDollar as your stablecoin, even if you do not necessarily care so much about ending extreme poverty, because GloDollar is able to defeat certain existential threats. So breaking the stablecoin duopoly, GloDollar is uniquely positioned to do so because of its unique design characteristics. GloDollar is designed to be managed as a public good, which should maximize impact to the world and the ecosystem rather than our shareholders, because we have no shareholders. And then finally, real-world impact and adoption. GloDollar is designed to be infinitely scalable and appeals to everyone on the planet, so it should be able to onboard the next 1 billion users. Now, if you think that GloDollar is a good idea, we'd love to have you or your organization join the GLO Consortium. The GLO Consortium is essentially a group of organizations that, like GloDollar, want to see it succeed and actively support it somehow. Basically, we ask you to do one of 3 things: either adopt, so hold GloDollar, donate to the GLO Foundation, which will be matched 2 times by Citizens Brandy, so $1 becomes $2, or build together with GLO, and that's typically integrating GloDollar into your own platform somehow. So for instance, Endowment recently enabled the capability for everyone to donate with GloDollars to other charities on their platforms, or other members of the GLO Consortium choose to hold, let's say, 20% of their treasury in GloDollar, or of their stablecoin holdings, typically not their entire treasury. If you would like to join, please feel free to hit me up here or to DM me on Telegram on @GeierGarmer. Finally, we're available for you as businesses to mint and burn directly for free with our third-party issuer called Braille. Or we're also available on Uniswap on both Ethereum, Polygon, and Celo, and we're coming soon on Base and Optimism as well, most likely. Yeah, thanks very much. Any questions?
Hi, good intentions, but I still don't understand how you stable your stablecoins. How do you back it? I can only guess from your call for donations and that you're promising that for every GloDollar one holds, you're going to be sort of matching that with a sort of charity to someone out there in the world. So that kind of suggests that you have kind of 50% backing in your reserve. I mean, are you building a reserve?
No, so we have 100% backing of the stablecoin.
How do you do that? I mean, if you're asking for donation, is it donation in, donation out, $1 in, $1 out? So or you're keeping a reserve and you have like...
It's different money streams. So the donation goes to the GLO Foundation, which funds the operations of the organization that creates GloDollar. GloDollar has a treasury reserve that's totally disconnected from any of our operational funds.
Fine.
And if you buy a single GloDollar goes into the treasury, which goes into either cash or a US bond, which yields 5% per year, and that 5% per year we donate to
so you're
directly.
Using the interest to donate.
That's right.
Got you. So that's not quite one-to-one as such. So you're hoping that your interest rate would fund the charity out in the world.
Yes, that's right.
Okay. All right. Got it.
First of all, a great project. What is your plan if interest rates go back to 0 again?
It's a good question. Our current party line is, we'll see when that happens. It might mean that we need to reduce donations or we need to seek other ways to raise funding, right? There's a lot of regulatory changes coming, which also impact this a lot. Like for instance, in MiCA, it might not be possible to even put it in anything else than government bonds. So we're not trying to plan ahead too much, unfortunately.
Why is Tether and USDC, why are they so strong? And is there anything that Glo can learn from that success?
Great question. So I think with Tether, they were very early to the market. So they grew market share immediately. And Circle had distribution through Coinbase, which allowed them to become very large through their customer network, right? And I think the big lesson here is either be early, we're not, so that's unfortunate, or find a strong channel partner that you can distribute GloDollar through. And we're still in search of those, working with different exchanges, for instance, but also backing other on-chain stablecoins are talks that we're currently having.
Hi. It's a very interesting project. So if I understood correctly, you're basically asking projects, companies to donate treasury yield in order to fund charities. My question is in terms of, I would say, scalability, because that's what you're going to want with a stablecoin. How do you make sure that it stays at $1? So for example, if my company has 10 million treasury and they pledge like 2 million in Glo, at some point if they need operational expenses, do they have to redeem or can they just swap it out? Because the problem with stablecoins is that it's actually extremely expensive to hold out liquidity, right? So on this kind of project, since you're at least at the beginning barely going to make revenue, how do you intend to be able to provide a seamless experience for people who have committed these assets?
So we work with Brill as our third-party issuer, who have a centralized minting and redeeming platform where businesses can go to and then always redeem one GloDollar for a fiat dollar or even USDC. So that ensures that in the back there's always $1 you can get for one GloDollar. On chain, that requires different operational interventions at times, like we saw with, for instance, the USDC DPEC earlier. There's the same situation, but you still need to have operational matters in place in order to ensure that the pack stays at $1, right? But yeah, that's the basic model.
Thank you for the presentation. Why do you yield only from US dollar or from US bonds? You don't yield from the DeFi market?
Good question. The primary concern here is keeping things simple, at least for now, and following the guidance of regulators as much as possible. Like, it's definitely looking like US bonds are going to be the only version of investments that you can make in the near future. But well, let's say if we get super large, at some point the number of US bonds also run out, so you need to diversify at some point. But yeah, the short answer is it's simple, it's straightforward, it scales very well, it doesn't require large overhead on our operations to maximize the yield as well, because, well, we are a foundation, we're funded by donors, so we typically choose to optimize for simple, straightforward, what can we do with a small number of people.
Any plans for a Glo Euro?
I would personally love that, being from Amsterdam. Maybe sooner rather than later, actually, but no concrete or clear timelines or anything.
So what was the question? Glo Euro.
Thank you for the talk. Is there a clear regulation like the e-money regulation you have to follow with issuing GloDollar? So basically what Yuri is doing, or Monerium is doing with Yuri, having e-money clearly regulated, how much they have to have in liquid assets and what they are allowed to invest?
Not as much as we'd maybe like. So there's definitely work happening there, both in the EU and the US. But our general counsel would love it if there's clearer and more straightforward regulation. But yeah, we do tend to stick with the regulations in that spirit already.
So we have time for one question left.
In terms of donors looking down the line, do you think like the World Bank or the IMF might be able to put the interest they're earning from third world countries into the GLO? Would that be something that's on the table? Just to
We haven't established context with them yet, but I think the model is applicable in every context, right? So they could absolutely do that, and we'd love to invite them to join, for sure.
Thank you very much.
Thank you.
So next is Omri Ross, who will introduce you to GoodDollar, the first 500K users. Welcome, Omri Ross.
This is used for changing slides. I press this one.
Yeah, this is to change the slide. Then there's a laser pointer, but I think
this is laser?
to go back.
Perfect. Hi, everybody. Welcome today, and thanks for organizing a full session on UBI. I think this is super cool. We haven't seen it in many conferences. I'm going to bore you a little bit about our project, but I'm also going to make all possible mistakes in this presentation. I'm going to focus much more about how we build stuff, rather than maybe focus much about like more personal stories, which are often very touching. But I'll tell you first of what we've been working on and how we sort of reach out so far 500,000 wallet users for GoodDollar, and a little bit about the vision behind it. So this is sort of the main sort of, in some way, the main motivation for us to start this project, right? There is 1.7 billion unbanked people, out of which 1.1 billion have actually access to mobile. And what we sort of believe in terms of blockchain is that the technology is very suitable for suiting that purposes, which I'll talk a little bit more about it in a bit. So what is GoodDollar? It's a general UBI project, Universal Basic Income, with the idea that sort of any member that is just sign up for application online in any way will just receive the same UBI, the same basic income as everybody else. This project exists for some years. I'll tell you a little bit more about it as we go along. Our main issue is that we have about 60,000 daily users that have been extremely consistent. If you open DebtRadar, you see us on the top 10 most used decentralized application over the last years, almost every day, at least as we've seen. So what's the idea for us? The idea for us is to say that if we want to use blockchain for financial inclusion, we need to somehow build a system that people can actually use. And for that readers, we sort of see it out as a three-chair that if you take any of the legs of it, it will totally die out. So the first one is to see how can we actually create a permissionless banking without actually having any banking infrastructure. The second one is how do you create permissionless liquid infrastructure, because once people that do not necessarily have access to bank receive some asset, how do they get value for this asset that people actually care about? And the third one is how do you actually make a decision if everything is permissionless in terms of decentralized organization? And I'll touch a little bit about each of these stuffs and then talk specifically about GoodDollar and how we kind of try to intervene there. So in terms of permissionless banking infrastructure, the idea there is that you can tokenize any assets. And we take here just one specific example. There are many, many different ways to do it, but we focus a little bit about creation of tokens and creation of different roles to mint and pause and deal with these tokens as issues happen. And not of least important to have some different access rights if you want to sort of whitelist it for everybody, or there are any sort of requirements to blacklist and to deal with stuff in a more less open ways. I guess by now you can see that I'm able to bore you very well, because apart from working as a sort of chief blockchain officer at eToro, I also work as associate professor, and a lot of the stuff that we do here and we build here is also based on different research projects that we've been working on throughout the years. Okay, so what do we mean in terms of tokenization, and why does it even matter if you tokenize assets or not? It's because, as we know also from our work in the more traditional market where we are regulated everywhere you want, you can really know that custody and how do you actually keep the assets in the way that is sort of following different regulation issuance of assets, and reconciliation, which means checking out that the books are automatically correct in everywhere, are big businesses, and are big businesses that sit under a lot of regulation and checking out. And on top of that, if you want to lead to settlement, there are a lot of rules around settlement, a lot of counterparty risk that is involved with settlement, and there is the issue of how do you even define ownership of these assets? You know, do you require KYC? Do you require different setup to build this stuff? And from our point of view, if you tokenize the asset, you kind of solve a lot of these problems kind of immediately, right? You have an ability to create settlements 24/7. You don't deal with the counterparty risk because the settlement is immediate, and you don't have to wait 2 days or 3 days, depending on the different regulations on how you transfer the assets. And the trading is automatically operational. And the owners take full custody of the assets, which is both an asset and liability, of course, because they can also lose that once. But I think this is really important for us because that means that we kind of create the idea of ownership without any need for infrastructures. On top of it, I guess automated market makers are very common and very known assets for, I guess, everybody that sits here. I had personally the luck or this luck to work from it since 2017, where we worked on the first sort of implementation of this stuff with the Banker team. But in very simple terms, when we look into automated market making, we say that if you want to sort of offer liquidity or be part of that asset, you just need to somehow pull out a situation where you have a pool with 2 assets. In both of them, you have sort of similar ownership of the underlying. So in this case here, if we take a value of $100 to Ether, you can see that, oh, sorry, I'll come back. How do I move back? Is it the red one? Okay, sorry. That if we have So if we have these 2 pools, we can have different kind of players, all of them sort of not connected to each other, that somehow support liquidity on these pools. So in this case here, you can see that when we start in, the pool is somehow reflecting a value of $100 for each ETH. But if for whatever reason one of the traders find this price attractive, they can buy it a little bit of the assets. So in this example here, the 10 to 10 was changed because one person decided to buy the first Ethereum in this case. Of course, the price of the Ether would change continuously if we sort of calculated that, but for the sake of the example, let's say that they could just buy it for $100, then you can see that the pool afterwards is no more balanced, or this is reflecting a different exchange rate, which is maybe closer to sort of higher than $100, because if it was $100, it would be 900. It's about 120. And in this case here, you can actually say that the market has changed. And now if you assume that both pools have the same price. And if there is a third person that runs arbitrage on this pool, let's call her Denise, they can kind of see that now the price of it is sort of, at least this pool is paying you a good price. It was about 120. So she will sell back to the pool until it sees balance again. So what I was actually trying to focus is maybe not so much how this works as much as the fact that now you can actually create price discovery, and you can create the ability to actually find assets without necessarily a need for a centralized player to run that. And what we do see sort of empirically, a lot of correlation between automated market makers. In this case, we compare the daily volume between Coinbase and Uniswap, and we see both the high correlation as well as that they both have daily billions of dollars traded in each of them. So we can actually, at first say, tokenize and achieve a way for people to have ownership of assets without banks, and then we can actually exchange them. The third thing, which I'm not going to talk about, by the way, all of this sort of stuff that is presented here is somewhat related to different research that we've sort of published or other people have, is really looking into how do you actually deal with voting into DAOs. Won't get into much into that, but often DAOs have the concept of 1 vote equal 1 token, and of course, because of concentration with a lot of these assets, that can lead for a bunch of different challenges with approving of different governments' decision. I'll just focus a little bit that you can actually move a bit from this concept to try and create more community-backed governments or decision. For example, if you still want to keep sort of the 1 token to 1 vote voting, you can create more social capital by distributing in different ways the funds that are voted. We've seen some cases where you have still the possibility to delegate it, which means I've given someone else here the rights to do that, and then if I can revoke it immediately, then of course maybe someone I've given the right to vote may be very compliant to what I want because I can just replace them. But at a given case where you kind of have some problems in revoking the delegation, you may expect the social community to act in a nicer way. Another dimension you can go for is something more similar to quadratic voting, like the stuff that we've seen in some projects. You will actually see the possibility of different projects to actually exchange also the value in the amounts of users that actually voted, and not just the total capital that has been used for the voting. And we've seen some cases of reputation voting, where your reputation will have a bit larger effect on how much you will vote, and then you get a little bit of both. I won't get much into that, but I said that there is still a lot of challenges with how we actually try to work with communities and open sort of voting and decision to be much more sort of open for everybody. But I think it's fair to say that we would like to achieve a way where there is much more meritocratic and democratic ways, and the people that own and choose it are actually the people who use it, rather than sort of necessarily the people that have already just sort of invested from it only from a financial purpose. Moving on, I'll talk a little bit more about GoodDollar and how we kind of use these three flags in our sort of project to really support it. So first, about going back to where we started, we've seen a very large amount of people in this world that may actually benefit from universal basic income, right? Whether we talk about people that are unbanked and cannot even sort of use sort of some of the benefits we all receive directly from being able to transact. And also, we've seen the people that actually just need money, regardless if it's banked or not. And we see that about half of the world population lives in less than $5.5 a day. So maybe we can try and help a little bit there. So how do we let the money flow that way? So first, I wanted to mention that a lot of the people in this room, and also two of the people here in this room, unlike me, many of them are staying here in Berlin, and I would highly recommend you to talk to them if you're staying here as well. And Mary and Johannes are working on this project as well. And eToro contributed early to fund some of the research that has been done of that, as well as the project already from 2018. But we also know that, okay, I'm talking a little bit about UBI, whatever, but, people will have to create their own Web3 wallet. That doesn't sound really fun. And also buying crypto is not super fun, and how do you actually do that? And how do you even consider doing UBI on scale? So before kind of mentioning more of that, we have actually managed to get quite a lot of people interested in the project and actually taking part in the project. Specifically, while the slide is not updated, there are more than 500,000 wallets that actually been claiming some of our UBI. We try to keep it very simple. So we know that some projects or recent projects using some eye identification or so, but we just use a very simple way to kind of check your face, which is kind of difficult to try and cheat. I guess it's not impossible to cheat, but we are taking the pragmatic approach that if it will be very, very difficult, at least the vast majority of whatever is distributed is going to be distributed to the right persons. We had some money that has been staked, and we so far distributed about $400,000 to different users. We also checked, actually, empirically, that a lot of these users are actually coming from some more developed countries. We have almost 100,000 users in Nigeria and Indonesia, and quite a few in Vienna and Vietnam. Actually, if you come to our webpage, you can see some more live checks from the last 30 days of who use it wherever, and this is sort of changed live. There are different stuff you can actually look into the statistics here, but I want to focus only on two. The first one is that a bit less than half of the people that use it have the less than $5,000 annual income. So it actually somehow seems to be fitting people that actually are in need for that. And that we also seen a bunch of adoptions. So let's talk a little bit about how we're building it and who are the people that we see as the real change maker in this regards. So we've seen a lot of community members that are using it. I'm going to do the unadvised thing and talk very little about personal stories. There are other presentations which are of much better presenters than me within our community that can show you very, very beautiful stories. But I'm actually going to, very quick, focus on more statistics and more scale information because I think that's more interesting for me. Okay, not more interesting, but at least it's more giving you a rate of what is actually happening. So we have some Cameroonian technologies that has organized different community savings that are based on GloDollar. We've seen a Brazilian entrepreneur that opened a second-hand shop which accepts and sells pre-owned goods with GloDollar. And we've seen sort of, in this case, an airtime shop that was built and is used with GloDollar. And we also wanted to mention Les, a Nigerian student that actually worked actively on helping people raising money and got about $3,000 to share using GloDollar. We have a bunch of more examples. There are quite a few, but I'm not going to focus so much on that in this talk, at least today. I want to speak a little bit about how it works, because that's maybe also a bit interesting. And actually, we try to keep things extremely simple. So our idea has been that in principle, there could come different supporters that will be willing to, similar to a previous talk, to contribute some of the interest that they could receive on DeFi assets to GloDollar users. And there could be plenty different reasons for people to do it. From the obvious ones, people want to help, people are willing to share with social responsibility, to maybe people that are not even able to use DeFi because of different regulatory environments on top of them that prevent them to use it, and anyway have to hold the assets without necessarily receiving interest. So all of this could actually access supporters and just provide some of their assets and allow the interest received by that go to others, so they still keep the value that they had beforehand. At the same time, the interest is then used to sort of be distributed at UBI and support the reserve. As we have a very predictable amount of users, we can actually check the amount of users that have done it daily. We can have a pretty good estimation of how much we'll actually be using every day for UBI. And if we suddenly be lucky enough to have this dumbbell of 888 or quadrate, we'll find ways to actually support it further ourselves, because this will be fantastic news for us to suddenly move from, say, 60,000 a day to 500,000 a day. So we'll actually support it for a short period of time. And then later on, customers can claim it with the DApp, and this DApp is very general, so we actually have a mobile application that you can download yourself on your application if you use Android or if you use Apple, and you can start claiming it yourself. It's super simple to do. We're working now on integration to much more places where these things are come, and we want to offer also people that are using it much more direct access in different places. They can exchange the value directly on different networks, but they can also move it between networks. So again, just to kind of summarize a little bit about the community in more general ways, we have more than 183 countries that actually have people claiming from, and we have support for it in 17 languages, and we have a bunch of communities. Again, please speak to Mary here. She is around here, and she will tell you much more stuff than me about actually working with these communities. So it's super exciting. Getting in touch, the project has been, just to mention again, constantly on the top 10 most used apps by user on DebtRadar. You can check it as we speak. And if you want to help in touch, please get in touch. There are many ways you can be involved, from helping different communities, from contribute directly as a supporters, or from being a foundation that want to potentially upload many of these users directly to your foundation, because we have the ability to support it. Currently, we support 2 networks. We run it on Fuse and Celo, but it's easily integrated to new networks and can be also allowing the foundation that want to maybe also enjoy having 60,000 daily users, and at the same time actually support for something good, just integrate to it easily and support a little bit with some of the funds there to their interest to actually move forward. Thank you very much. I'm done.
Thank you. We have about 7 minutes for questions. Let's see the first one.
Thank you very much. Great presentation. I was wondering if you can go a bit into detail how the monetary mechanics work.
Would love to.
So, if I understood correctly, you donate interest. This is like one side, and then you claim GloDollars, which is not connected, and GloDollar is the supply is just growing. So maybe you can.
Yeah, I would love to explain it. Okay, I'll explain it in your right, 99% correct, not like 100%, but just to make it very explainable. But there is a lot of supporting information, both white paper and others on the webpage. But to just simplify it, let's imagine to start with, we have 50,000 users, right? And we receive in one day $500 to share, okay? Why did we receive $500? Because we have an interest, we have an outstanding balance of people that supported the project and have staked, and they received $500 in that day at interest, right? Say on whatever, a couple of $1 million may receive that interest on a daily basis. So if you have $500 and say you have 5,000 users that access our system one day before, then we can say that each of these users will receive about 10 cents a day, right? So we can calculate that amount and distribute it to them on GloDollar. I want to make a couple of comments here as well, just to make it a little bit clearer. So we are not sure that exactly 5,000 users will come from day to day, right? But we can make minor balances to make this sort of oil work. And more importantly than that is that if suddenly we are moving on to have, I mean, eToro has generously supported these projects for a very long period of time and worked very hard on also making it available for people and know people to know about it. If suddenly the amount of AAA or not, this daily amount are still ones that we can actually work with and we'll be able to sort of receive it, some help to support the numbers. And in any way, in the worst case, it may be that the daily distribution will be a little bit too high, and maybe there will be a very, very minor unbalance that can be fixed very shortly. So that's about the distribution. On the next stage, if you remember my 3-arm chair, or if it's even called arm, you have seen that you receive it, but what do you do with that? Then we support AMMs on fast networks like Fuse and Celo that are sort of quick and not necessarily very expensive, that you can transact on there directly and sort of receive, instead of it, dollars or USDC or whatever you want to use to be able to actually benefit from that. Does that answer your question?
It does to some extent. I will think a little bit more about it and maybe come
Sorry,
back
okay.
to you. It does to some extent. I will think a little bit more about it and then come back.
Okay.
Thank you very much.
Of course.
I'm interested in the collateral that you accept. Which collateral do you accept right now, and what is on the roadmap?
Yeah, so that's a very good question. So we mostly accept right now sort of different sort of stable coins that are used in a DeFi application, other than Compound, to sort of receive some sort of DeFi interest. We're looking into different ways of extending some of that. And we're also looking a little bit about how it will work across blockchains, because currently we have it in 2 different blockchains, so that's also one way to sort of separate some of the security risk of each of them.
Okay.
How are people in Africa and Southeast Asia spending GoodDollar? Can they spend it from their wallet in store, or is there a mechanism of...
Yeah, I mean, I wish I could now connect my phone and just show you how it works, but unfortunately it's not. But first, I highly recommend you to download the app and start claiming, because you can see it. But in the app, we made it very playful, because one of the key points for us has been to prevent people trying to find addresses and start working with addresses. So there are different ways to sort of to somehow hide it and connect with it very easily in a very friendly way. But in a very simple way, you can transfer sort of funds to a friend if you want to keep it directly in GoodDollar at the app, or if you need to settle it in asset like USDC because they don't necessarily accept it directly, you can directly on the network, which are sort of not expensive network, as I mentioned before, like Fuse or Celo, and we somehow fund a little bit of the native token to the app so they can exchange directly without necessarily needing to get that sort of asset to hold, and then you can exchange it with USDC if needed, but in often you can just directly do it in GloDollar in the app and just transfer it to someone. There are different play around with QR codes and other that you can make it a bit more easy. So check it out.
Answer your question?
I thought I understood GloDollar until I heard you talk, okay?
Oh, I'm sorry. That's totally my fault.
Okay, so I read your first white paper,
yeah.
And it came across as Rothschild kind of trying to create the new dollar, and it was all built on the notion of building a reserve that would back a floating currency called GloDollar. That's as simple as it was. Okay, it was straightforward and understood. Now, I don't understand why you brought up the DAO here. How is that connecting to UBI? And then I saw you presenting examples of being people financing projects as opposed to having UBI on monthly basis. So that kind of also going all over the map. So you lost me there. So I still don't understand. Is it still a floating currency or is it a stable coin? And what is your reserve?
Okay, a lot of questions. I hope I remember all of them. But let's start with the end. The reserve is simple. The reserve is some different donors. You know, a very large one of them is, of course, eToro, are putting some sort of stable coin, receiving some interest on that, and that interest is given daily to the people that claim daily, right? With the approximation I mentioned before. In terms of the floating rate, because we wanted to support a sort of an AMM-like asset, there is a little bit of a Bancor-like mechanism on how the price changed with that. I will not explain it now, because it will make it a little bit even more technical and confusing for most people. I mean, we can check it out in the break if you want. But the idea is the price could change a bit, but it's fairly stable. So it could change, but there is a mechanism to describe the change, because the first idea was we were really, really trying to avoid the prospect of that becoming speculative coin. So there is a lot of, let's call it, mechanism inside it to prevent you from making money on it a little bit, which may sound weird for people that are working within this space, but it's more about sort of supporting people to support it and provide it and do for that space. And I think you had another question of where I confused you, but I can't remember that. What was it? The DAO. Yes, so, I mean, this is a project about communities, right? And you also talked about, in some of the stories that I mentioned, we mentioned communities. So, of course, using it as a transactional currency is very important, because that's the big thing in terms of people and adoption. But at the same time, if you want to create this community, I don't want to, who am I, but I'm saying, why should you tell people how to use it? You know, you just want to tell them, hey, there is free money you can get and receive. Okay, I think I was told to cut it off. So maybe I confuse everybody right now, but I'm used to that.
Thank you very much. We are unfortunately out of time. Let me introduce you Kaustub from the Circles Entropy project. He will talk about how to bring back privacy into a trust graph-based network. Welcome, Kaustub.
Oh, those are not my slides. Okay, that's... Got it. Thank you. Good morning. Wow. This is such a contrast. It's so sunny outside. I feel like I'm in the darkest room in this building. But yeah, thanks for coming out this morning to listen to us. This is my first day at the conference. I wasn't here yesterday, but really looking forward to, yeah, it looks like a great schedule. My name's Kaustub. I work with, as Daniel mentioned, the Circles project, and more recently working on a project called Circles Entropy. I'll tell you a little bit about it, but let's start with, for folks who don't know what Circles is, a little bit of context about Circles. I work with Circles, but I'm also a part of a developers collective called Bits Possessed. And actually, we're a small software developers collective, primarily working on trying to work on sustainable technology projects around more equitable tech. And I work with a small group of folks who usually aren't in Berlin, but some of us are here today. And I'll tell you a bit more about what their involvement with Circles is in a second, but maybe I'll just wave at the Bits Possessed gang here who are here, who've been working on Circles for the last couple of years too. So Circles. Circles is an alternative community currency system. It aims to provide, enable communities to provide each other with basic income without involvement from the states, because a lot of states don't do basic income as they should. Circles was founded in 2020. It was launched in October of 2020 as a set of smart contracts deployed on the Gnosis chain, but also a web-based wallet which runs on Circles.Garden, and that's the bit that's been developed and maintained, along with original smart contracts, that's been developed and maintained by the Bits-Possessed developer collective. The project has been supported in Berlin for the last couple of years by the Circles Co-op, and there's some members from the Circles Co-op here, I believe, they are, who have successfully run a community pilot in Berlin where there's about 30 businesses, over 30 businesses in Berlin who accept Circles. And there's this number, I'm not sure, I was told is not right. This is probably higher than this, but about 700 active members using Circles on a day-to-day basis to buy things like fresh groceries, veggies, preserves, coffee, paying for some alternative medicine and healthcare, and yeah. Say that again? Dappcon tickets, yeah, you could, yeah, actually a bunch of us, I didn't have to pay for my ticket this time because I'm speaking, but I know a bunch of my friends who actually bought their tickets using Circles to come to this conference. So yeah, that's possible, that's awesome. So yeah, and so that's been going on for a couple of years, and hopefully keeps going on for a bit. So that's Circles, and that's awesome, but there's a few things that we noticed that we could make better here, because as it goes with a lot of blockchain projects, all of this stuff that happens on Circles is actually written on chain. Circles works in, so I said it's deployed on the Gnosis chain as a smart contract, so we call it the Circles Hub contract. It does two things. One is enables people to, well, actually three things. It sets up a token contract every time someone signs up with the Circles Hub. It starts minting what your basic income. We currently issue Circles as 1 circle per hour, which means you get about 720 Circles a month, and then you can spend those Circles. You can send those to other people and pay businesses who are selling you the goods and services I mentioned earlier. But the way this works is that it relies on a web of trust-based system. So Circles, to sign up with Circles, you need 3 people who are already using Circles to trust you. Once that happens, you have a Circles account, and then you can use the Circles tokens that are minted as your UBI to pay people who actually trust you or trust your token. And we do something called transitive trust, which means I have a friend called David. David has a friend called Jackie. Jackie trusts David. David trusts me. I don't know Jackie directly, but I have just bought some veggies from Jackie and I want to pay them. But Jackie doesn't, because Jackie doesn't trust me directly, but they do trust David, they will accept David's Circles, but not mine. But in this case, what the Circle system allows you to do is, allows me to say, pay 50 Circles to David for the veggies that I bought from Jackie, and David then pays his 50 Circles to Jackie on my behalf, and that's what we call transitive trust. And most Circles transactions work like this, via the web of trust, where it uses the degrees of separation within your trust network to determine who trusts who and move Circles around this way. But for this to happen, we write the whole web of trust on chain currently, which means that all transactions within a community can actually be looked up by a third-party observer on-chain publicly, which basically lets them determine who is connected to who in a specific community, or if certain communities are connected to other communities elsewhere, right? This is a privacy risk, especially if you're working with communities at risk. In places where the state's not so cool about somebody just running a basic income project, in places where you may be connected with someone somewhere within your, because of your degrees of separation, with somebody who somehow happens to be in a place where there's like blanket crypto bans. The third one on this slide is the bit that it's kind of like, it's more immediate and concerns me with what I see, how we use Circles here, where so you can actually access alternative medicine, certain kinds of healthcare in Berlin using Circles, but I wouldn't want that information to be public if I'm paying a therapist or if I'm paying someone to, I don't know, fix a problem with my back. I really don't want the world to know that I am paying for healthcare by like looking up what kind of transactions I'm engaging in on chain. Or it could apply to a lot of other things that I generally, maybe I don't want people to know what I'm eating or how much coffee I'm drinking. But these are things that you cannot hide today because, well, if I'm paying with Circles and making a transaction in a community, you can kind of track where my Circles went to and what kind of goods and services I bought. So this is something that, yeah, you may not want to make public. But anyway, the point being that all transactions within a web of trust are public today, and we want to try and fix that. Sorry, did I miss something? Sorry about that. So that's what Circles Entropy, that's where the Circles Entropy project came in. We've been thinking about this for the last couple of years. We wholly support the idea of being able to let communities have the autonomy in the way they engage in financial transactions within a community without the need of centralized authority, and Circles, to an extent, has allowed that, has actually helped a lot of small businesses kind of flourish because they can now accept community currency and engage with members of the community themselves. But all of this is public, as I mentioned, on chain. And I don't want to target just Circles here. I don't want to target my project. This is a problem with a lot of blockchain projects where, yeah, in the name of transparency, we actually do end up making a lot of private data kind of public, right? And all things considered, it's not so bad with Circles. Yes, the public addresses that are engaging in transactions and trusting each other are on chain, but there's very little data we collect anyway. It's basically a username and a user profile picture that you can query using the public API that Circles provides today, but no other personally identifiable information beyond that. But that sometimes can be enough to kind of like know who is who and what's happening in a network. To fix that, we started thinking about how we could maybe make Circles more privacy preserving, and that's where the Entropy project comes in. We put together a small team of cryptographers to kind of like help us think about, well, how can we offer more privacy guarantees in Circles? How can we provide users user account anonymity so they don't have to make their user information public to anyone except people they trust? How can we make sure that their balances are private? How can we make sure that all transactions are shielded? These are things that are not new. These are things that have been other projects have been doing for a while, shielded transactions and private balances and user account anonymity. But we want to do this in a way where we still want to be able to apply this to the web of trust that Circles relies on for transitive trust and transfers. And we also want to try to provide network level anonymity for all transactions while we are at it. So this is where well, most of the work that we've had to do so far is around figuring out how can we do this kind of transitive trust pathfinding that Circles currently does, where we need the web of trust data to be public currently so we can see who's connected to who. And that's the problem we started to work on solving. So we ended up with, after a bunch of research, we ended up with having to make some decisions around what we're going to base this on. We chose to go with building Circles Entropy on top of a set of protocols developed by Anoma, which allow us to do fully shielded multi-party state transitions, and in the context of Circles, allowing us to use the max flow algorithm that Circles uses to do transitive trust, but without having to reveal user information, users having to reveal any personal information in the process. And that led us to defining the technical architecture that Circles Entropy is using, where we have, so Anoma is an intent-centric platform that allows a user to make their intents known, which are partial state transitions, that then solver solvers can pick up and do matchmaking to basically turn that into complete state transitions, which are like to form atomic transactions. And then you can settle this as zero knowledge proofs somewhere. In our case, a blockchain. And we do all this, and so we need people to run like. We provide resources to run what we call the solver network by running solver nodes. And to reward these solver nodes, we intend to use a utility token that will then incentivize people running these solver nodes. In our case, we want to use a token that we will issue called Enzo, but a solver can choose what they accept, and they can be incentivized the way they wish to, as long as there's some sort of an agreement in the network about like what's viable. So that's the technical overview, where there is a user defines partial state transitions as intents. Solvers pick it up, try to match them with other intents that would fulfill this transaction. And once that happens, it can be verified. It can be published as a proof and verified on chain. And solvers and gossip nodes can be incentivized with a utility token. Of course, this can be used beyond circles. We want to use this to do web of trust based transactions for payments within circles. But if you can actually elevate the web of trust to provide, there's many uses for like. There's many things that rely on many things that actually rely on web of trust models, right? So if you can actually elevate this to provide the kind of privacy guarantees that we wish to have with circles, you could apply this to, more autonomous mesh credit networks. You could do community credit clearing without the need of a central authority, where communities make publish intents anonymously, and then those are matched with others to kind of like do debt clearing in the context of a community without the need of a bank. You could apply this to social media. I think it can really help solve problems around web by providing spam protection measures in a privacy-preserving distributed social media context. You can also apply this to secure private messaging. And there's many things. Basically, it comes down to the web of trust is a strong model which is used widely to build various kinds of applications on top of. And I could see this working in any of those contexts, but with privacy guarantees that a lot of the time doesn't come with web of trust-based models, because you need the web of trust available for you to compute connections and enable transactions, right? So that's what those are the problems we're trying to solve with circles, and hopefully apply that to some other applications. The current state of affairs with Circles Entropy is that we started working on this project with a small team of cryptographers earlier this year. We went through a pretty intense research phase between, I'd say, March and about now-ish. We published our technical findings and our goals as a black paper in June. You can read that on the Circles Entropy website. There'll be a link in a second on the next slide. We're currently working on applying the algorithm, the Maxflow algorithm that Circles currently uses to do this kind of pathfinding and transitive trust and transactions, using Taiga, which is the framework that is a part of the set of protocols that Anoma provides. And we want to publish a proof of concept of how this intent-centric solving with the solver network would work towards the end of this year. Our end goal is to make circles more privacy-preserving with Circles using the Entropy protocol sometime next year, ideally by summer, autumn next year. And that's where we're at. And if you'd like to learn more, we have published the black paper on entropy.circles.coop. We also have a booth downstairs. There's a Circles table where you can, if you have Circles, spend Circles to buy some of the things that I mentioned earlier. There's some beautiful things that you can spend your Circles on while you're here at Dappcon. But also, importantly, if you want to learn about Circles Entropy or Circles UBI in general, there's one of the cryptographers working on Circles Entropy, Davey, is here. Will be at the booth today. There's also other Circles developers who will be at the booth now and then. So come talk to us about Circles. We're also in the process of doing some fundraising to continue to work on Circles and Circles Entropy. So if you'd like to know more about how you could engage with us around that, come talk to us. Have a look at the website and read the black papers, entropy.circles.coop. Yeah, and that's me. Thank you very much.
So if I understand correctly, if you want to pay someone who you don't trust, you need to...
Sorry, I can't really hear you very well.
If you want to pay someone who you don't trust, you need to ask someone who you trust, which means, but actually related to the privacy issue is that if you trust your friend, it doesn't really mean that you want your friend to know everything you buy, correct? So yeah, I just have this question on how to solve this problem.
Yeah, so the question is, yeah, currently the way Circles works is with transitive trust, yes. So if you trust me, but I'm trying to pay, say, them, and they trust you, you would know that I paid them, say, 10 Circles because it's actually you who paid them 10 Circles and I paid you 10. Yeah, so your point is valid here that, yeah, currently you could basically go, you would know as the person who trusts me to enable this transaction that what I paid for and who I paid and probably what I paid for, right? And this is, yeah, one of the things that we want to kind of like solve with Entropy by not routing transactions the way it does currently, but basically determining that there is determining that there is the path that exists between us without actually having to route the transaction through you. So I should be able to send somebody Circles directly as long as we can prove to everybody involved here that, yes, that transitive trust path exists. So in this case, it wouldn't be that you would only accept my Circles and they would accept your Circles. Ideally, they would accept Circles directly from me, but your role would be to validate that there is a trust path that exists here.
Thank you very much. I have two questions. Question one is, where does the value of UBI come from?
Sorry, say that again, please.
Where does the value of the UBI come from? And the second question is, so what I learned is that you understand that privacy is a #1 blocker for you to reach adoption or scale. And I wonder what are, apart from privacy, the #1 blockers for you to reach the next level of growth?
So the first question, where does the value for this UBI come from? So simply put, the value for the UBI within the current context of Circles comes from the community. So your tokens are actually your personal tokens, which only have value if someone else trusts those tokens and accepts them. But of course, that's like, yeah, that's a very simple explanation to a more complex question that you're asking. In the context of Berlin, the Circles Co-op has been able to do a bunch of fundraising in the past to run a subsidized pilot where we've subsidized businesses who are accepting Circles to a certain extent. and also well, using that to kind of like leverage, trying to create a community and try to build more more loops, more circular loops within businesses, so businesses can trade using circles with each other that they're accepting from the community. But yeah, it's been a subsidized pilot, and I think there's a few more examples I can think of where there's like subsidized pilots of circles right now. But there are other models that you can use where instead of like, well, trying to do large amounts of fundraising to like subsidize businesses. So there, for example, there's a project called Ethic Hub in Mexico who do this, where they actually support a lot of like farmers, especially like small business coffee farmers, and anyone can invest in them by actually buying tokens that could provide that in return provide liquidity for these businesses. But then these tokens can be staked, and then there's like pretty attractive staking rewards for people who actually are investing in these tokens. So that's one model that I can think of. But with Circles, we actually have a group currency layer on top of the UBI layer now, where communities can actually pool their Circles tokens, and via the current Web of Trust and the transitive trust path, mint a specific group token, which could be for a specific community, and that token could be used to bring in liquidity in various ways. So yeah, there are many models. There is no So the value really again comes down to how the community decides to create value for it. But there are like definitely economic and technical models that you can apply on top of the Web of Trust-based UBI system that we have currently to bring in value. I don't remember what the second question was. It was about scale and privacy. Can you? But we are also out of time. Maybe we can chat outside. Yeah.
So, thank you very much, Kaustop. If there are remaining questions, then just join them on their booth. Next, I'm proud to introduce you Shaunda Brown. She will also talk about Circles, but this time about the implementation of Circles in Indonesia, Bali. Welcome, Shaunda.
Do you have the clicker? Thank you. Good morning, beautiful people. My name is Shaunda Brown. I'm the CEO of Circles Indonesia, and I am thrilled to be here in Berlin today to talk to you about what we're doing in Circles Indonesia, in Bali, where I'm based, to provide a universal basic income on the blockchain to all Balinese and beyond to help meet basic needs. So, I think a lot of us here are familiar with what Circles is, but Circles is an application built on the Gnosis chain that aims to distribute a fair global resource called Circles based on the principle of universal basic income, UBI, that circulate through mutual trust. So what does that actually mean? What we found in Indonesia was that there was an abundance of resources, but there was a scarce and a lack of being able to meet those resources because of a lack of rupiah. Rupiah is the fiat Indonesian government currency. So if we were able to determine a way to exchange those resources based on a fair global resource, such as Circles, that every individual could be able to meet their basic needs on a daily basis. So what could that solution be? What we found is that if we had a community-driven initiative, so for the people, by the people, implemented in a proper way so that there's ownership and people actually buy into what that value is, that we could help meet those needs. So we're currently experimenting this whole process in Bali right now with Circles by providing 1 circle per hour, that's 24 circles per day, to each participant to help them meet their daily needs and really improve livelihood opportunities. So what we really believe is that as a complementary cashless solution, Circles can really advance humanity into this era that we all want to see of mutual support, abundance, and sustainable growth. So why UBI on the blockchain? So UBI has had a resurgence in really redistributing that wealth. We saw that during the pandemic with the stimulus checks, and as you all very well know, AI is creating job disparity and income loss for a countless number of people. It's no coincidence that ChatGPT's creator, Sam Altman, has also created WorldCoin, which is poised to distribute UBI on the blockchain. And also blockchain is just really an incredible tech solution that we really believe can have a convergence for all of these points to position UBI on the blockchain, such as Circles, as more relevant and important than ever. So that's why Circles aims to put wealth in the hands of those who need it most by using this transparent, decentralized, and community trust-based system. But what really matters are these people that you see here in these pictures. This is the community that we're serving. We really want to see this for the people, by the people. So why Bali? Why did we choose this little island in Indonesia to test this theory out? First of all, there's a social structure in Bali called the Banjar. And the Banjar is basically a neighborhood. It's a collection of 50 to 250 family leaders that form the lowest form of government. And so this is where a lot of government decisions are actually made on that localized level. And there's this financial system of debt that synergizes very well with this decentralized trust system that we have of Circles. We also wanted to prove the concept in developing countries and remove the barriers to mass adoption for these target market of micro entrepreneurs. And I'll tell you later about our total addressable market of 500 million that we're looking to remove those barriers for, to have this easily accessible and really help meet those basic needs. We also chose a location such as Bali where UBI can have an extreme life-altering impact to really empower people. So one example of that is how we decided to value one Circles point. So again, you receive 1 circle per hour, and we valued that at 1 banana. So something very, very understandable for individuals to comprehend in their daily lives. So 1 banana is the equivalent of 1,000 rupiah. And rupiah is that fiat currency for Indonesia. So 24 circles daily is equivalent to 24,000 rupiah, or about 1.5 euros. So this is 27% of minimum wage in Bali. So just imagine this. You are a Balinese citizen living at the poverty line, and you have 27% of disposable income that you are earning. That can make a huge difference in your life. Another aspect is that we have an incredible team that is very experienced in Bali. Not only our impact team that is doing the implementation, but also our Gnosis partners. Nogi, shout out to you. But we really have primed that social capital for adoption. And here they are. Here's our team. This is actually our team in the black shirts that you can see here. This is our first product testing event that we had during our initial beta launch in May, and they're just incredible humans. So first of all, there's Alam Santi. They're our implementation partners who have been able to help expedite this initiative light years ahead. Like, there's no way that we would be able to do this by walking into a village and saying, try this blockchain technology that you've never heard about in this isolated village that's very remote. So we've built relationships over decades through these partners to be able to go in and be able to offer Circles UBI and actually have it be adopted into these environments. So we partner with organizations such as Kalimanjaro and Kembali Berdaya, who are our outreach teams. So how the implementation works is really we have outreach team officers that go out to the villages, have gotten all the approvals through the government systems, up from the Banjar, up through the Desa and village level, and be able to have field officers who they recruit who are local Circles champions who represent this and are that local point of contact for any questions, onboarding, how to deal with technology, and they're just incredible. So those are a lot of the individuals doing the circle sign here in the field. Let's see. Most importantly, we have our Gnosis partners. So I want to give a shout out again to our Noki team that's here. This is Circles and Gnosis, Noki. So they're developing all of our tech, and they have funded this product testing through the Gnosis DAO. One big partnership that we have is the IndoBig Network and the UBI Labs. So that's the Indonesia Basic Income Group Network. This are our government partners as well. They're associated, we align our values and our mission with the Indonesian government. And this has been able to help us get the research permits to operate in Bali and be able to provide universal basic income without threatening the Indonesian rupiah. So part of the legal landscape that we have in Bali is that it is illegal to buy goods and services with anything else other than the Indonesian rupiah. So we are not considered a crypto. It's a Circles point that we're using to supplement the daily income of individuals. So we've been able to work some magic with aligning those goals and with these partnerships, which give us credibility. We also work with Memory, which has helped us with our governance system. So it's democratically based and very transparent. One thing that I want to clarify is the two separate entities that are working on Circles. So we have the Circles Co-op that is based in Berlin that's running the flagship pilot. That's how I first heard about Circles in 2020 through the amazing work that they're doing. Their website is circles.coop and their product is circles.garden. So very separate markets that we're serving, very different approaches, different product and app completely. But today we're talking about Circles Indonesia, and we are testing that product and concept in Bali with no subsidy program. Our aim and intention is to be able to have sustainable transactions that can grow organically without the constant need of being able to subsidize any sort of payments. We're also have the vision to be a coordination hub for the global expansion in developing countries. And we're doing that by all the extensive research that we're doing, tracking all this information and having these documents and handbooks for individuals to start their own global Circles hub. Highly suggest checking out our website, Circlesubi.Id, tons of information on there, all of our past research, all of the stories from the field, which I want to share some with you about. And our product is app/Circlesubi.Id. And here is our beautiful beta web app that we are using in the field currently to our 1,500 participants in our research beta pilot. So when you come to the landing page, you have this beautiful photo of this Balinese woman who's asking you to support your community through universal basic income. You go to your profile, very easy, pulls up a QR code, you scan that, and you're able to trust and exchange circles with one another. You can see on the right here, there's your balance, where you get 24 circles per day. And on the right, you see the marketplace, which is a key aspect for people to be able to understand how they can spend their circles across Bali. So there's a geolocation service that says exactly where, like, I want to find a dentist. I'm based in Denpasar. Where's the closest dentist that I can use circles to meet my basic needs? Then you physically go to that location, ensure that that's a person by trusting them, and you're able to exchange circles. So we kept it pretty basic, pretty easy for individuals to use, and pretty easy to replicate, not only in Bali and across Indonesia, but across the world in all these developing companies. So this I'm very excited about. This has been a work of art to be able to create these real-time reports and be able to get information from the field so we can adapt and be able to implement in a more effective way. So as you can see from the map of Bali, there are 3 main areas that we're testing circles in right now. One is a rural area in Jembrana, very remote, takes 4 hours to get to from any other city that we're based in Ubud. So wanted to see what that environment is like. We had 97% approval rating before we went in there, so it's pretty cool to see that it's actually working in these areas. We also tested in Denpasar, which is a very urban area, and then a semi-urban area. You can see from the user growth that this is just incredible that we've been able to onboard so many people in such a short period of time. We did have some tech issues, as you can see from the graph going down of the days that we were working out the bugs. But I just want to give a shout out again that we're much more stable now, being able to implement a technology such as blockchain in Bali, and it's being adopted by these communities. I think this is the key to what we're seeing in the initial success in this pilot so far, and it's the healthy ecosystem that we've created for continuous exchanges. So users have created shops in various basic needs categories. So we did a lot of research in 2021 to be able to understand what people want, collaborated with them to understand what is needed and where can they spend their circles to really help meet the basic needs. So as you can see from this graph, about 25% of that is food and beverage. There's also utilities, grocery shops, ceremony supplies are a big expense in Bali, tools and equipment, garden and farm products, laundry, education, transportation, construction services, health services, and salon and barbers. So the most exciting aspect of this is that we're really seeing this healthy exchange and dynamic because 97% of participants who are receiving their basic income are also vendors that are listing their goods and services in exchange for circles. So we have about 1.5 thousand shops in just 10 weeks after launching this app. You can see the marketplace where some of these are listed. They create their shop. You have images. You can contact that person. And it's actually working. So these graphs, I just want to give a round of applause also to our teams. Can we do this? Can I get some applause here? This is really, really cool to see these kind of graphs. This is exactly what we want to be seeing in this experiment to see how this actually works in the field. So we've had 750,000 Circles points exchanged already. After just 10 weeks of being able to onboard, go through getting the tech set up properly in these communities, and we're seeing the graphs go exactly what we want to. The top one is the daily exchanges that we're seeing, and the bottom is the weekly active users. So we want to see these sustained transactions, and we're seeing that. So I can tell you all about the impact that it's making in Bali, but I think it's best to hear this from Ilu, one of our users in Denpasar. So let's go ahead and play the music. Can we turn the volume up a little bit, please? I want you to hear the gamelan music so you can actually understand and see what this is like in Bali. This is very different than the communities in Berlin that you're involved with. So Ilu was asked what the benefits are that she's seeing from Circles, and she's based in Denpasar. This is her home in her Banjar. So she's saying that exchanging Circles points for the things that she really needs helps her and her children to be able to meet their daily needs. She said the biggest benefit is that it's so easy to use. They can get all the things they want in the marketplace for Circles. For example, she got ceremonial needs for Galangan holiday. Galangan is like Christmas. It's a 2-week holiday, biggest holiday in Bali, and a huge expense is the ceremonial supplies that are required by your Banjar to participate in this community. Her biggest suggestion is to continue exchanging Circles to build your trust network so that you can use the network of friends to exchange these points to make your life much easier. She says it's very exciting and she wants to do more exchanges and get more points. So that's a little snapshot into what life is like in Bali. check out our website if you want to see more. We have a 10-minute video on our homepage, which specifically goes into the different regions, goes into the shops, and shows what people want and what life is like with using Circles there. Our vision going forward. So right now, our main goal is to be able to show these sustained transactions and really how Circles works in communities in places like Bali, so it can be easily replicable and have that mass adoption that we're looking for. So once we do this, in our current pilot plan, our plan is to expand to new areas of Indonesia. From our research, we found that it is one of the world's most ripe regions for the use of Circles. And so with that, we're going to build a global network of community organizers through the Global Grant Strategy Program. So this is what we're launching at the end of this year or at the beginning of next year to empower Circles hubs around the world. We have two main targets with that. The first one is micro-entrepreneurs, that just like you saw with Ilu. So Ilu is running a business out of her home and a small warung. So these micro-entrepreneurs in the top 22 developing countries have a total addressable market of 366 million. People facing job disparity, particularly from AI, also have a total addressable market of 177 million. So there's a big goal for us, and we have an incredible team to make this happen. So in order to do that, we do need to get the tech to a place where it is extremely easy to use, adapt, and be able to expand. So our next goal is to be able to develop and launch a native Circles app. There's so much that I can discuss about what that implementation strategy is, but just to give you a timeline of how we've operated in Bali, we started that research in June of 21. So we spent a good 6 months of doing this market research, understanding these communities' needs. And in June 22, that's when we partnered with the Gnosis team, Noki, to do the product design and development. We got funding in April of this year from the Gnosis DAO to do the product testing that we're currently doing. So in May, we did that product test that you saw the beautiful picture of everyone doing the circle sign. So we've done some product fixes there, bug fixes, and really gotten that technology ready to where it is now with our field testing and market activation. And so in December, we'll produce our annual report of the research findings. You can find all of this on our website, and we're looking forward to scaling and going global. So I would like to invite you to join the Circles movement. You can contact me at Shaunda@circlesbali.org. You can also go onto our website and have any contact there. So sign up and receive our monthly newsletter. This is where we produce stories from the field. Last month I shared about one of the women. We did a contest on a Facebook group about what are the most impactful stories that you have about your use of Circles. And this little girl collected her entire community and had her send them all of her Circles so she could gain enough Circles to buy her mom a cell phone for her birthday. And so her mom, this family is below the poverty line, and so the ability for her to do a gift like this for her mom, it's so meaningful to me. That's what really matters. So get more stories like that in our newsletter. If you are coming to Bali, please reach out. We'll hook you up with a Circles account. Right now, it's invite only, so invite links, and we also allow vendors to invite their own individuals, so we have that organic growth going too. If you want to start a Circles hub in your area, let's chat. I'll be around for the rest of the week, and thank you very much.
Thank you very much, Shaunda. We have around 3 minutes for questions.
Hello, great presentation.
Thank you.
A quick question. How do you plan to sort of scale the funding to support more and more places for being able to open Circles and share UBI?
Great question. So we have done a lot of A/B testing throughout the different stimulus activities that we've done and really tried to reduce costs for these Circles hubs that we're planning on expanding. So right now we're working with the Gnosis DAO, and we're putting a new proposal together in November that we would like to have approved for that expansion project. And we are looking to reduce those costs significantly for those other markets, since we'll have already developed the best strategies that we found for implementing and engaging these communities as well.
Thank you for the presentation. Technically, this is all running on XDAI, right? So if I, with my Circle's Garden wallet, trust somebody with a Circle Indonesia wallet, would that work or not?
Right now, the back end is compatible, but there are some differences where you're not showing up as the same contact if you were able to engage with that Bali community. But if you came to Bali, you would be able to exchange your circles in Bali as well, and that valuation for that one circle for one banana.
Thank you very much for the great presentation and also for answering that question. I had the same, but I have another one with regards to how you are able to onboard shop owners and micro entrepreneurs. Maybe you can share a little bit about the strategy you implemented.
How you can reward.
No, how you onboarded.
How onboard.
Yes, you showed that almost, I think 97% also offers services and products in Circles.
Yeah, I think this is the key to why we're seeing more sustained growth in Bali, is that we are rewarding the vendors. So one of the simple things that we're doing is offering little perks, like as a vendor, if you sign up and create that shop on the marketplace, you're able to invite other people to receive a basic income too. And so the whole intention is, if you're a vendor and someone comes to buy your shop, you want to allow them to be able to use Circles to buy those goods and services. And so it is a big perk to be able to invite the rest of your friends and family to join and receive a basic income. So that's one of the aspects, but we've also relied heavily on our field officers and our outreach teams to be able to understand who was being selected for this 1,500 person pilot and say, okay, we need to have individuals in each of these categories to ensure that basic needs can be met and you can spend your circles no matter where you are. And so these individuals were selected because they were able to offer shops in these different categories, and then that has grown organically where they've chosen individuals to be invited as well. And so that's why we've seen such growth outside of those main clusters of those 3 areas that's organic and now all around Bali.
Thank you very much.
It's beautiful to actually see it working, so thank you very much.
Thank you, Shaunda.
Thank you.
Great talk. Next up is Luuk Weber, who will talk about the latest trends in regenerative finance. Let's welcome Luuk Weber on stage.
Thank you.
Here's the next slide. If you want to go back, it's the wrap-up.
Thank you, sir. Good morning. I'll give you all a couple seconds to settle in. How's the bear market going, people? How are we feeling? Good? Who here feels that you're losing or have already lost your motivation to build in the Web3 space? Motivation. Who still has motivation to build in the space? Couple hands? Everybody? Some of them? Who feels that we have made meaningful progress in the last 2 years with the capital that we had? Hands? Less than half of the people. That's not good. All right, so today I'm going to give you a quick overview of the emerging regenerative finance space, and I'll make the argument why building for the global crises is the best use case of blockchain, and why you as a builder should probably be looking into solving impact problems instead of only making money. Who remembers this? 2008, I was like 12 when this happened, so I don't know much about it. But what I do know is that this was the financial crisis of 2008, and that there was a lot of pain and friction behind this picture. What you see is an investment bank going bankrupt, but what you don't see is all the people in the back losing their homes, losing their faith into financial institutions, into institutions in general. A global crisis that took years and years for people to get over. But it also created one of the most relevant innovations of today's day and age, the Bitcoin white paper. And following that, the launch of Bitcoin. It was a direct relationship or a direct reaction to this crumbling financial system. It was looking for an alternative or a complement to this bureaucratic, inefficient, impersonal system that was clearly not working for us already 15 years ago and still today. With the Bitcoin white paper, we started this revolution of blockchain, which took us all the way from cryptocurrencies to this ReFi space that I'm going to tell you about. But let's settle into today a bit, looking at some of the biggest challenges we face today. This is a shot from the World Economic Forum. Who's afraid of the World Economic Forum? Hands? No maxis? Awesome. 2 hands? Okay, sorry. They're not that bad. Maybe they are, but we can do better. Look at a couple challenges that they're prescribing. They might be wrong, but it's very likely that they will be coordinating efforts, energy, money to these challenges. We can't ignore it. At the top of it, you see that it's all environmental, climate action, extreme weather, biodiversity loss, but we're also seeing more society, where the economic side is only down at the bottom. So as we're seeing, we are starting to realize that our systems aren't just under financial pressure, but we're also under environmental pressure, under pressures in society. Now, we can get this bleak image from this. It's like, oh, there's so many challenges, right? There's climate change, it's getting hot. It's freaking hot. This summer was incredible bad, to be honest. And we can look at the numbers. Climate change will cost us about 23 trillion by 2050. The global debt right now is at the highest point ever, with the highest leverage ever. 300 trillion US dollar, a 3.49 leverage on average. That's a lot of debt. And we're seeing it now. We're seeing it in inflation. The average this year or last year was 7% all across the board. This means that people have 7% less value, 7% less well-being, 7% less houses. It's struggling. It's taking people's value away. But what if we turn it around? What if we don't look at these things as challenges or problems, but as opportunities? Because in business, you're being rewarded for solving problems, for building something that solves real people's problems. And these are big problems. If you look at the climate change market, right, $23 trillion, that's way bigger than any part of the blockchain space nowadays. It's bigger than the majority of economic value that we're coordinating right now. So it's also enabling us with our new innovations to look at these things and say, hey, if the world is gravitating towards solving these problems and we have innovations that they've never played around with, why don't we spend our time here? A common thread among these challenges is that although they're global, they can only be solved on the ground. We can't stop climate change just from our living rooms here in Berlin or wherever in Europe. We need to make sure that the actions happen all across the globe and that it happens efficiently. Because in the end, it's all coordination. Beautiful meme by everybody, essentially, in the ReFi space. But in order to get there, we need to accelerate these local coordinations. And we can do that with the blockchain infrastructure. Our open source knowledge and tech allow us for the first time ever to have pure and true digital assets and digital settlement. We're able to coordinate capital around the world faster than ever before. And by innovations in the measurement, reporting, and verification space, combining AI, machine learning, blockchain, we're able to measure impact better than ever before and valuing it. By doing this, we're able to allow local coordination like never before. The challenge, most of the actions we're doing nowadays are still in this degenerative or value extracting paradigm. But what if we move from degenerative to regenerative? What would it look like if our existing financial stack on top of blockchain, the DeFi space, moves towards something that's more regenerative? What if we go from profit extraction, tokens that are here for the pump and the dump, let's make money in 18 months and get rich and then exit? How do we move from there, from this profit generation and extractive economics, towards a world that's about value realization and regenerating, improving the state of well-being of all? Moving away from this short-term thinking in a year or 2 years, lockups of 18 months, to long-term oriented. What would our space be in 10 years or 15 years from today? What is the world we want to live in? Moving away from this mechanistic or reductionist mindset of just focusing on one single thing, one KPI, money, to a more natural and holistic view of the world, of the value we create. This is a beautiful graph that explains or kind of visualizes this transition from degenerative to regenerative. From this conventional thinking where everything was built and structured like machines, like factories, where people were working like slaves, 9 to 5, 9 to 9, 6 days a week, to a world that is built more like nature, more patterns, more holistic thinking. And that's when you get into this transition. So initially we were this conventional mindset. We were taking everything. Our economies were just going into places, extracting value. And over time, we've started to move towards sustainability. We realized that we're destroying the earth, we're destroying the social fabric, and we need to slow it down. We need to do less bad. Now, are we going to be able to make the world a better place if we only do less bad? Probably not. We need to start doing good. We need to start making things better again. And that's where this regeneration comes into play. It's taking less energy to do more. It's a mindset shift from extraction to creation. And it's on top of this mindset shift that we're seeing more and more innovations, especially over the past 2 years, that are tackling some of these crises. One of them are the environmental projects. Think from all the way from on-chain carbon credits to better measurement reporting and verification. You may know some of these projects. DAO, they were the first ones to use Ponzinomics to buy a ton of carbon credits with the intent to experiment with how we're able to accelerate that market with new capital. That was powered by Dappcon, a project based in Berlin and Switzerland that is bringing on these traditional claims or credits from the Web 2 world and bringing it onto Web 3, allowing for more transparency, faster settlement, better markets. Or Region Network, taking it one step further. They're making Web3 native standards for measurement, reporting, and verification, and carbon credits or climate credits. By creating these markets, we're able to create an experience that's 10 times better than the conventional systems. Right now, if you're a country like Germany or the Netherlands, and you want to invest into carbon credits, you're most likely going to end up with a claim on carbon of a forest in Brazil or somewhere with very manual and slow and expensive ways to measure, report, and verify that. There was an article a couple months ago that over 90% of these claims were false. They didn't have any value, they were false claims. And that has a big effect on people like us, right? We're not going to buy anything that's 90% a scam, besides cryptocurrencies. But there is a way forward. And then there's a project like Gainforest, for example, that's using advanced AI, machine learning, on-chain assets to just create this environment where you can literally 3D see every single tree, and there's no argument to be made. This is happening. People are planting trees, are making the world a better place, and are being rewarded for it. Let's look at these economic crises. We just had Circles right before me. They're doing amazing work. And there's other projects that are also doing comparable or similar work. So for example, in Kenya, you have a project called Grassroots Economics. Who've heard of Grassroots Economics before? Cool, then I'm going to teach a lot of people something new. So Grassroots Economics is a project that started with the Red Cross in Kenya. They have created a mutual credit network in about 200 communities, over 50,000 users. And they've been able to leverage $1 million of the Red Cross to coordinate about $6 million of value every year. And they're essentially allowing people to leverage their donations, to leverage their impact. And they're now scaling to other countries like Zimbabwe and, if I'm not mistaken, Cameroon, another country. Sorry for not knowing that. Then there's Ethicup, who have been providing on-chain loans to farmers in Latin America for over 4 years already. They started all the way back on XDAO. They've processed over 6 million of loans. And what they're doing is they're enabling these farmers that are traditionally captured into very extractive systems, paying up to 40% returns on their loans, and allowing them to be matched with people like us who are eager to get 10, 11, 12% on our money. GoodDollar, Impact Market, also UBI projects that are taking similar approaches to Circles. Some of them are adding in microloans, others are adding in identity, but really trying to find ways to allow local communities to coordinate resources without being dependent on foreign capital, without being dependent on, for example, the US dollar flowing into their economy to create action. Because a lot of communities do have the talent and the land to coordinate value, but what they're missing is this cash, the capital, to realize that value. Then the social side. There is a project called ReFi DAO. Who's heard of ReFi DAO? Also not too many people. Awesome. So ReFi DAO is almost like a spin-off of something like Bankless DAO or the Daoist. And what they're doing is they're creating a social, cultural, and economic movement around this concept of regeneration. And what they've done, they've created over 40 communities around the world that are organizing meetups and events to talk about this concept of regenerative finance, to bring in talent and capital into the space. And today they have about 1,500 members. Then there's Greenpill from one of the founders of Gitcoin that is taking a similar approach and trying to leverage the blockchain technology that we have to allow local communities to do better and get access to these solutions. If you ever wanted to live with a bunch of people for free, the Dream Factory, if you hold their token, you're able to live in their co-living environment. They're making a co-living space, and later today they're also sharing about all of that at an event we're organizing. Then there's Regions Unite. If you're here on Friday and Saturday, they're doing a Regions Unite here in Berlin. It's a great opportunity for you to not only listen to what people are saying, but really connect with other people that are trying to find a way to have a positive impact with the innovations that we're building. Now, the capacity of blockchain is increasing rapidly. This year alone, we're seeing new innovations from scaling no longer being a big issue to token-bound accounts, smart wallets, progressive web apps. There's so many innovations that allow us to create a UX and experience now that is 10 or even 100 times better than what we had maybe 5 years ago. When I came to my first Eat Berlin in 2019, we couldn't even imagine the solutions that we had nowadays. Back then, everything was proof of work. We were polluting, we were destroying, we were taking. It was all about learning how to even run a stable blockchain. Now, a couple years later, we don't even think about that. I think very few of the talks at this event have been about, oh, how do we maintain a stable blockchain? How do we do these things? We're now progressing to the actual value layer, and how do we realize value in the real world? So imagine being able to move away from a currency that, like Bitcoin, that is purely focused on security of a network, which is a very basic function. We have been able to accomplish that now across the board, towards something that is regenerative by design, something that's driven by, for example, nurturement of nature, the stewardship of nature in communities, or the ability for a solution to tokenize value and bring it on-chain. It's from this point we can start imagining currencies that are embedded into the real world and create these positive feedback loop, that creates these regenerative economics, where every time that it's spent, it creates more conditions for prosperity, where every time, with every person joining the economy, we're increasing our capacity to do good, we're increasing our capacity to value it properly, and we're increasing our capacity to realize that value. Almost like a memeable impact network. And we're quite close, I would argue. We're getting better and better at, like I mentioned, measuring, reporting, and verifying this value. We're getting better and better at acknowledging the value of nature, right? World Economic Forum, all the nations, they're looking at it, they're pouring more and more money into it, and it's really creating this opportunity for people like us to innovate with this new technology. But why would you do it? Does it pay well? Honestly, not that great at this point. However, there are so many new ways of value that you're going to appreciate as you embody this regenerative mindset, as you're going to move past just prices of currencies and looking at number of users, relationships, impact, and I can attest to it. So over here you see a couple of screenshots of the things that I am most proud of. It's no solution, it's not a tech piece, it's nothing. It's real-world things happening in the real world that have been created by these solutions. So the first and third picture are from the Kolektivo festival that we organized in the Caribbean last year. We had 700 attendees. We piloted our impact economy solution with over 400 users. And overall, that was a mind-blowing experience. It's something I will never forget, and it's something that keeps me motivated. Even if prices go down, I can look back and say, we did this. We are making a difference. In the middle one, it's a grant we issued, also in the Caribbean, to a group of teenagers. They're called Youth for Climate. They're organizing cleanups and education events. And back in 2019 already, they requested a grant from our on-chain DAO called CuraDAO. And we asked them, why are you coming to this weird blockchain thingy to ask for money? And they said, because no one else is taking us serious. They've worked with the government, with large corporates, all cute, sprinkling money on them. But no one asked them, what do you want to do? How do you want to have an impact on your community? And by our new technologies, we're able to provide people like them with the tools they need to take action and doing it at a big scale. So if you're interested in regenerative finance, the best way I would say is to experiment with it. Either go to Valora.app, which is the main wallet of the Celo ecosystem, which is a blockchain specifically built for impact projects. It's carbon negative, so it's actually subtracting more carbon than it emits by purchasing carbon credits and burning them. Or if you're even more interested, we're organizing a ReFi fundamentals event later today. It's from 2:30 onwards at Factory. The wait list is already long, but if you really, really want to come, give me a hand. I'll find a way to get you in. There we'll have 4 projects that are going to give an explanation of their case study. For example, Gainforest will be there explaining the challenges of the traditional MRV stage and explaining how their innovations are able to surpass these limitations and build a solution that hopefully will be able to have a big impact. So with that, I'll go to Q&A. Looking forward to your questions, and thank you so much.
Hi there. I work in the space. I'm a big fan of Kolektivo, so thanks for your talk. Talking to people that are building in this space and using carbon credits, what I hear a lot is that there's a lot of distrust. You're almost piling distrust on top of distrust because you have to convince people about the value of carbon credits, and then you have to convince people of the value of blockchain. And outside this room, blockchain has a lot of distrust. So what would be your advice to builders in the space that are encountering such obstacles?
Yeah, so I think there's a very sad story. Last year, I gave a talk at an organization called Nederland Maakt Impact, which is like the Dutch young, innovative entrepreneur network. And I asked them the question, who thinks blockchain does more harm than good to the world? Everybody raised their hand. I would say 98%. So that's definitely something we need to overcome or find a way around, right? A lot of solutions coming on nowadays, especially with the innovations I mentioned, smart accounts. You're able to do all the things that the blockchain allows you to do without even having to mention blockchain once. I think that's just a really good meta if we want to really reach everybody and go to the billions of users. We need to let go of our technical terms. And there's ways around it now, especially the coming months. On the carbon credit side, there are essentially 2 pathways that we're seeing. One is people realize that the initial generation of carbon credits are just really bad. That's why we're seeing the innovations on the measuring, reporting, and verification. Bringing in AI and machine learning, IoT, makes a very, very big difference. We are able to verify with multiple sources. So for example, an underground app combined with satellite data, combined with a reputation system, just makes it much more trustworthy. But also we're seeing a broadening of the meaning of these environmental credits. So we're also now seeing development of biodiversity credits, or credits that are also taking in other types of values, such as reducing inequality, creating opportunity, creating a safe space, that are also now being valued slowly. So I think it's really going to take some time before it's kind of mass market ready and everybody should be building an impact app, but we're definitely seeing positive developments in that direction that will allow it to be a proper, healthy market. There in the back.
Thank you for the talk. Just commenting on the previous question, we use blockchain and don't mention it for an application for energy communities where we basically do the payment between the members and don't need a bank for it. My question would be, if we think that thought further and you're thinking about wallets, how does a wallet look like if you don't want to mention blockchain anymore? And what wallet would you say is closest to what you think would be a good solution to kind of get around this kind of distrust in blockchain?
So my answer would be no wallet is a good wallet. I've been really obsessed with smart accounts for the past months. It's allowing you to embed the functions of a wallet natively in an application. So the user journey in, for example, Friends.tech, which is like a newer application, you don't have to go to MetaMask and then go to a website inside of MetaMask. What you do is you go straight to the app. It says connect with whatever, save your backup wherever. It could be on a drive, it could be local storage. It could also be abstracted away to a third party. And by doing that implementation of smart accounts, you're able to create that whole kind of all the transactions, everything can be stored natively. So you no longer need a separate wallet and a separate application. And I think that that is really going to make people feel much more confident. And also just the experience of being a user is so much more stable if I just tell you, hey, go to this website, connect with whatever thing you already have, and you're ready. You can start transacting, you can start doing. So I think that that innovation specifically, I think, is going to allow us to just open up conversation with stakeholder groups that we've never been able to convince because they still had to go and write down crazy words and pay gas fees and all those things that were just hurdles along the way. If I had to pick a wallet right now, I would argue for something like Rabby if you're an advanced user, or something like Valora if you're mobile first, just because they are quite extensive and relatively simple. But generally, I do see that we're moving away from wallets being the main way to engage with a blockchain app and going more and more towards kind of app-native engagements, just like we're slowly moving away to almost like app-native chains and things like that. I think we can do a question, final question. No one? There. Nice.
So we've focused a lot on this talk around impact certificates. So being able to say, okay, I'll buy some carbon credit to be able to offset my impact. Do you have any good examples of ReFi projects that are going to be internalizing their impact and trying to reduce the amount of environmental damage they have internally and helping other organizations to do that?
Yeah, so I think the main front runners right now are layer 1s and layer 2s. They're buying carbon credits or different types of environmental credits to become carbon negative. I think that's like almost like corporate social responsibility, just the big corporate saying, oh, we need to look good. So that's like the first step that you're seeing with Polygon, Celo, Avalanche. They're all carbon negative. They're all buying on-chain carbon credits for that claim. But we're also seeing a next stage, like I mentioned, with projects like the Impact Market, projects like that are creating more detailed and more native solutions that are separate from the traditional carbon credit claims, that are also gaining in interest slowly. For example, Celo has a mandate to have X amount of their treasury in environmental credits. I still think that it's going to take some time, a good amount of time, for more projects to be able to have the focus on taking on impact claims into their balance sheet. And I'm even wondering if the majority of that demand will even come from blockchain native projects, or if it's more coming from government, corporates, individuals, all across the board. Does that answer your question or not really? No, that's okay.
Any more questions? No? Okay, then thank you very much for your talk.
Thank you.
We are wrapping up here and doing a lunch break. This room will be closed, and at 1:30 will be the next talk in this room. Have a nice break. See you then.
We're going to start the afternoon session, so please take your seats. All right, so our first speaker of our session is Alex Vinyas from Coop Protocol, and he will tell us about Composable Cow.
Hello, everyone. Thank you for joining me and us. So today I'm here to talk to you about what's next for Cow and entering the era of Composable Cow. And I'm Alex Vinyas, the product marketing manager at ParaSwap. And I've broken down the talk into three topics: a brief history of how ParaSwap came to be, what has the Cow's journey been up to today, and then finishing up with the era of Composable Cow. So first, let's start with a bit of a brief history. It all started with the famous formula X times Y equals K, which actually not a lot of people know, but it was coined by a Gnosis ex-employee back in 2017. And the reason for this was that Gnosis back then was working on prediction markets, and it needed a way to actually trade the outcomes of the prediction markets. So it needed to find a mechanism to trade these outcomes in which also you're not going to have a lot of market makers provide liquidity, right? Because if it's a major kind of event, then maybe market makers will provide the liquidity. But if it's the prediction of market of will Alex screw his Dappcon presentation, yes or no, then you're not going to have a lot of market makers interested. But the issue is that back then, Gnosis already saw that this type of mechanism had a big problem, right? And even after some discussion, also Vitalik realized that the mechanism had a big flaw. And the flaw was that it was vulnerable to MEV, or more precisely, to front running. And this was extremely bad because in the case of a prediction market, if you are at the will of someone who can order the transactions at their own will, it means that also the system is extremely manipulable, right? Like, no matter what you call off-chain, if someone can alter the order at their own will, the outcomes can completely be different. So back then already, Gnosis decided to stay away from this sort of mechanism and try a new mechanism. And even though it's taking a bit of a long time to play out well, I think it was the right decision, and now time has demonstrated that indeed it was. And what was this new mechanism that Gnosis decided to focus on? And you guessed it, it was auctions. And it was auctions because auctions are important in the case of blockchains because there are several points to take into consideration. The first one is that blockchains aren't continuous, so trading on a continuous system doesn't make sense where all the transactions are happening atomically. And this notion of first come, first serve can't really be fair, as it ultimately leads to simply, like in TradFi, an arms race to kind of be the first one to trade and then screw retail along the way and giving them a bad price. The idea of focusing on auctions was that auctions were also great at handling like the multiple tokens that they were going to appear throughout time in Ethereum, because Ethereum has lowered the barrier of creating tokens, right? With the ERC20 standard, it's super cheap and super easy for anyone to create a single token. So this is why also auctions are great for handling multiple tokens at the same time. And lastly, because auctions can add guarantees that play well for the trader, right? Instead of saying, I want to sell this for $100, you go to say, like, hey, I'm willing to sell this. What is the best price that you can actually give me? But throughout the time, Gnosis tried different versions, and along the way, it also learned different lessons. Back then, in 2017 to 2019, Gnosis launched this exchange protocol, which is called DutchX, which was a trading mechanism focused on Dutch auctions. And the idea for this exchange was to help projects that were launching ICOs to actually not suffer from running and offer their users kind of like a fair price of entering in a way of like a normal Dutch auctions. You start at a high price and then decrease the price until the end. But even back then, Gnosis already saw that kind of Dutch auctions weren't the solutions because they're single kind of side tokens, and you can't deal with the liquidity fragmentation that Ethereum suffers, or you can't deal with multiple amount of tokens at the same time. Then in 2019, they also worked on a project called Diffusion, which was a zero-knowledge project focused on Plasma. But I guess the friendly ghost kind of faded very quickly, and the project never saw the light into production. And then in 2019 through 2020, DeFi summer arrived and Gnosis Protocol version 1 was launched. And Gnosis Protocol was a batch auction exchange mechanism with a batch settling time of 5 minutes. It had its own solvers that competed to kind of give the best price for the users. And it also had its own set of liquidity pools. Additionally, also, it had concentrated liquidity before Bankless Shieldboy said it was cool. But the problem is that back then, there was a lot of kind of liquidity mercenary competition. There was a lot of opportunities for yield chasing. So kind of it was hard to bootstrap the network effect of Gnosis Protocol as the liquidity pools weren't big enough to kind of showcase the price improvements of auctions. Then on 2021, Gnosis also launched Gnosis Auction, which was a batch auction mechanism for similar to ICOs, but now they were called IDOs, which were initial decentralized offerings. And the idea was to give uniform clearing prices and MEV protections for those projects that wanted to launch a new token, but weren't really conscious of what was the fair price for their token to launch. And then on 2021, we launched Cow Protocol, which was actually launched as Gnosis Protocol V2, which was a similar concept than Gnosis Protocol, but instead of relying on its own set of liquidity pools, it kind of was a layer on top of all the AMMs and aggregators, so that instead of being self-dependent, it could actually tap on these liquidity pools on top of giving these additional benefits of batching, such as coincidence of ones, or even more just efficient batching of transactions overall. But most importantly, it also had a big moo sound when you trade, which I think is what a lot of people like. And what has been the Cow journey up until today, right? So we built ParaSwap for thinking mainly for all the type of users, but if you kind of like are to group them into 3, right? The first one was retail or the normal user, because the idea of ParaSwap was to use this delegate model execution so that instead of having the user navigate the dark forest, it would be these solvers that kind of do all the execution on their behalf. So this would help users not suffer from MEV, but also kind of not have to worry if they're up to date on what is the best liquidity pool where I can trade. The second one is smart contract accounts, or in general, smart contracts, because the problem back then was that when you traded with a multisig, all the aggregators or DEX forced you to commit to an execution path. And this was cumbersome because by the time that you actually had all the signatures, probably the price was already outdated and the transaction would fail often, which means that you executed a transaction that led you to nothing. But not only that, if you were somewhat fast and could sign the transaction with enough time that the actual trade would hit the chain, the problem that we saw is that most of the time, the path that you kind of like already committed was outdated. That when your transaction hit the chain, there was already like another better path for your trade. And lastly, for DAOs, there wasn't like a really trustless way for DAOs to actually trade. So this is why in the end, we've had all these DAOs just stack up their treasury and not have like, not use it how they should use them. And this is because there hasn't been a way since the inception of smart orders for them to trustlessly trade. They would actually always have to go through like an intermediary that holds the funds on their behalf. But even though it was originally built for these 3 users in mind, it hasn't been the same path for all the users since the beginning. At the beginning, ParaSwap, which is the inventor of the intents, as we know it, by the way, only worked for EOAs because they were the only ones that were able to trade gaslessly. And this is because an EOA has a private key. And therefore, because you have a private key, you're allowed to sign a message saying like, hey, I authorize to do this on my behalf as long as my conditions that I sign here are met. But in the beginning, this was only possible, right, for EOAs. If you were a smart contract, so if you were a safe, you had to actually go the on-chain route and execute a transaction, which, okay, it was still better than nothing, but it was still quite annoying because if you go the on-chain route, you actually had to pay for the transaction, which is a bit more annoying. So it wasn't really until the introduction of ERC 1271 smart order that the thing changed. And as we said before, because an EOA uses e-recover because it has a private key, but a smart contract doesn't have one, we needed a new way using interactive signature verifications to allow the smart contracts to trade gaslessly. And this new interactive way is called is-valid signature, which allows the smart contract to kind of delegate the placement of the order on their behalf and basically just sit back and relax with the guarantee that someone else will place the trade on chain, and they only have to say, I'm okay with this trade or I'm not okay. And if they're okay, the trade will execute. But what's cool is that then you can marry these kind of conditions with on-chain guarantees. So for example, you can say like, only execute if the price is within 1% of this Oracle price, or else just simply don't execute, which is a big step forward for smart contract trading. And now we're going to look at the first implementation of smart orders in CowSwap. The first one was the eFlow, or the native sell token, which was originated because in CowSwap, a lot of people were kind of annoyed and complained that you actually had to wrap your ETH when trading. So basically, we developed this new intermediary contract that would hold the funds on your behalf and would do all the wrapping on the back end without you knowing it. And basically, this contract just receives the funds, does the wrapping for you, and places the order on chain, like to the Call API. And then if the order is successful, basically just sends you the output tokens, or if not, it will refund the original ETH that was placed in them. Then the second one was a collaboration from the Cow Grants program and Yearn, which was a system for advanced DAO trades, which allows DAO to kind of swap autonomously through governance. So instead of having to just make a CIP where you create a new safe and kind of delegate the powers of trading, you can now create a governance proposal that says, hey, we're going to swap this amount of tokens, and we're going to do it through this mechanism that allows us to guarantee that we're not going to get wrecked by MEV, even though we're kind of setting up this trade 7 days or whatever days in advance. And then this milkman, which is the intermediary contract, receives the funds and creates the order on your behalf based on the guarantees that you have instructed it. And already today, DAOs like Aave, ENS, or Nexus Mutual have traded more than $50 million with this system. But ERC 1271 single smart orders have some drawbacks. The first one is that in order to have the swap autonomous execution, they're quite gas heavy, right? It takes a lot of gas to kind of encode these orders on chain and have them execute. The second one is that they require some trust, because this intermediary contract, actually, to be able to place orders on your behalf, need to have the funds on it. So in this case, this can be worrisome for certain people, and understandably, because you lose the custody of the funds and you're at the mercy that then you can actually withdraw them, or that this intermediary contract is going to work and allow you to withdraw. But lastly, is that they're single order, meaning that if you want to deploy multiple orders at the same time, or multiple orders for whatever strategies that you're doing, you have to make a signature per order that you're creating. You can't just sign all at once. So because of these drawbacks of ERC 1271 orders, DAO contributor decided to step up and create a framework around these orders. And this is why we're now entering the era of Composable Cow. So where is Composable Cow? Well, it all started, as I said, because a DAO contributor wanted to do time-weighted average orders to buy ETH. But the problem he had is that he was a little bit lazy, so he didn't want to sign each order each time. So then he started to develop conditional orders so that this use case could actually work for him. But then he had this light bulb moment, right, where he realized that, hey, it's much better if we just create a framework around this so that anyone that thinks alike like me or is a bit lazy can actually encode all these orders on chain and have them execute autonomously. So Composable Cow is this conditional smart order framework that allows a smart contract to express its intent to trade in Cow protocol. And what's cool about this is that everything is on chain, so that there is no trust assumption because your assets are held on your own safe. You don't need to send the assets anywhere until the trade is actually happened. And lastly, it's also super cool that everything is specified on chain. So in case you're kind of like, how do you say this? In case you're not very trusty of the protocols that you're using, you can add these guarantees on chain, knowing that what you're coding or what you've programmed is going to execute as is. So where is the Composable Cow architecture? When you deploy a safe, there are two signing methods by default allowed, right? The first one is a proof hash transaction, which was the one we use for pre-sign. And this is just basically executing a transaction on chain that signals that your safe is allowed to do whatever operation that you're doing. Then the other one is threshold, which is basically the assembly of the signatures, and this one is the one that's gasless. But if you actually create a custom fallback handler, then you can allow your safe to sign and validate much more complex orders that, by default, the safe is not able to understand. So basically, you're allowing your safe to operate in much more complex scenarios. And this is where iSignature Verifier, in combination with ERC 1271, was created. And basically, iSafe Signature Verifier is an ABI encoded function call that triggers a custom call for a signer, which in this case is Composable CAO. And what does Composable CAO enable, right? So another cool thing is that instead of being single order, which was the normal ERC 1271, Composable CAO allows you to execute unlimited smart orders in parallel, right? You're not bound by the orders you're signing, but rather by whatever you want to do. And what's cool about these type of orders is that they have a lot, like extreme gas efficiency, because all your orders can be summarized into a single Merkle root. And what's cool about this is that you actually achieve a lot of efficiency in creating, deleting, or replacing orders, because instead of having to replace one by one, you can simply just change the Merkle root, and you will, by de facto, change whatever orders that you want to do. And what's even cooler is that you have achieved a lot of gas efficiency in here, because creating 1 to 1,000 orders is going to cost you the same gas cost. And lastly, it also allows you to have your own assets in the safe, which is quite important, as you have full custody of it. But Composable CAO actually has 4 main properties when you're creating an order. The first one is the handler, which is the contract that verifies the conditional order parameters. So in this case, for example, in CAOSwap, if you're doing a TWAP, it would be like the TWAP contract. Then you have the salt, which is like a cryptographic guarantee to kind of hide what you're doing, so that no one that is trying to brute force, and kind of front run you for whatever trade you want to do can actually see it. Then you have the static data, which is all the sell token, buy token, slippage, kind of this parameter information. And then you can add additional off-chain data that can be verified at the time of settlement that only you know, in this case. But in terms of actual example, what does it actually enable? So for example, if you're a DAO or if you're a protocol that has to do fee collection every weekly, for example, it allows you to automatically set several orders to swap token ABC for XYZ once your safe hits a certain threshold, right? So in this case, for example, CAO protocol has a CAO settlement contract that it weekly drains the fees and changes them to pay and swaps them to pay the solvers. So basically, all this process could be automated, saying, hey, as soon as the balance of the settlement contract is more than $1,000, just directly swap them into ETH and deposit them in the solver's payout safe. It also allows you to do DAO payrolls, so say, hey, we know that we have 10, 20 contributors, and we have to pay them at the end of the month. So instead of having to do this recurring swap each month, you can actually just set up the order saying, hey, on this month, swap this amount for ETH for USDC, and send the tokens to all these contributors. And here is the cool part of the Merkle root that, say, one contributor throughout the month kind of disappears and you don't want to pay them. Well, instead of having to redeploy like one by one the orders, what you do is just simply update the Merkle root. It also allows for good after time orders, which is trade on September 30th, and not only until then, you're allowed to trade. As I mentioned, it allows to create the TWAP orders, which is time-weighted average price, by just breaking the order into n times the good after times. So when you're breaking the order into, 5 parts of 1 hour, you're basically creating 5 good after time orders. It allows you to create private conditional orders, and in this example, the cool part is a stop loss. So basically, only you know when your trade is going to when your trade is going to hit the on-chain, so you can keep it quite confidential, your trading strategy. it also allows for wait for cows, basically just signaling to the protocol that, hey, I don't want you to route this to a liquidity pool or whatever. I only want to trade when I'm doing this peer-to-peer with another user. And it also allows to place all these orders that we mentioned above simultaneously at the same time. But most importantly, it really allows you to do whatever you can imagine and you can code. And so concluding, what does Composable Cow enable, right? Composable Cow allows your safe to turn into your autonomous bottler for placing orders. But most importantly, this bottler can actually place simultaneously conditional orders and trustlessly because you own the assets and you can add your on-chain guarantees. And if you're interested in integrating, reach out to bd@cow.fi. And if you're interested in building and want to get a grant, reach out to grants@cow.fi. And thank you.
Thank you very much, Alex, for this presentation. The floor is now open for questions.
Easy questions, please.
Yeah, so there's the trigger and there's the action, right? In the trigger, you need to define what's the condition to do the action.
Yes.
So can you really do anything? For example, I would like to withdraw my funds from Curve if this something on-chain happens.
Yeah, so that on top, when we actually launch Cow Hooks, you can actually combine it so that then this action, because Composable Cow is specific to the swapping aspect of things, but then enabled with Cow Hooks, you can actually combine it with what you're saying, like kind of withdraw from this LP position and then actually send the withdrawal result to swap, I don't know, on this day, for these tokens.
And the logic is based on smart contract or a message that you need to sign?
No, on the smart contract. On the call data, if I'm not mistaken.
Thanks.
Any other questions?
You spoke about integrations. Do you expect a user interface to be available for this as well, or is this more protocol to protocol?
I mean, I guess ideally we'll have a user interface, but as is right now, it's more developer focused and developer friendly, right? It's not there's no easy way yet to kind of do this through an interface. I mean, you have TWAP that's the first interface of Composable Cow, but that's so far the scope of the user interfaces. But if anyone has an idea and wants to build a UI, please reach out.
We have a little bit of time for one or two questions, maybe.
Or we call it a day.
Yeah, we can call it a day. You can always find Alex in the break.
Thank you, thank you.
Thank you.
Thank you very much.
Short break of 1 or 2 minutes. We will convene here in 3 minutes. So. Short break is over. So everybody who's staying for this next talk, please sit down. If you would like to continue the conversation, please do it outside the room. All right. So the next talk in this session is from Kiba Gateaux from DebtDAO. And the title of his talk is Aligning the Crypto Funding Landscape with Revenue-Based Financing.
Hello, can everyone hear me? Yeah, sounds like it. Cool, so I'm going to be talking today about revenue-based financing and how that changes the incentive mechanisms and the possibilities of what we can fund within the crypto ecosystem. So first, a little bit about me. I'm a software developer. I used to do Web 2 web apps, and then I moved into crypto Web 3, do kind of everything from smart contracts to subgraphs to token economics. And then I also have a background in design, doing design thinking, service design, systems design, and that's also kind of how I got into crypto, was very much interested in how can we take all these different, very complex systems and make it so that humans can coordinate effectively within them. And so that's why I started DebtDAO, was I saw this gap in the market where a lot of DAOs can't get the finance they need to do their day-to-day operations, and they're kind of forced to either sell tokens or do liquidity mining or just generally do these equity-based things, which might not be in their best interest because they don't have other options. And so we are focusing on revenue-based financing as this alternative financing option for DAOs to kind of help them better execute on their missions. So first, what is revenue-based financing? Just show of hands, has anyone heard of PIPE before in the fintech space? Okay. Or income share agreements that kind of boot camps do with their software developers? No? Okay, a little bit. So basically what revenue-based financing is it's a loan, like you're typically used to, but they secure the loan with your future income. And so instead of putting up some type of assets as collateral like you would with a house and a mortgage, you say you will earn 15% of all the money that I make in order to repay back this loan that we're doing. So it's very popular with SaaS companies that have these kind of subscription-based models, but then also kind of income share agreements like they do with software developers and personal loans. So before we go into kind of like why revenue-based financing is the solution that we think is best for this kind of financing, I kind of want to go into how we ended up at revenue-based financing in the first place. And so the kind of goal that I was getting at with DebtDAO was I was working at this DAO called Index Co-op, and they were spending millions of dollars a month on liquidity mining and contributor incentives, and kind of, you guys know the deal. And it was kind of really hurting their token price, and it was very inefficient to organize all these programs. And then it was also just not efficient from like a financial perspective of how much they were spending versus how much they were actually earning from these products. And so I kind of set out to figure out how they could do capital efficient borrowing, so they weren't putting up a massive amount of tokens that they would probably have to sell their tokens to get in the first place, while also making it fully anonymous and fully trustless. So the anonymous aspect is no KYC, so that they could still do it as the DAO itself. They didn't have to do some type of legal wrapper where some kind of like foundation or something was taking on the risk, quote unquote, for the DAO. I wanted it to be fully crypto native, and then also trustless, where you didn't have to actually trust the DAO, and it was entirely kind of like what you do with Aave, where you know that you can be repaid, even though it is capital efficient and they're not putting up the capital up front. So kind of balancing these three constraints, where it's capital efficient or under collateralized, completely anonymous, and completely trustless, was actually a pretty difficult problem to solve because they're all kind of competing. And currently people do kind of reputation-based lending, where you're in some kind of on-chain credit score, but that I would not consider anonymous or trustless. You're trusting that someone's going to repay based on some kind of personal history, even if that history is associated with an anonymous smart contract wallet or something. So another way to frame this is how can DAOs effectively and sustainably finance their operations while remaining autonomous and crypto native? So allowing the DAO to remain a DAO and not create all these other legal structures and other kind of power structures through off-chain entities that are in charge of like executing on their behalf, but making it so that the DAO is what is in the smart contracts, and the DAO can control those smart contracts directly, which means you're not kind of like delegating decision-making power to other people off-chain, while also allowing the DAO to do what it wants to do better by having these financing options. And so what we're doing at DebtDAO is doing economic and technical research and development into coordination mechanisms and alternative financing to better enable DAOs to finance their operations and give autonomy to them and allow them to build things better without these perverse incentives from equity and VCs and some other things. And specifically with revenue-based financing and debt financing, it's a lot better for public goods infrastructure because you don't necessarily want someone to own, the roads or the internet. You want that to be completely free and public for everyone to use equally. And so without equity-based financing, then you have this alternative where public goods can now get the financing that they need while also repaying investors, while also not having the protocol be captured and become a private good. It can remain as public goods. And through all this, we've come up with crypto native credit, which is essentially allowing DAOs and on-chain entities to take out loans and lines of credits and any type of debt financing completely on-chain, which is in contrast to things like Maple or Clearpool or Goldfinch, which while they do capital formation and have their pools on-chain, all the lending infrastructure is off-chain. So you don't necessarily know where the money's going to or what they're spending the money on. You don't know what the actual business operations and the financial accounting of the companies that you're lending to necessarily are. Like we saw with FTX, it's a great example. They technically had these assets, but they were double promising them across different lenders, and they obviously didn't know what their books really were. And so crypto native credit kind of addresses a lot of these issues that we saw with the collapse of the bull market a few months ago, where a lot of the issues were caused by lack of lending infrastructure to more corporate entities. And currently, we're at the Funding the Commons residency here in Berlin, where we're exploring a lot of these ideas and partnering with a lot of other teams to explore how we can better finance public goods and get them the money that they need to build, fully open source and trustless software. And yeah, so this is kind of like the landscape that we're looking at that we mentioned with the kind of difficulties of doing anonymous, trustless, and capital efficient. And so these are kind of like the different ways that people kind of raise money. So at the top, there's technology, where you're just saying, we want to build cool things together. And then community on the side, where it's like, I want to build cool things with cool people. And profitability is, I want to build cool things that just make me money. And then you have these three different kind of financing options that lean towards like two of those sides. There are like ways that grants or VCs can kind of be more inside the triangle, but this is just for explanatory purposes. And so the main two that we'll talk about are grants, where you're focused on technology and community, and not so much about profitability, and VCs, where you're looking at technology and how it can be profitable towards you. And we'll look at how that kind of dichotomy plays out and where revenue-based financing fits in. So just looking at VCs, the pros are that it's usually easy money to get because they're aligned incentives between the founder and the funders, where the people that are giving you money are directly benefiting from whatever you're getting, and you're also benefiting from the same thing because you have this equity structure, and everyone's on the cap table. It's really good for getting clout and like social signaling, because now you can say that you raised from these investors, and they also give you support from services like hiring to security audits to introductions, business development. You guys are probably familiar. But the cons are that it's generally adverse to community, and so you're going to have to profit off of someone and return the VC's money somehow, and usually that comes from your users. And so it kind of creates this dynamic where you're getting money from these people, but you have to take it from this other group. But the group that you're taking money from are usually the people that you want to be the most aligned with because they're actually using your product. And then you have this kind of like VC obligation, where a lot of founders like feel the need to wake up every day and like provide shareholder value, which is generally not what anyone wakes up and wants to do with their life. But people feel obligated to do it because they've now taken this money and they have a literal like legal obligation. And then the con is that you just have to go through the fundraising process, like always, which whether it's VCs or grants or revenue-based financing, you always have to do. And then the issue with this VC model is that they all have the same operating principles, where they are trying to get like 100x growth, and that means they have to invest in specific things. And everyone kind of treats everything like a software startup, where they expect very low cost of acquisition and that you can scale super fast. And that if you just pump enough money in, then you'll take over the market, and then you'll have a monopoly, and then you can like exit to someone. But that only works with specific models and specific business models and financial and operational models. And so when you pigeonhole the financing of these projects, you also pigeonhole like the actual things that can be built. And so this is also John from Cabin DAO, and he has a bunch of great tweets I recommend following. And this kind of like leads to the theory of the greater fool, where everyone knows what everyone else's investment strategy is, and they just try to get in early and then try to exit from these later groups in their financing rounds. So Aptos, for example, I don't know, has anyone ever used Aptos before? No one? No? Okay, well, it's $1 billion project, yeah? And no one's using it. So like, why is it worth $1 billion? And that's generally because the VCs know that if they get in early, then eventually someone else, and if they like meme it enough and they make it popular enough, they can exit to someone, whether that's other VCs or to retail liquidity on centralized exchanges or what have you. And this isn't just a Web3 problem, it's also a Web2 problem with WeWork. No one knows why WeWork was worth whatever, $40–50 billion. But SoftBank is the one that kind of like took the hit on that because all the other investors kind of got to exit through the SoftBank's Vision Fund investing in them. And so these are just some examples of the perverse incentives that only having VC funding creates within the crypto ecosystem and generally startups. So now looking at grants programs, in contrast to VCs, we're going to skip Ponzi's because they're just obviously bad. But grants, like the pros is that it's free money. You can just get the money. You can build whatever you want to. Sometimes people don't build it. That's one of the cons is that there's no real accountability with grants programs, except that maybe you won't get grants in the future, but at that point you've already gotten the money, so what's the point? And then usually it really aligns the community with the values that they're trying to create. So with VCs where it's all driven by profit, with grants programs, they're very often funding things that both VCs wouldn't fund, but also that the community just inherently wants, regardless of whether or not they think it's going to make them money in the future. So let's take like Rave by Aave, where they're funding these events that they just enjoy, and yeah, community tooling, all that kind of thing. And also this goes to public goods funding, where a lot of projects just want things to exist within the ecosystem, and they don't care whether or not they make a profit off of this specific thing, because they know it's going to benefit the whole and grow the whole pie, which VCs also generally aren't trying to do. If they are investing in public goods, it's usually in some way where they're trying to capture a market and doing a fast follow fork or something where they're essentially it's like a public goods, but they're really doing it so that they can capture a market and then still earn fees in some way and not give it away totally for free. And the other pro of grants is that it expands your ecosystem where now you have more people building on top of it, and they're more collaborative because you've given them the free money, and then they're also probably part of the community, and so you're growing the total base of your community and who's providing value, versus generally with VCs, you become this competitive standpoint where you see people that are your competitors and you want to beat them, but with grants it's more collaborative. And the main con with grants is that they're very bureaucratic from both the funders and the grantee side, where you have to put in a ton of time to actually apply for grants and do the politicking to get it approved, figure out what they actually want, like the impact metrics that they're looking for to get from the grant. Is it developers or is it users or whatever? And then it's also very bureaucratic from the grantor side, where they have to go through all these applications now, and they have to spend a ton of time and a ton of resources just to give away free money again, because it's free money and they know that there's no incentive alignment, so they have to do a really good job of curating who they actually give the money to make sure that it's valuable. But that's also kind of a failure in coordination, because there is no inherent coordination within the grants model itself. And so, yeah, just the meme, like saving the world is always Sisyphean, where it's always more and more work to do good things. So even though you're doing grants and it seems like it's a great thing for everyone, where you're giving away money to community and they're just going to build cool stuff for you, it does add in a ton of work where now you have to figure out who are actually good actors in your community and what exact value are they providing, and are people outside of your community going to provide more value, and is there a good or bad thing with giving funding to outside community members if they're not, if they're going to provide more value versus your actual community members. And it just adds in a lot of work with the grants process, where you have to go through this whole thing of evaluation. And a great example of this is DAO, where it was intended to be a coordination mechanism itself to fund public goods, but the main issue was that they collected all this money, and like millions of dollars, and then there was no incentive to actually give it away. No one wanted to put in the work to sit there and evaluate all these proposals, and how much money should they get, and who's actually building them, and are these proposals aligned with the actual goal of DAO? And so what you actually ended up with was ironically a coordination failure, where no one actually wanted to give away all the money that they had collected. Of course, they did give away some things like just Tornado Cash, but a lot of the money is still just sitting there. And so this is kind of an example of the failures of the grants model, where it does seem like it's perfect in every way, but there's kind of these hidden problems. And so then that's where revenue-based debt financing comes in, where we're kind of trying to figure out this Goldilocks approach, where it's not completely about profitability, not completely about community or technology, but somewhere in the middle, where it might not be perfect for every use case, but at least it's providing a new option in the ecosystem. And so the benefits of revenue-based financing are that it's anonymous and founder-friendly. So basically how it works is because you have this provable revenue stream that's on-chain through smart contracts, you no longer have to trust the individual. You can just look at on-chain data, and then because it's going through a smart contract, you know that that's going to be programmed to a specific thing. So once you've staked that smart contract and you're controlling that revenue stream, you don't really care who the person is, so long as that revenue stream keeps going, which at that point is generally out of their hands, assuming their product still keeps working. For lenders, it's also great because it's non-degen borrowing. The main thing for money markets at the moment, like Aave and Compound, is that it's either people that are getting leverage on their existing assets and trying to get more and more leverage, essentially, to buy more volatile tokens and then recollateralizing those to buy more, or they're using them as they actually want to be liquidated because it's more capital efficient to get liquidated through this thing versus actually selling the tokens firsthand. And so revenue-based financing has these non-degenerate borrowing use cases where you're using them to like finance your business, pay contributors, pay for security audits, improve your product, things like that. And then with revenue-based financing, because the lenders only get paid when you make money and you're earning revenue from fees and whatnot, that now creates this symbiotic relationship where the lenders want to benefit your business, whether that's giving you product feedback, giving you clients, giving you just general support and help, because they only get repaid when you earn fees. There's no kind of like liquidation process based on assets, or there's nothing to really collateralize except unless they improve. So it creates this really nice incentive mechanism where the lenders are working in your benefit, even after they've already lent you the money. And then lending gives you uncorrelated returns to the crypto market. So instead of being exposed to volatile asset prices, you can still stay within the crypto ecosystem, but then earn a real yield from these lending operations, which are two generally better DAOs that have sustainable operations and profit models. And you don't have to be exposed to the token price while still benefiting from their success. And then it also just gives you operational liquidity versus VCs and grants where it's very ad hoc and you don't necessarily know how much money you're going to get or when. With a line of credit and revenue-based financing, you know that you can sustainably and reliably get the money that you need to do your day-to-day operations. And then the cons of revenue-based financing are mainly that you need to already be successful to some extent. You need to have product market fit. So where grants and VCs are very useful is that you don't necessarily need to have success yet in order to get their money. And then that's good because you can then prove your success and do higher rounds or get more money later on. But then they have all the issues that we just discussed. And with revenue-based financing, you get all these benefits. But the other side is that you need to already have some success metrics that you can show to people. Versus grants is that you also have a debt obligation now that you have to repay. Same with like the kind of the VC obligation, except I feel like it's less personal. Like when you have debt, it just feels like you have to pay the thing. Versus VCs, it feels like you have this personal obligation because you're the founder. And then revenue-based financing takes a lot more accounting work because you have to prove your finances and that you are profitable and that you're a business that should be lent to. And then it also takes more work from the actual financial reporting of accounting for that debt and the interest that you're paying and all those things to your existing investors. And then you still have to do the whole fundraising process of figuring out who's going to lend you money and go through that whole thing. So examples of some revenue-based financing that we've done so far. So we've partnered with Metacartel to help them finance their events organization that they're running. So MCon, that's in Denver, Metacamp, that's in Costa Rica, MetaFest, that was just last month in Croatia. They were all financed through a line of credit that they used on DebtDAO, and they repaid their loans from the ticket sales and sponsorship sales that they had. And so this is really great for event organizers because a lot of times the personal event organizers are putting up their credit cards or their own obligations because they don't have the money up front from sponsors. And so the line of credit is very useful because it allows them to have the financing that they need to put down money on the venue or pay for vendors and things like that up front and kind of secure their event. And then they can more easily go to sponsors and speakers and kind of organize the rest of it. And so we found a very good model with community-backed credit and letting DAO's members lend to the DAO itself, and then they also get these kind of like mutual beneficial rewards where because I've lent to the DAO, I'm now this kind of more premium member because I'm also like have some risk in the game of the success of the DAO, and I can get special perks because of that, or just show that I'm like this extra supporter versus other people. And then we're looking at how lending and revenue-based financing can fit into the grant stack with Gitcoin and funding the commons and all these other public goods organizations. So kind of right now, the problem with Gitcoin is that you can get grants money, but eventually they cut you off after a certain amount. And then that means that the only way that you can get financing is then just going to VCs, which has this very perverse incentive where the community is putting in all the work and taking all the risk to make your product usable and actually testing it, and also giving you the grant money to sustain yourself. But then you just turn around and you go to VCs, and VCs get all the upside because there's no way for the community to do that. And so doing this whole changing like the model from grants to lending, and then the funders can then re-grant based off of the interest that they earn from loans, and then the founders can also then just exit to community because they don't have any equity obligations, and so they can actually give away the public goods or whatever that they're making back to the community after it's been built. And so this is all to say that revenue-based financing is regenerative financing, both from like a human perspective of the relationships that it creates, and then also from the financial model and how it fits into the DeFi stack and how we fund protocols. It's really looking at how can we create more sustainable relationships and financing models and business models and everything like that, where we're doing more slow growth and long growth and not just doing like 0 to 100 and trying to like exit as soon as we can. And this is generally just how we're looking at the solutions that we're creating. We want to do DeFi primitives, so we've invented the Spigot contract that I'll get into, where we're focused on ungovernance and revenue as a first-class citizen. So we're not looking at assets at all. We're looking at purely at who is paying you fees from a user perspective, and not taking out loans against some volatile crypto, and making everything as trustless and automated as possible and anti-fragile. I'll skip ahead because I'm a little bit out of time. So this is the Spigot contract that we use. It's a paraphrase of it. But basically, this allows us to actually do the revenue-based financing on-chain fully trustlessly. And we do that by allowing you to stake a smart contract to the Spigot, which then controls the whole cash flow for you. And so you can set a split between how much you get and how much your lender gets. And then either of you can claim the revenue, and that automatically goes to repaying your debt. And this is what makes it trustless, is because it's all smart contract based. And we know that the fees are flowing from your smart contract, so we don't need to trust you as an individual to repay your loan. We know that the smart contract will do it for us. And then this is just kind of like a systems overview of how all of our contracts work together. So you have your smart contracts, you stake them into our Spigot, and then the Spigot repays our line of credit, which the lender and the borrower are interacting between. Cool. Question time? Q&A? Yeah.
Thank you so much, Kiba. Who has questions after his talk?
Hi, thank you for your presentation. So I have a couple of questions. The first one is about, I've seen that you brought some use cases of native Web3 companies that get a line of credit by you, and are you planning to implement any sort of onboarding some companies which are not Web3 native, or that might not have part of all of the revenues on the chain, so that basically you won't be able to see them? And the second question is about regulatory. So what are you planning? Because for a regulator, this can be seen like a bank, right?
Yeah.
Thanks.
So with the first question, like off-chain entities, we have been talking to some off-chain entities because they actually find it useful that we're doing this everything on-chain. So we've talked to some kind of like taxi companies in Pakistan, to some diamond sellers in New York, like a lot of people that are unbanked essentially, that still find value in this model because they don't have access to normal financial services essentially. And it's important to note that our line of credit contract is modular, so you can do fully unsecured loans if you wanted to, or you can do revenue-based, or you could also do asset-based, theoretically. So it's very mix and match, and you can define the terms that you want to borrow or lend against. And then in terms of regulatory stuff, so we are not actually doing the lending at DebtDAO, we just build the infrastructure, and we have a credit marketplace, so anyone can propose lending terms to you. So you define what you want, like I want to borrow for 60 days or 90 days or whatever, and then other people will offer you the amount and the interest rates that they're willing to give you.
Okay, so you're like offering a peer-to-peer marketplace rather than the actual financing.
Yeah,
okay.
We're just the infrastructure, we're not the bank, yeah.
Cool, thanks.
All right, we still have a time for 1 or 2 short questions.
Yeah, so thanks for the talk. Quick question, because you mentioned a little bit, right? The project has to be somewhat late in the stage to be able to do it, right? Should have some revenue, etc. What kind of levels are you looking for in terms of revenue and its relationship to the loan size? Are there like any metrics that you defined?
Yeah. So again, we're a marketplace, so we don't necessarily define those. It's up to the lenders if they're comfortable. The main thing would just be history and consistency. So if you just have 1 month of whatever, $1 million of revenue, but you didn't make any money before that, and we don't know if you're going to make that amount again afterwards, that's obviously a consideration. Versus if you have like a very small amount of revenue, but it's consistent over many months, that obviously changes the equation. And then because people can offer you terms, multiple lenders can offer you different amounts at different interest rates. So someone might say that you want to borrow for like 90 days, let's say, and someone would say, okay, I'll lend you $100,000, but it's going to be 20% interest. And then someone else might say, I'll only lend you $10,000, let's say, but it'll be at 5% interest. And then you as the borrower get to decide which one you want to take. So it could be a larger amount with higher interest or a lower amount with lower interest.
Got it. So it's still up to the lender basically to decide, right? Because I can come onto the platform saying, okay, I earn like $1 every month.
Yeah.
And then maybe there is someone who is willing to give me $1 million, right?
Yeah.
Okay.
Thanks so much. This is all the time we had questions in this session, so thank you, Kiba, once more. Yep. And then our next speaker is Max Sherwood from Ultimate. And the question he'll be asking, and I suppose answering as well, is can order flow auctions monetize wallets fairly? So give it up for Max.
Got water. Cheers. Yeah, I'll just put this.
The green button goes forward, this goes back.
Okay. Cool. All right. Hey, everybody. Can't quite see familiar faces here, but maybe some of you were at our meetup last night. Yeah, Dappcon 2023. It's good to be back. It's crazy how fast a year goes. So yeah, this is a talk that's kind of meant to just get the conversation started around wallets and monetization. You know, probably most of us still use MetaMask. I work at Ultimate, which is a mobile wallet. And yeah, the question is really, like the title says, you know, can we make a wallet zero fee and still monetize it fairly without centralizing Ethereum? So yeah, a bit about me. I'm Max Sherwood. I guess in 3 words, I would describe myself as an enthusiast, an analyst, and a validator as well. So I'm research and growth at Ultimate, and I also co-founded a validator company last year called H2O Nodes. So let's get straight into it. Where are we today in terms of like DEX versus SEX trading? So DEX trading makes up about 15% of the crypto trading volume. The other 85% obviously being centralized exchanges. Obviously these are rookie numbers, right? We want to pump those numbers up. Ideally, we would flip the amount of volume that decentralized exchanges are doing and have there be more than even the centralized exchanges are doing. But maybe you say, okay, well, I don't really, trade in DeFi. I don't really, trade shitcoins. I don't really care. Well, I have news for you. If you're staking your ETH, you should care because thanks to MEV Boost and the new paradigm that we live in now, where validators are collecting MEV, anytime there's a big spike in DEX trading or just DeFi activity generally, we see a big spike in the staking APY. And here's a couple examples of that. And yeah, sure, it might only last a day or two, but I think you get the idea here. We should all want more DEX activity as holders and stakers of ETH. So how do we get more DEX activity, more users, more volume onto DEXs off of centralized exchanges? Probably not with antiquated UIs. No hate to Curve, of course, but I think they almost did this tongue-in-cheek because it looks pretty terrible. So at Ultimate, we're fully convinced that we need to move on to mobile. This is already where TradFi has gone. Most of us probably do a lot of our online banking on mobile, and there's no reason why we should all still be on our PCs on web extensions. I saw people in line to collect merch a couple days ago with their laptops, having their wallets open. So we're still a little behind, perhaps, in crypto. So when I started Ultimate, I thought, okay, well, a wallet is, just taking data from the blockchain. It's just interacting with the blockchain. It shouldn't be too hard to build a wallet, right? Yes and no. Building a great wallet takes a great team and some APIs, which are not cheap. So, if you load into a new wallet and let's say you import a seed phrase and you instantly see, portfolio chart over the last 3 months, like that's a lot of data, right? You're taking a lot of token balances, historical balances, even looking at your transactions, you need to parse through transactions. So there's a lot of stuff going on in the back end, I guess is what I'm saying. And that needs to be built by some very skilled engineers who typically like to be paid quite a nice salary. And the APIs as well need to be fast and reliable, and those are not cheap either. So building a great wallet does cost money, and it begs the question, how should a wallet monetize, right? Because nothing is for free. So let's talk about MetaMask. Of course, many of you know, but actually let's see a raise of hands, like who has actually used the built-in swap function inside of MetaMask before? Okay, 1, 3, 5, some people, okay. A lot of people don't even know this exists, especially the more advanced people amongst us, but they do have a built-in swap function. They aggregate liquidity from multiple sources and try to give you the best price. And what do they do then? They slap a 0.875% fee onto your order, which is probably going to ruin your price. And yet, they've made somewhere between $200 and $400 million. So that's like the top right is the total revenue. I've seen estimates higher than that as well. And the figure, the $58 million, is the amount of volume they did last week when I put these slides together. So definitely a lot of volume going through MetaMask, and they've made a lot of money. You can see in the last bull market, many weeks they were doing over $2 million in revenue per week. So pretty impressive. But from a user's point of view, are we really going to trade on wallets that use 0.875% as the fee? Probably not. If anything, that's a reason not to use a wallet, right? Because we can go directly to a DEX front end, we can connect directly with a DEX, and we don't have to pay an extra fee. So I would say that added fees are a reason not to use a wallet. And if we want to increase adoption and users and DEX trading volume, we actually need to remove hurdles from DeFi trading, right? If we think about what Robinhood did in the US with TradFi brokerage, they removed all the fees. They made it possible on your phone, super easy. So they kind of removed all the hurdles. So the question was not, why should I trade on Robinhood? The question became, why shouldn't I trade on Robinhood? And I think we need to do the same thing here. So Ultimate right now has no fees on swaps. That begs the question, how can you monetize with 0 fees? So there's a few kind of ideas out there, subscriptions, so a monthly subscription. Coinbase does this with their centralized exchange. I don't remember if it's like 20 or 30 bucks a month, but they basically cancel out all your trading fees if you subscribe to this service. You could also do tipping, where users could add a tip to their transaction, which has worked for some companies in the past. I'm not really a fan of either of those, to be honest. But the last 2 points on here is kind of where we're going to go, and is also more interesting for the Ethereum community, is talking about payment for order flow or MEV rebates. So this is a picture I took last year downstairs. That's Stefan from Flashbots, or at least he was from Flashbots back then. Now he's doing frontier research. And this is the MEV supply chain, right? Crazy how fast stuff changes in a year. This felt new back then. We were mostly talking about proposer-builder separation, of course, which is kind of the latter half of the MEV supply chain. But today I'm interested in talking about the front half, which is users and wallets. So let's talk about order flow auctions, which sit kind of in the middle here. So order flow auctions, there's a few types out there. So for example, an RFQ, a request for quote, you might see this in like 0x API, where there's market makers who are giving you quotes or giving the user quotes, and the lowest one will obviously win. So this is for like price discovery on swaps. There's also exclusive batch auctions, which is more like CowSwap, for example, which you'll be familiar with. And that's more for swap execution. So that sits in the middle of this MEV supply chain, and there's bidders obviously trying to fill this bid. So Stefan wrote a piece in March, I think, of this year called the Order Flow Auction Design Space. And if you'll excuse me for reading off the slide, Stefan wrote, "Order flow auctions promise to return users the value they create via their orders. We believe this year will be the year of order flow auctions, and we expect significant competition happening between order flow auction designs and their implementations in the next 6 months." So that's all fine and well, but actually it's still quite early for order flow auctions and also payment for order flow. I'm going to make the case that in-wallet swaps still play a very minor role in DEX order flow, because most DEX volume is still coming from DEX front ends and APIs directly, not from wallets integrated swap features. And as such, we haven't really seen the effects of payment for order flow. So let's go back to MetaMask. I said they did around about 50 million in volume last week. So almost half of it came from Uniswap, and almost half of it came from 0x API. I'm talking about the liquidity, of course. So if you consider the fact that the entire DEX space does about $10 billion per week in DEX volume, you'll see that about 0.5% of the DEX volume today is coming from MetaMask swap functions. So even though $50 million a week is quite a lot, it's just scraping the surface of total DEX volume. So this is really just me saying that MetaMask hasn't completely taken over the DEX trading landscape with their swap function. And by the way, it's still early days for aggregators too. So only about 20% of DEX volume comes through aggregators. And it doesn't seem to be trending up at all. So yeah, this is a 2-year chart, so it really hasn't changed in 2 years. I was quite surprised when I saw this. And by the way, from 0x, the aggregator, only about 5% of their volume comes from RFQ. So RFQ is also not widely used today. So it's still early days. Yeah, basically my point is just that people are still connecting directly with DEXs on the front ends, on the APIs, and trading directly. They're not really doing it through aggregators. They're not really doing it through wallets, at least not yet. So it's still early days. But let's think about the future, right? Because that's what we do here is we think about opportunities and challenges for the future. So let's imagine there is a wallet that's completely dominating the DEX trading landscape and creating a ton of order flow through a built-in swap function. Would that create centralization for Ethereum if they're engaging in payment for order flow? I think we can all agree that for a wallet to succeed, it should profit with its users and not from its users. That seems pretty straightforward. But Quintus from Flashbots wrote 2 pieces in September of last year about order flow auctions and centralization. The first one was called A Warning, so clearly he's got something on his mind. So it's useful to think about these things in terms of utopia and dystopia, right, which is something we do quite a lot in the MEV space. I think we all know that decentralization is good for Ethereum, right? Especially on the block building side, we want open, diverse, competitive market for block builders. And centralization is bad for Ethereum, so we don't want a domination of large block builders due to exclusive order flow. So what would this look like? By the way, this chart, here's a picture I took of Stefan last year down in the boat stage, which is sadly not available this year, but it's good to be up here. So yeah, this chart that he presented last year, if we start at the top, if a block builder is getting exclusive private order flow from, let's say, a wallet, they're going to be able to build higher value blocks because they have more transactions to pick and choose from. They're going to consistently win block building competitions because their blocks are higher value, which is in turn going to justify the exclusivity agreements that they have with the wallets because they can say, hey, look, we're building most of the blocks. Our blocks are the highest value. So this is kind of how a dystopia flywheel could start. So yeah, sorry to pick on MetaMask and consensus, but nothing against MetaMask or consensus. But let's just imagine for a second that MetaMask and consensus did like vertically integrate, or in this example, horizontally integrate across the MEV supply chain. So starting from the left with the wallet, obviously MetaMask plugs into Infura RPC. But let's imagine that consensus wanted to launch a block builder, right? They do have a validator infrastructure product currently. Let's say they also had a validator, a block proposer. So really, as a user, if you were plugged into this stack, you'd be using MetaMask, and your orders would be being batched together into blocks built by consensus and proposed by consensus. So it kind of begs the question: is this even DeFi anymore? Right? Is this even DEX trading when pretty much every step of the process is being administrated by the same party, right? So. Again, nothing against MetaMask, but this is just to kind of get your brain going. So what's going to happen next? Auction models are going to be tested. Wallets are going to launch and compete for market share. We've already seen tons of wallets launching. So 1inch and Uniswap, interestingly, announced wallets, I think, this year, fairly recently. So 1inch is obviously an aggregator. Uniswap's obviously a DEX. How do we feel about that? I don't know. It's up to you to say. it kind of begs the question, who will win the wallet wars and who should win the wallet wars? So, there's kind of two strategies here, right? If a wallet captures more value, it can, spend more on marketing and a bigger team. So maybe this is like what MetaMask currently does with their high fee. But if wallets return more value to their users, either by cutting fees or giving them MEV rebates, they might get more users and more volume organically. So that might be interesting as well. But who should win the wallet wars? Should it be DEXs, aggregators? Should it be block builders if they're going to launch wallets themselves? What are the conflicts of interest here in terms of centralization? Am I making a big deal out of nothing, or is this something we should have our eye on? Definitely curious to hear your thoughts and your questions and your comments. So yeah, in summary, the entire ETH ecosystem benefits from increased DEX trading and increased DEX market share. DeFi needs fair markets and infrastructure. Unsophisticated traders need access to liquidity and protection from adversarial MEV. Wallets need a fair way to monetize their order flow. It costs money to build and develop a great wallet, and high fees on swaps are unacceptable, at least in my view. Order flow auctions should protect against builder centralization. So let's see what the future brings. I kind of sped through that here, so we've still got some time, but thank you for your attention, and looking forward to your questions.
So much, Max. The floor is open for questions.
From your talk, it just gets me thinking, why doesn't MetaMask just take all the funds it's making, make its own nodes, and then try to just corner the block producing space, and then just say, hey, if you're using MetaMask, we won't front run you, but every transaction that doesn't come from MetaMask, we're going to just basically put some graphics card up and make sure we squeeze out every single little last piece of miner extracted value and give it back to our team.
Yeah, right. I mean, they could. That's pretty much what I'm talking about. I don't think they're going to do that, but if we do get to a place where there's a wallet that has huge success and is just generating a huge amount of order flow, in an extreme case, if we imagine like more than half of all DEX trading coming through a single wallet, there's tons of stuff that wallet could do, right? And I think creating a block builder would probably be the first thing if they wanted to vertically integrate, but I'm not a huge expert there, so.
Okay, thanks.
Any other questions from Max?
If we look at TradFi and how payment for order flow is being treated in Europe and in the US with major concerns by regulators and policymakers over misdoing by, let's say, large financial institutions, how do you see, let's say, if crypto is now excited about payment for order flow today, aren't we running into the same problems tomorrow from a regulatory perspective?
Yeah, so here in Europe, as far as I'm aware, I think payment for order flow is quickly becoming illegal or is already illegal. If we're going to engage in this in the future, either we have to make the argument to regulators that it's not the same as TradFi payment for order flow, because we do have a kind of a more sophisticated supply chain that we're talking about here. So, not everything. Not every payment for order flow-esque mechanism that wallets could use might fall under the same regulation, but here in Europe, yeah, it's definitely quickly becoming very unpopular.
Yeah, thanks for the talk. That was really excellent and very astutely presented. There's a lot of interesting work done at the moment on mempool encryption and attempts to blind transactions in general, just to really counter MEV, right, as I'm sure you're aware. Can you comment a little bit on how that would affect order flow auctions?
Sorry, what were the first two words?
How the mempool encryption, better mempool encryption would affect order flow auctions, and how general work against MEV extraction would affect order flow auctions in the value chain.
You're talking about privacy transactions? Yeah. I mean, I don't count myself as a huge expert on the technical side, but my understanding is the challenge is you don't want to, I mean, you need to make your intent known, obviously, because you want to trade and someone needs to fill the other side of that trade. But the moment you kind of publish the fact that you're going to the marketplace with the trade, you open yourself to potential front running, right? So I'm sure private transactions and encryptions, like you said, have a role to play here. The question is like, how do you stay private enough to protect yourself from front running, but not so private that you don't find anyone to trade with, right? So, but I'm not an expert.
Any other questions for this talk? In that case, thank you, Max.
Thanks, everybody.
Give it up for him. We have a little bit of time before the next talk. So the next talk will start at 2:45. That is in 6 minutes. So don't go very far if you want to catch it. All right, everyone. We're starting the session very shortly, so please settle down. If you would like to have conversations, go and have them in the break rooms or outside the room, because we're starting the last talk of the session in half a minute. Excellent. So, finishing up this session is Olga Fetisova from Coop Protocol as well. The title of her talk is MEV Transparency, Ensuring Fairness in DeFi Markets.
Hi, everyone. Thank you for joining. As was mentioned, my name is Olga Fetisova, and today we're going to be talking about MEV metrics and how to actually ensure fairness in DeFi market. So the first part of the talk, I'll be focusing mainly on what MEV is, what it means for us, what it means for the community. We'll cover some metrics, we'll go through some stats. And the second part of the talk will be focusing mainly on the transparency initiatives, challenges, and solutions. So what is MEV? Can you please raise your hands who actually know what MEV means for us and for the community? Great, I see quite a lot of hands. How many of you actually know whether you've been MEV attacked before or not? Wow, quite less hands, I guess. So let's get into that then and figure out. So while blockchain network ensures all transactions are valid and new blocks are appearing, preventing the downtime, it is actually not a guarantee that all transactions will be ordered in the exact same manner they appear to the blockchain. While block producers have a full autonomy of selecting the transactions, whatever transactions they want to include in a block, because each block has a limited number of transactions, usually they order transactions by the highest gas price, as we see here, and which means they have a full autonomy of censoring and reordering transactions, extracting what is so-called known maximal extractable value. So in other words, MEV is the profit that can be extracted by miners or other actors of the blockchain network who can insert, remove, or reorder transactions, making it more profitable for themselves. According to Flashbots, the organization that focuses on MEV research, nearly $500 million has been extracted just this year from MEV opportunities, just since the merge. So can you imagine what number? And this number, this value actually accounts for the number that's been paid to validators only, to the Ethereum validators, which means the attackers actually earned way more than that, and we'll get in a few slides why. So to put this in a perspective, it creates a very big opportunity, right? On certain days, Ethereum validators earn way more ETH while extracting MEV opportunities than from executing the transactions than from the transactional fees. While some MEV activities are legitimate, making sure that the transactions are indeed ordered in the best possible way, it also creates an unfair advantage and manipulative practices. So today I'm going to be focusing on the most commonly occurred damaging types of MEV, and I will cover these three types. Specifically, I'll talk about front-running. Front-running is when a bot spots an opportunity, sees a transaction in a public mempool, and then duplicates this transaction and places this transaction within the same bundle in front of the victim's transaction, benefiting from the opportunity. Back-running is very similar, but it's the other way around. So basically, the attacker places the transaction right at the end of the user's transaction, right at the end of the victim's transaction. While front-running and back-running is not that common by itself, a combination of those two is a very common attack, which is called a sandwich attack. So a sandwich attack is basically placing both a buy order and a sell order in between of the victim's attack, creating so-called sandwich attack with the victim. So let's look a little bit closer in the sandwich attacks, since it's the most one that you can find in many blocks. So how does sandwich attack occurs? First of all, a user places a transaction. So imagine a high transaction is placed in a public mempool. A bot user, very important, indicates a slippage. So that's basically a tolerance a user's tolerance toward the price change. So the user says, OK, I'm allowing the price of the token to change to this certain amount. A bot knows that. So what does the bot do? A bot front-runs this user by placing the transaction right in front of the victim's transaction, which causes the price of the token to go up, which means, consuming the maximum slippage of the user, which means once the user's transaction is executed, it is executed already at a way higher price, which means the user loses, right? What does the bot do at this stage? The bot places a sell transaction right at the end of this sandwich at a very, very high price of the token and sells the token, which causes the token price to go down, which again means that the user loses. So the bot benefits in the meantime by getting the difference between buy and sell order, and the user's transaction is executed at below the market price, and the user gets way less tokens that they could have actually gotten before, right? That's not fair. So now this is just an example, but let's look how we can actually spot these transactions, the sandwich attacks within the block. It is quite simple to find out if we start analyzing the block. If we see, for example, in a block, the same token traded multiple times, the price difference would be most likely the gains earned, and this would indicate the sandwich attack. So here we can see an analysis from ZeroMev, another organization who is focusing on MAV research. Here we can see already an analyzed graph, but as I mentioned, we'll see here that the DAI, for example, is traded multiple times in a block, which means that that was a sandwich attack. And indeed, it's already marked there that this is a sandwich attack. So again, let's look at the same block. This is a randomly chosen block by me. And we can see here immediately on top of the analysis that the attack, well, specifically 3 sandwich attacks, has cost nearly $40 in user losses, while the last transaction in a block is actually a payment to the miner, which means that the miner got 0.41 ETH, which again indicates that the attacker has earned even more. Why? Because the attacker obviously needs to pay some bribe to the miner, and they need to make sure that this transaction is profitable for them. To put this into perspective, the average payout per block hovers around $100, which is a modest 0.06 ETH, but obviously depending on the price. But on certain days, when the market is volatile and there are a lot of trading activity, this value can reach crazy numbers. So let's look at a slightly different block. This block I chose within the time frame when FTX was crashing. And here we can see, well, slightly or completely different numbers, right? So here we can see immediately from ZeroMev stats that from this specific block, the bot has caused over $6,000 of losses to the user, exploring the MAV opportunity. And the payment to the miner was 3.6 ETH, which means that the gains from this attack were even higher than that. According to The Block magazine, one of the famous MAV bots have earned within that time frame millions in proceeds. The report states that the bot actually earned $34 million via MAV opportunities in just 3 months. Can you imagine? Crazy numbers. No wonder why this is a very, very attractive opportunity for bots. According again to Flashbot's dashboard, the transparency dashboard that is publicly available, we can see that these opportunities come from various DEXs. And here, from this pie chart, we can see that most of the DEXs don't actually protect you from these MAV attacks. Here you would see that most of the attacks come in actually from Uniswap V2 and V3. That doesn't necessarily mean that if you're trading on Uniswap, that's it, you should not. That means that Uniswap actually has the most of the liquidity available there, and even if you trade through different DEX aggregators, most likely your transaction would be rerouted through Uniswap or one of the other DEXs. Remember in the beginning I asked how many of you actually know whether you've been MAV attacked or not before? It's quite simple to check it out. One of the easiest way to go to zeromev.org, you can all go and check it out. Place your either wallet address, your transaction hash, any block you want to analyze, and the tool will actually tell you whether you've been attacked before or not. Quite simple, right? So I'll actually will invite you to check it out afterwards. So as you know, there are a lot of opportunities being extracted. And as well as a lot of research being done to prevent these opportunities. Right now, we have a lot of organizations, and some of them I already mentioned in this talk, that focus and specialize in MEV research. Among those organizations, we have Flashbots that I've mentioned a few times in this talk. We have AgenFi, we have ZeroMap that I also mentioned in the talk. And all of them dedicate a lot of resources to actually understand and evaluate the situation. But that doesn't really protect us, right? So today I'm going to mention 2 ways that you can already protect yourself. One of the ways would be using an additional RPC endpoint. For those who doesn't know, RPC endpoint is the way with a blockchain application to communicate with the blockchain. It is a request-response-based model that sends, where an application sends a request to the blockchain and it receives a response with the requested data. It is insanely simple to adjust it in your favorite wallet, such as MetaMask wallet, with just a couple of clicks. Among those RPC endpoints, we have a few famous ones, MEV Blocker, MEV Background Me, and some other ones. They're quite simple, but obviously some of them have more advantages than others. And let's look a little bit closer on MEV Blocker. Why MEV Blocker is special? So first of all, as I mentioned, it is very simple to adjust it in your wallet, your favorite wallet, such as MetaMask wallet, with just a couple of clicks. And what it's going to protect you from, first of all, it sends all the transactions. Instead of the public mempool, it sends it to MEV, private pool. So that means your transaction is actually never exposed publicly, right? So that means that the searcher does not really know about your transaction. Additionally, it adds fake transactions to confuse the searchers on the truthfulness so that they cannot try to probabilistically attack you. And as an additional thing, it offers you a rebate on your trade. So while it protects you from front running, it allows still back running. While it allows back running, it guarantees that at least 90% or more of the value will be forwarded back to you. Great, right? So MEV Blocker is relatively new, but it's gaining its popularity. And today, it's already protected over $16 billion in volume, while saving 370 ETH. That's quite a simple way of protection, but as you can see, numbers are great. For you, I added here a QR code in case you want to scan it and add it immediately to your wallet. Again, it's just a couple of clicks, and you're going to benefit from that. So as I mentioned, this is one of the ways to protect yourself. Another way to protect yourself would be to use a dedicated dApp that already protects you from MEV opportunities. And one of these dApps that I'm going to be talking today is the CowSwap. How does CowSwap protect you from MEV? So CowSwap is a MetaDex aggregator that combines the best price, so it matches your order with the best liquidity provider on chain. And on top of that, it protects you from MEV opportunities. While it's already using MEV Blocker, it also focuses on 3 main principles or features. One of them is the delegated trade execution, which means that your transaction is executed by so-called solvers, who are the ones that are responsible for your transaction. So at no time you are actually out there in the public mempool, so you're never going to be affected. The second feature is the coincidence of fonts. That's where cow comes from, C-O-W, which means some of the orders are actually matched off-chain. Great, right? And then additionally, on top of that, it provides the uniform clearing prices. So that means that the price of the token within the batch is going to be the same. So these 2 methods that I mentioned, RPC endpoint and CowSwap, are just the ways that we can currently protect ourselves from MEV attacks. However, that doesn't really eliminate the problem, right? The problem still exists, and the bots keep finding new and new ways to attack us and to steal our precious ETH or precious money. There are a lot of challenges. One of the challenges, in my opinion, well, from the data perspective, is the data availability. Obviously, not all of the data is public. Thus, for example, centralized exchanges do not actually share their data. So it is quite hard to get a full comprehensive picture on the scale of this problem. Thus, make a good solution and propose a good solution and solve it. While there are a lot of organizations that focus on MEV research and actually try to figure out how to solve it within the community, there are some solutions available that we can talk after the talk and discuss that. However, this is also a call to the community. MEV's challenge possesses a significant challenge, but it also creates an opportunity. An opportunity for the whole community to come together, innovate, and ensure that Ethereum remains the gold standard in the blockchain network. Thank you.
Thank you so much, Olga. Who has questions? Let's start there.
Hey, thanks for sharing. Great talk. Just a quick question. What's the business model of the MEV blocker? Do you like background the transactions yourself and then you share part with the user and then keep part as like a revenue, or?
Well, right now there are a few models that are being discussed, but right now there is nothing, no gains, pretty much. So that's why it's a great opportunity for everyone to use. The same is actually with CowSwap. There are no profits made, so that's a good opportunity for everyone to use it and explore it while it's free.
Perfect. I love public goods. And then the last probably question. So it's on ETH, obviously on Ethereum, right? But any other chains that you're covering, or maybe from the MEV perspective, any other chains where you see it as a big problem as well?
Well, I'm covering, or you mean the okay.
The MEV blocker.
Yeah, so right now we're focusing, the CowSwap is focusing on Ethereum and Gnosis, but we're also discovering that we need to integrate with other chains, and we're working on that.
Thanks.
Thank you. We had a question over here.
Yeah, thank you for the information. I had one question regarding FHE, these schemas about full homomorphic encryption. And given that that goes against the MEV, everything being public on that mempool, how do you see all these MEV-based attacks and even the Flashbot community when smart contracts actually start using this FHE schema for being able to compute data without actually decrypting the data first? So how do you see MEV going completely away, or just the good MEV being kept, as you can select, of course, which parts of the transactions will be encrypted in the mempool? So yeah, how do you see all that?
Yeah, thank you for your question. I think a previous question was asked also in the talk before that. And indeed, this is still unknown how it's going to be treated, but I don't think, in my opinion, MEV disappears. Well, first of all, while the transaction is going to be encrypted, there's somebody should be able to validate the transaction, right? But even if they don't know the transaction itself and they get the key after they approve the transaction, it still does not eliminate all of the MEV types, right? So for example, backrunning is still an option in this case.
Okay, thank you.
Yeah, thank you very much for the talk. I was curious how CowSwap's approach compares to Uniswap X and 1inch Fusion in terms of MEV protection.
Thanks. So indeed, there are obviously some competitors available right now as of a few months. However, we actually did a comparison on that, and CowSwap still offers quite a few benefits. First of all, it provides you some transaction types that are not actually available. Then, such as TWAP, for example, orders, limit orders, and so on. Another benefit is that we actually batch the transactions together, and they are executed at a uniform price, which means that the price within the block, within the batch, is going to be the same, which again prevents you from being exposed to some of the MEV opportunities.
Okay, thank you.
We still have time for questions, if anybody has some more.
So you mentioned 320 ETH have been saved. I was just wondering, how is that quantified? Is this the total sum of rebates so far, or something else?
Yes. So the way for us, actually the whole data, all the data for MEV blocker is all publicly available, and you can find it on Dune's dashboards and well, actually on the blockchain. So yeah, the way you can go and check it out how much volume it's been feeding, how much MEV's share is increasing, how much MEV's blocker share is increasing, and how much transaction been going through, and how much we already saved by these opportunities.
All right, anybody else for questions?
Hi, thanks for the talk. Kind of a more of a generic note. So am I correct that like fundamentally there is no other way to protect against MEV apart from introducing more trust into the system? So basically instead of using an open mempool, I trust a particular service, be that CowSwap or something else. And basically I say, okay, you can front run me, but I trust you not to do that. And you basically trade off trust for money.
Yeah. Yeah, there are, thanks for your note. There are some solutions that are currently being discussed. One of the solutions is, for example, frequently batched auctions, where the transactions are gathered together within a certain time span of a time, so for example, within a minute or so, and then executed at a uniformed price, which means that there is no way for the attacker to actually try to probabilistically attack this trade because the price would be the same. But again, that doesn't prevent from all the types of MEV. Again, that prevents from the front running, but back running would be still an option.
All right, it seems like there's a lively discussion, but it will have to be continued in the break. Thank you so much, Olga.
Thank you.
Hope you all had a lovely break. And up next, we have the wonderful Oxytocin from ParaSwap. And he will be talking about the big split, how DEX, trading, and liquidity are separated. So everyone give a big round of applause. And the stage is yours.
Wait, next? Okay. Right, thank you very much. Thanks everyone for joining. Oh, I already have a mic actually. I can pass you this one. Yeah, thanks everyone for joining me, both people that are here live and the ones joining me in the live stream. I'm going to be talking about the big split. So I gave a very friendly title with how DEX trading and liquidity are separating, but what I actually meant by that is DEXs are breaking apart. And you know what? That's actually a good thing. So before we start, I want you all to briefly close your eyes and imagine what is a DEX for you. You probably all think pretty much the same thing. 2 text boxes, one with an input, one with an output. You choose an asset, it calculates something, and then it spits something else out. Then you connect your wallet, you approve it, and you do the actual swap. I chose all of these different examples very deliberately because they are all incredibly similar to each other. They all have a pretty identical interface, but in each one of them, something very different is happening behind the scenes. So what actually happens behind the DEX? I made a very simple flow so we could all navigate through it together. Basically, we have somebody accessing the trade. This trade has to be communicated somehow to different poolers and different assets. And there has to be something in the middle that can be called a connector, a router. There's a million different names, but basically somebody has to say, how do I deliver this quote to the poolers, and how do the poolers deliver this quote back to the final person that is doing the trading? And it looks simple, right? It looks like a very simple back and forth. It looks like a handshake. And if you don't do much about DEXs, you think that's where the story finishes. But actually, every single time that a trade is going on, there is a big tug of war happening. There is a fight in every single one of these steps. So on one side, you have the traders. You have the people that obviously they want the best trades. They want the most bang for the buck. They want the low cost. There's a very specific, it's a very general requirement. It can be anything from like low MEV protection. They can be gas. It could be a gasless trade. It could be gas refunded. Slippage fees. Basically, they don't want to spend a lot for the trade. And they want low latency. It kind of connects with the slippage side of things. Like the longer it takes to calculate the trade, the more the market moves, the more your rate is going to be changing, and the more you're going to be waiting for your trades. On the other hand, you have the people that are giving you the liquidity, the actual poolers, and they want something different from the traders. They don't want losses. These can mean anything from like impermanent loss. They don't want something like security losses. They want the maximum return with fees. This can be from trading fees. They can be incentivization, can be gauges, but basically they want to get more than what they initially put in. And the final one, people want to do different things with their assets. You cannot really make everyone fit into a single box. So you need to be able to accommodate different strategies, from the single degen to the big institutional investors that we're hoping are going to be coming back anytime soon. But yeah. And in the middle, you have this complication. How do you reconcile these two? You have the connectors. So I went with this analogy of knots because there's a million different knots that you could be using depending on what you actually want to be doing. Do you want a very thin knot that is going to be handling everything basically on chain? Do you want a very thick knot that is going to be calculating everything, it's going to be incredibly robust, it's going to be planning for every eventuality? Do you want one that has like unique knots that have like jumps in the middle? It's really going to depend on the kind of traders and the kind of poolers that you're actually using. And up until now, and this is the part that is going to be mind-boggling for the people that are not used to DEXs, all of these things, all of these contradictions, they had to fit into a single DEX. Whenever you were building a decentralized exchange, you were expected to have a good front end that would be pleasing these traders. You were supposed to have a good pooling interface to make people actually pool your assets, and you were supposed to have a good connector that was going to be able to navigate through all the pools in a acceptable time. But we can see that that's not possible. There's so many contradictions happening with one another. So how do we deal with this? How does a single DEX manage to balance all of these interests? How do we fix it? Well, I devised a very scientific diagram now to explain the solution that I want to devise for how to move forward with these DEXs. Here's the DEX. No more DEX. So during my time working at ParaSwap, I've been noticing that this actually has been happening more and more over time, but it's kind of been like a silent revolution. We've been seeing this split happening more and more with different examples, and we're going to be now briefly navigating through each one of them to try to pitch to you this idea that maybe DEXs becoming like this, breaking apart into smaller and smaller examples, are going to be much better than these monolithic ideas that we used to have before. So the most obvious example, which is the one that like ParaSwap is built for, is routing. So getting the most bang from your buck. Instead of having a generic router, this ability of DEX being split has led to much better efficiency. I like to believe that this has also been a response following the recent decrease in liquidity in many different exchanges. You have like a limited amount of liquidity. People want to be making big trades. How do you maximize it? And the example that I brought here was something that ParaSwap collaborated with QuickSwap following their new V3 integration. So being able to have a dedicated router as opposed to a generic one brings two big advantages. The first one I already mentioned. You get to be a lot more efficient. You get to see the steps in between. You get to see ways to navigate different pools, different assets, to be able to do everything. And of course, if somebody is dedicated to this, if somebody is able to do all of these computationally difficult tasks to get the best rate possible, you are going to be able to receive much more than somebody who does a very simple calculation that is just like sort by orders, get this thing, and get whatever comes out. But the second advantage, which is kind of going to be connecting to the next block, is that thanks to these kind of like specific routing that is able to go through different pools and different versions, you allow people to connect different kinds of pooling together. So through the old kind of routing, if you wanted to go from a V2 to a V3, I'm sure that all of you OGs are familiar with this. You had to do like the big migration. You had to decide, okay, we have the legacy pools, we have this one, so how are we going to be displaying it in the interface? Are we going to have a toggle from one to the other? Your liquidity is going to be split. And now, with a single streamlined interface, you get to have all of this happening in a single trade, and not a single dollar gets wasted. And obviously that benefits DEXs, but it goes a step further with pooling. And in my opinion, this is the most exciting development that we've seen over the last year and over the entire bear market. I really think that we're seeing a lot more niche solutions that people really wanted and didn't notice until now. Here's a few. It's not comprehensive, but there's some examples of ways that pooling has become a lot more specific now. We have small niche DEXs that are trying things different from what it used to be done before, such as with Swap Finance and their Swap B2 model. Instead of the usual Uniswap-based model, which relies on arbitrage to be able to balance all the different pools, they've gone with a Chainlink Oracle to be able to minimize the impermanent loss and be able to maximize the swap fees. I am not super technical with how they've been able to do this, but what I've known is that the efficiency has been insane with this. So looking at this from the side of ParaSwap, from what I've been able to see, in some months, every single trade below 10K had at least some parts going through swap, like 30% going through it on the ETH USDC one. And this was with a very brief amount of TVL. So thanks to this split, we are seeing this rise of new DEXs with new ideas, be it like programmable orders, like we see somebody from Mangrove here in the audience. We have these swap solutions that are minimizing impermanent loss, which used to be something that in the past was impossible. But let's also flip things around. This is a solution for niche liquidity pooling, but what about people that are developing? One very interesting example that I've also been seeing has been with Algebra Finance. They offer like very concentrated liquidity engines, but they've been offering it to a different variety of DEXs all throughout the space. So it started with QuickSwap, then they went with Camelot, Thena, and they're able to provide this concentrated liquidity engine as a service and be able to integrate into these new DEXs. And this would not have been possible if we had this kind of monolithic DEX model happening before. They are able to build what they know, collaborate with other DEXs, and be able to do this kind of solution thanks to the increased composability of splitting DEXs. So we've covered the side on the pooling. We've covered the side on the software, like why they should be benefiting from this. But let's go even a step above. What if you do not want to be profitable from just trading fees alone? What if you want to be going with even more composable and like interesting gauge mechanisms? So that's where you go with ideas like Balancer and Curve with their different systems. I went with Curve because they have their automatic Vnomics and gauges, but they go even a step further on the weirdness, which is why I really love them. They're able to have these balanced assets where if you can decide that you actually want your liquidity pool to be 80%, 50%, multiple assets, you can build everything however you want it. And finally, what all of these have in common is that they've all mentioned the same thing, that without this kind of split, without of this aggregation, they would not have been able to thrive. Imagine you're building these kind of incredibly niche products, and you also have to worry about getting your own front end, making the people swap only through you through your very specific case, making sure that people actually stick with it, making sure that liquidity shifts. It's impossible. But by integrating all of these together, we're able to see these strategies and these solutions, and DeFi becomes a lot more exciting for everyone. So at least for me, it feels like something else is being built thanks to all of these composability. So I wanted to go with a final advantage that if we have any designers in the audience, they're really going to be enjoying this, which is the UI. We are able to finally judge a DEX by its cover. I'm going to show these three. Again, I'm using ParaSwap as an example because that's the one that I know. You talk about what you know. But all of these are using ParaSwap in a different way with different levels of complexity. You start with Argent, which is a wallet, and they have a very simple interface from swapping from one to the other, and the amount you get in network fee. So that is the level one. But what if, for example, you already know about trading and you want to go even a step above that? Using the same API, using the same interfaces, you get to build something like with Full Combo, which lies in that middle of you know enough about trading, you know enough about strategies, but you're not satisfied with a simple swapping A to swapping B. You want to have more in-between steps, but you still don't know how to program. So here's another level that you're building on top. The biggest example, that's why I used the screenshot, is that you're able to access stuff like Aave flash loans directly through dragging and dropping different cubes. And me, I'm not a dev guy. I am a complete smooth brain that up until now, flash loans were completely scary for me. And introducing this kind of interface suddenly opened this world of possibilities to me. But let's say that a miracle happens and I start programming. You can abstract all of this away and be able to go directly through the API. And then you can build whatever you want. You can build maybe something that doesn't have an interface. It's an automatic bot that does some conditions. Or you can have a simple command line if you're the kind of person that absolutely loves having a Unix interface and running everything through the SSH. There you have an API. So these are just three examples, but I hope you can see what I mean now with, even though we're presenting the same thing, which is basically all of these DEX aggregation gone through a single entry point, we finally have this ability of giving one for every single user, which I know that with the current market sentiment, we keep thinking, like, what are we building here that is different from Web 2? What is different now from what we were doing before? And think of this, in previous ecosystems, in permissioned ecosystems, every single designer, every single UI was thinking, how do we make something that satisfies everyone? And it's not possible, but they had to be able to fit everything maybe through a simple interface and an advanced one. And here you can build everything finally for every person's dreams. So yeah, that goes to where do we go from here? There's always the meme that's been happening from the beginning of DeFi about money Legos. The idea that every single part is composable, you have the different blocks, and you build them from each other. This, yeah, it was true before. It was happening for a while since DeFi summer or even before. But I really believe that the Cambrian explosion is happening now. So I come from a biological background. For those that do not know, the Cambrian explosion was a point in evolution where we went from like basically very simple life to everything developing all sorts of weirdness. Everything was being tried. Everything is being able to be exploited thanks to the sheer amount of choices and the sheer amount of things that were happening, this never-ending wheel. And I really think that by breaking down DEXs and having this amount of immense composability, we're really entering this stage. We finally get to have a use case for every single kind of user. Think of it, instead of having to be like, okay, I'm going to be building an interface that I personally like, are we going to have enough people that are going to be using this interface? You don't have to worry about it anymore. If you have a small group of weirdos that like having this kind of weirdo trading, you can build for them. If you want to have an extremely accessible trading interface that doesn't even notice that it's DeFi, you can build that one, and you can utilize all of them with all the steps in between that you want, thanks to this amazing level of composability. And finally, and this I think is the most exciting one even for me, you get to build on the shoulders of giants. You do not have to reinvent the wheel every single time you want to develop a new product. So I think you're all familiar with this. It's part of learning and experience, trying to build something, is there's something that you actually really care about, something that you're really excited about. But on the way, there's all of these small pesky things that you have to learn to be able to make it go live. So for example, you have this brand new liquidity idea for poolers to be able to have everything working without having to worry about it. And you're a genius of it. You've studied about this university. You've seen other examples. You want to program that. You make it go live, and then you wonder, OK, how do I make the traders arrive now? Where's the volume? And by having this level of composability, you can borrow from one, you can borrow from the other, you can have all of these being built. And not only do you have to skip all of those parts, you can build from everyone else, but also they benefit from it. We end up having this amazing ecosystem where we have these incredibly niche products built from each other. And to finish, I'm going to have a personal tangent because, I mean, we've already gone through 2 days of crypto talk. And I want to show an example of why this is so awesome from another hobby that I've been doing in my free time. This is Stable Diffusion, a self-hosted AI model. OK, can you guess how this UI is called? They call it Comfy UI. Supposedly, this is a comfortable way of approaching things. It's very similar to Blender nodes. It's very similar to this kind of like programming-like interface. But as somebody that doesn't know programming, as somebody that is not able to do these kind of things, it felt incredibly overwhelming for me. And in a way, we started seeing these communities that were in a similar position. They were like, OK, I do not know how to handle this. How can I make it more accessible? And then people started making their own pre-made nodes, these own pre-made ways of showing all of this while abstracting away the complexity. So for example, now I'm using a very specific kind of node that all of this spaghetti is completely out of the picture. All you do is put the text, you put the image you want to be putting in, you put the seeds, and then it automatically outputs the image. And from there, if I can make it that I do not understand diffusion models, I do not understand Python programming, I do not understand any of this, I just understand that I want to make a pretty parrot. If I can make a pretty parrot with these comfy UIs, we can get something similar going in the world of DeFi, in my opinion. Even if you're not a programmer, just get the nodes and get everything going. I wonder if that buzz was for me. Well, anyway, thank you so much for attending this talk. I hope you got something out of it. I have a PO-up if you want to scan it afterwards. And yeah, if you have any questions, we have even a couple more minutes.
Thank you very much, Oxytocin. Yeah, so we still have some time for questions. So if anyone would like to ask any questions, now's the time. Anyone?
If you're scared, we can always talk afterwards. Don't worry.
Well, if no one has questions, then I guess we still have about 7 minutes until the next speaker. So everyone take a break, and we'll be back to you soon. Thank you very much.
Thank you. Till this year.
And up next, we have the great Lucas Martin Calderon from Pentestify, and he will be talking about the latest advancements of AI in blockchain security and how deep reinforcement learning compares to static, dynamic, and formal verification techniques for DeFi security. Everyone give a big round of applause.
Amazing. So hello, everybody. I'm super happy to be here, especially because I've been thinking quite a lot about what to speak about today, whether to speak quite technically about what AI is, comparing our tools to other world-leading tools like static analyzers, dynamic analyzers, formal verification tools. But at the end of the day, I actually decided to truly maximize the impact, go back to the basics. So how really AI works, to be able to understand where the future is heading to, and to be able to, when you guys, which I imagine are quite entrepreneurial, have an idea, something to do next, you're able to really get the basics well, get the basics right, and hence develop a product that really makes a difference. As Elon Musk says, one of the problems with entrepreneurs, with smart engineers, smart people, is that we focus on the wrong problems. So we try to optimize and maximize problems of things that shouldn't even exist. So who here in this room is afraid of AI, as in replacing your job or actually taking a bit of your job? Is there any takers for that? Of you guys. Okay. So first of all, if by the end of this talk you feel a little bit worse and so on, that means that I've done a good job, a little bit. So again, we are going to talk about how AI works, why you should fear AI, the ways to think about it, and the exact same thing for the blockchain. So already, what is a neural network? You already have some inputs. In the middle of the inputs and the outputs, that's where the layers come in, right? That's where you have some weights. The weights could mean how strong the system is, how strong the relations between these variables is. Then those B's represent the bias. So in a loss function, in an AI model, that means to minimize the error, the loss function, the cost function. And then you have an activation function, which could be softmax, ReLU, sigmoid, to simplify the output. And finally, you have the outputs, which generally could be it's a car, it's a carpet, it's a mug, or that would be classification, or it could be regression regarding numbers and so on. So again, we've talked a lot about, and we've heard about ChatGPT, LLMs, transformers, what they do, how they work. And I would like to give a very basic explanation, but yet enough for you guys to understand why ChatGPT or different LLMs wouldn't be apt for certain things, certain vulnerabilities, and so on. So I don't know if you can read it well, but ChatGPT is made of, or transformer networks is made of encoders and decoders, right? Encoders get your input when you put text into ChatGPT, and decoders actually get that context and decode and output the end result, right? And it's quite easy, and well, it's quite important to understand how self-attention works. That actually comes from a paper from Google called Attention is All You Need from 2016. Actually, it's quite old, but it's the basics for all we've got right now. So if you want to use these tools to find vulnerabilities in smart contracts, that's a bit more tailored to smart contract security auditors. You already start wrong if you use a pre-trained model. Why? Because the attention mechanism of LLMs, of ChatGPT, is already tailored to optimize and maximize the probability of the next word, right? So according to your questions, according to the tokens and the whole embedding, what is the probability of the next word popping up, right? This is important to know because if you think about mathematics, if the smart contract does some mathematical reasoning, when you ask it 5 plus 5 and it outputs 10, it doesn't know what 10 means, or it doesn't know what addition means, or what 5 represents, signifies. It simply means that after all the terabytes of training data, academic papers, and so on, most of the times there is a 10 at the end of the thing. So do you want that to be piloting, to be driving the security of your Web3 company? I definitely hope not. So when thinking about all these things, on the right, as you can see, that's simply how AI sees the input text that you put. When we call artificial intelligence, is it really intelligent? How intelligent is it? The stability of the CEO Stability AI said that by the end of 2024, I might be wrong about this. Well, already it's not me who says that, but I do agree and align with him, as in we will be able to have ChatGPT on our phones, downloadable. And the size would be 5 gigabytes, more or less. Doesn't that mean a lot already? You're able to train on terabytes of data. You're able to put a big portion of the internet, of the best books, of the smartest academic papers, and then you're able to download all that information into 5 gigabytes. Are we talking about a sort of compression algorithm? Are we talking about something else? That something else is what we interpret as intelligence, but however, we plan to transpose our intelligence to what this AI, how AI works, right? Which is something completely different. This is why, when really thinking about security, and even though certain models might output certain vulnerabilities of smart contracts, you truly need to understand how it works first, what kind of intelligence or compression algorithm it has, or pattern recognition, to know the limits of its creativity, of how it works, and so on. This image is simply what the AI sees in the first step. So if you see these are the word embeddings. All the features, all the rows, so each row is a token, and each column is a feature of the token, a dimension. A dimension could represent different things that we cannot even imagine in that case. It might be word similarity, semantic similarity, and it's quite important for the self-attention algorithm. This is taken actually from Jay Alsom, one of the best illustrated engineers that are able to express with graphics how AI works. And in this case, for example, that it says the animal didn't cross the street because it was too tired. When you refer back to the whole graph, to the whole way of seeing things by the AI, what does it represent? Does it go back to the animal, or does it mean the street, right? This is where attention comes in and where it's tailored to certain parameters. In this case, ChatGPT is tailored to make sense for the questions that the user asks them, but it's definitely not tailored, engineered, made to find vulnerabilities in smart contracts. Now, however, we would like to talk about really the opposite of the monopoly of AI, and why AI companies should fear AI, and why it is really down to the community, and this is the message that I want to put across. It should be up to us, up to the community, to really drive and set the pace for the future of the developments in Web3, including AI and blockchain, and not to these big corporations. So GPT-4 was the first one, the most known one, well, commercially available, even though Google started way before. Then we've got Cohere, Stability.Id, Claude by Anthropic. Some engineers from that already were working there. And then in this case, it seems that Mark Zuckerberg is actually one of the good guys, one of the biggest research companies putting their research out there for free. This is how fast, by the way, AI has been working. So since the first moment ChatGPT was released, on February 24th, Llama was released, but it was open source, and yet the weights of the model, that means the intelligence after the training model, they were private. Somehow they got released from 4chan, and since then there has been a super fast acceleration of people building on top of these tools. To give you an example, on March 13, it was already running on consumer hardware. On March 19th, Vicuna, another model, already surpassed Google's Bard. So something that was around $200 million to train in the AI database, and computing zones, it already takes $300, $300 to fine-tune the model. Fine-tuning simply means making it better after it's already pre-trained or tailored to your needs. GPT-4 launches, and it already creates an entire ecosystem. The biggest LLMs, open source libraries like LangChain, like Weaviate, the vector database, already try to pop up and catch up with the speed. On March 30th, Bloomberg GPT launches, and shortly after FinGPT, so Finance GPT, the open source version of that launches as well. So as you can see, since the weights of Llama were put out in the wild by, well, definitely not by Meta, but by someone else, I guess an insider, in less than 6 weeks, we were already able to get the same performance or very similar accuracy, F1 scores, precision, that models that took years of development and hundreds of millions of dollars to train. So this is again the moat. There was as well a leaked article by Google saying OpenAI has no moat, and neither do we. By moat, they simply mean competitive edge, competitive advantage, and it was already possible given certain technologies, certain advancements in the field of AI that allowed all of that to happen. However, it is important to note that you're able as well to fine-tune the model simply by prompt. So you don't need to do that technically. Prompt and giving context already kind of helps that out. But speaking of the technologies that actually helped the open source community carry all these advancements forwards and actually achieve the same precision or similar precision than Google or OpenAI were two main technologies, quantization and LoRa. LoRa is not to be confused in the electronics field, but it is a lower rank adaptation that allows actually to reduce the number of trainable parameters by 10,000 times, which actually reduces and helps free up the bottleneck of AI training, which is generally the GPUs. And then quantization, it is faster inference, it saves money, and you're able to simply, when the training happens and on inference, you're able to reduce the vector space, which is used to train the model. So now the problems with generative AI, and this is really where the research that I've been doing at Pentestify, and as well in collaboration with University College London, we've really wanted to approach it in the most natural way. And by natural, I mean one of the human's best inventions, or rather than inventions, executions and engineering achievements were actually when we observed nature. So what best to represent how a human finds vulnerabilities and thinks of vulnerabilities than actually studying the brain and seeing the brain how it interacts when presented with a smart contract. So we took a bunch of auditors, 50 smart contract auditors, and we put them on an MRI machine to know actually the areas of the brain that activated when doing these things. A lot of noise happened, but we were, thank God, helped by medical professionals that know exactly how to interpret and read that data. And actually, it aligned very well with the philosophy at the beginning that we carried at Pentestify, and it was, what kind of AI should we develop to really find vulnerabilities without having the same weaknesses as OpenAI or ChatGPT? Again, we don't want to optimize a problem of an issue that shouldn't exist in the first place, right? So we realized that the answer was actually the true intelligence for this very specific task was mixing different types of intelligence, and we realized that when spatial and vision activated in the brain, there's already an AI model tailored for that, and it's called graph neural networks that are able to think sequentially through time, through functions. Again, a smart contract auditor, when you're creating or auditing the code, you might think of the control flow or data flow diagram, right? but might be thinking directly with all the different function calls across time or in different order that it was already meant to. So graph neural networks are indeed able to achieve that task and have different information in parallel at the same time. The language area in the brain already was quite active, and for that we use part of LLMs like ChatGPT, but only up to the embeddings point. And the embeddings, again, it is the representation of the tokens of the words that you put in. And we wanted to make sure that the attention algorithm, the attention mechanism, was tailored to find vulnerabilities instead of to understand the semantic context of it, because at the end of the day, we don't want the AI to understand the smart contract per se, the semantics of it. We want to understand the different instruction sets and its interactions with the EVM. And there were a bunch as well of algorithms like short-term long memory algorithms and so on for prediction, mathematical reasoning that we already know that ChatGPT might not be the best at. In fact, even though it improves, it is definitely from the base, from scratch, the wrong algorithm to think and the wrong AI model to think for these things. So, well, I hopefully can skip that one. The blockchain, how it evolves, the good ways, the bad ways. Well, the fact that that is on right doesn't mean that I don't agree with those two, but it's definitely something that we should take into consideration. The fact that both things exist at the same time and the need for both things to exist at the same time. For the first time in history, our money in banks will be programmable. That means that if you receive money from your job or from even your own venture, you might need to spend it in a timely manner, because otherwise you could get burned, or you won't be able to route it through certain channels because it would be forbidden. Again, control has never been so active. So again, what is the best way to marry blockchain and AI in the context of security, and why is it so interesting to mix them in? Is it simply because in Web 2 AI was so prevalent? Well, in this case, it really helps the infrastructure of blockchain. The availability of the data is there for the first time, is public. We've given up the control for our data to be public, for certain transactions to be public, for at least the pleasure of not being stored in a centralized server that someone else controls and not you. The sector is about to change as well, with different encryption schemes. FHE, ZK are definitely there to change the game. And if you want to simulate different aspects, different attacks on the blockchain, it's never been so easier with an infrastructure that you can fork, that you can literally copy and simulate it. Why is the security aspect so important? Even though this is not a double sale that I need to make here, I'm sure. In 2023 alone, there was 3 billion over of attacks, of stolen dollars. 70% came from smart contracts, and 92% of these smart contracts were already audited by top firms. This is nothing to say of these top firms, but rather the fact that it evolves, that new vulnerabilities are found, and most tools are actually, when referring to static analyzers and dynamic analyzers, they have predefined instructions, predefined vulnerabilities. So again, the very basics of AI, of deep learning, is being able to train to inference on unseen data and being able to infer new vulnerabilities that you haven't even learned the patterns before, or hasn't been entered by an expert. So that's what we do at Pentastify through 5 different AI models. You give us simply the address of the smart contract. We get all the vulnerability. We get all the dependencies, all the graph from the different smart contracts. And across time, we continuously monitor it. We extract the vulnerable patterns. We store them in a database. Many of them are not vulnerable. But given that it is in a multidimensional space that not even humans can understand, as you saw in the graph, embeddings are using way more dimensions than what we can possibly imagine. That remains on the database until a smart contract with a similar vulnerability is found, and then we alert the team immediately. And we are able to find variations of vulnerabilities like reentrancy that a static analyzer wouldn't unless it receives an update. So yeah, thank you very much. More than happy to answer any questions now or after. I was only able to touch upon on an overview, not in detail, many topics, but happy to answer any questions.
Chris, and yes, now it's time for questions. So if anyone has questions, please raise your hands. We'll start with you first.
Can you explain the triangle from about 4 slides before?
So it's simply what are the limiting factors of AI once you're scaling it for training and inference. There are 3 triangles, which is data availability. There is also the compute and storage. Where do you store it? How do you ensure the integrity of it? And there is the what kind of model do you use? The model relates very much to the state of the blockchain. If you change the model, you might actually be changing the weights of it, and you might make it dumber, right? This is the exact same thing as if the blockchain changes the state by the consensus, but it wasn't the right thing to do via an attack. So when you put it in a big enough scale, you end up seeing that they also share many of the problems, whether it's the state of the model and the continuous change, or how do you ensure the data integrity of all the data. Yeah.
Yes, I've seen your hand. Right, so yeah, you go next.
Yeah, thank you for the talk. I have 2 questions. First, the AI modules that you use, what is the input and the output? Do they output like human-readable descriptions of vulnerabilities or pieces of code or malicious transactions, or like how does it look like? And second, I want to know if you are able to identify any like new types of vulnerabilities that auditors haven't even thought of before. Thank you.
Yeah, no, good question. So the inputs, we in fact are experimented with 2. The product only uses 1. We act directly on bytecode, so that is where we get all the instructions. There is a way, by the way, to as well clean out the bytecode if it's obfuscated or some things, but that has nothing to do with the AI. It's a bit more static, that process. So from the bytecode, we are able to obtain the graph, the general graph of the function calls, of the edges with the data, the control set, how strong they're interlinked, whether a single variable, a storage variable, shares different function calls, and if so, which function calls, are they the same link? That means, do you have an access control problem right there, or are you not supposed to change that variable? Should that be an invariant and it's changing? So you can definitely obtain all that information from graphs. We've been able to find or to have certain positives in the results that we didn't quite understand how to attack them, how to exploit them, or if they were even a vulnerability. But after experimenting and I don't even know there is a name for certain attacks that we discovered, it was indeed vulnerable. So it doesn't act on classification, on that expert pattern relates to reentrancy, let's say, or relates to access control, or relates to something else. Plus access control, you first might need to know the business first to know that. So after tinkering, we were able to see that it was indeed vulnerable, even though there is not a classification of that. And that is again because of the whole multidimensionality of how the AI sees the smart contract. And that is one of the main advantages, that it thinks of vulnerabilities even before we can think of one, or put a name to it rather.
Thank you. And I believe we have time for one more.
Generative adversarial neural nets, and trying to get those things to play against each other like they would play AlphaGo or they would play StarCraft. Has that been explored? Has that been ruled out? Is that something on the roadmap?
Yeah, super good question, and that's what we're playing with as well. We haven't obtained many conclusive results, so I'm not able to speak objectively of how much better it is. But if you play with that and deep reinforcement learning, you're able to create agents in parallel, right, that act on different environments. And what if you could detect a vulnerable graph that we were able to do already, but create variations of that graph, right, that might relate to different ways of attack, right, and playing one against the other. Again, we can already fork the blockchain, we can get that reward, whether it is positive, that means that it was exploited. So yeah, playing different AIs against each other to know which one wins, which one really got that positive reward is something that, again, I'm convinced that it's another venue of finding vulnerabilities, and new ones even, because you're generating new graphs, new interpretations of data, and for sure that's a very smart way to think about it as well. Yeah.
And so the definition of vulnerability, could it be abstracted to more of a game theoretic definition? Instead of it being a hack, it's a, for example, poor game theory dynamic. The game theory, like the table doesn't match what the white paper says. Could something like that be interpreted from such an AI?
Yes, that's a bit more higher level. You need to understand the business, the logic, the semantics of the smart contract, or the business behind. We are purely focusing on bytecode, but if you're able to input, again, automatically instructions of what shouldn't change, or given that the business is that way, that definitely shouldn't be like that, or that variable should never contain that data. That is something, again, the possibilities are endless, and you would need, an LLM would be a good option for that too, on the other side of the smart contract, yeah.
Unfortunately, we have no more time for questions. Thank you very much, Lucas.
Thank you.
Everyone give a big round of applause again. And up next, we have the brilliant Zoe Mekbak from Fala Network, and she'll be talking about the off-chain computations, problems, reality, a trusted solution. Everyone give a big round of applause.
Thank you. Perfect. Thank you so much. Yeah, great to be here. Hello, everyone. I actually thought about it today. I travel quite a lot and speak at different stages around the globe, but it's my first time at Dappcon this year in my hometown Berlin, so it's very great to be here and to share some of my knowledge, or the knowledge that we develop and have acquired at Fala Network about off-chain computation. I'm Zoe. I'm VP of Growth and Partner at Fala Network, and we provide a decentralized off-chain computation infrastructure. The title is Problems, Reality, and a Trustless Solution. I won't go too deep into all the problems, but of course there are some things that we can improve in Web3, specifically when we talk about computation for dApps, backend services, as well as when it comes to off-chain computation. And as we all know, smart contracts are a very important component in our Web3 tech stack, but we at Fala have the thesis that smart contracts are not really smart without connectivity. And connectivity in terms of actually reading information from the off-chain world and the on-chain world. But on-chain, or what is actually off-chain, we define it in different terms, because if you look at different chains like Polygon from Ethereum to Polygon, would Polygon also an off-chain network, right? It would be off-chain. From Polygon to Arbitrum, it's also an off-chain connection. However, all of these platforms are trustless platforms or protocols. So the question is, or what we are trying to solve and look into, is how we can actually connect these trustless platforms in an off-chain or with an off-chain solution. And to explore this a bit further, I don't know if you guys have heard about the FET protocol. Yeah, some of you, cool. We actually got very inspired by the name and the protocol. You will find out later why. And I would like to deep a bit into this. This is a nice visualization that shows the initial web, we call it Web 2, right? Where the value captured or also created is mainly on the application layer. We have fat applications or rich applications and a very thin protocol layer. Now in Web 3, when we started to implement blockchain in the overall internet tech stack, we actually turned the page, right? And we have now value captured or value creation on the protocol layer. But with this is coming also that we have quite thin applications. So we have a fat protocol and thin applications. We now said, okay, or if we go deeper into the application layer in Web3, where we have fat protocols but thin applications, what about the smart contracts that are important component of these applications. And if you look into most of the dApps, most of you guys are builders, I guess, they're also you develop your own dApps. We actually have very thin contracts at the moment, but a very fat or rich backend. And fat in this case, that most of the backends are still hosted in a centralized way. So we have a lot of computation, storage, right, on these centralized or provided by centralized backend providers, and then a very thin contract that runs on chain, which is also okay because we don't want to make the blockchain also too fat. So, but how would it be if we actually have fat contracts? So a dApp could be actually more rich or actually better, could create more use cases if we provide fat contracts at a thin backend. So we at Phala say, okay, to create this, we need to upgrade these smart contracts and create smart contracts with verifiable computation. So we can actually lean or make this backend small or thinner and have the fat contract that actually dedicates or communicates with the dApps more rich. So we say, okay, we need two things to actually create this verifiable computation or make these smart contracts thicker or fat. The one thing is add connectivity. At the moment, smart contracts don't really, or they lack a little bit of connectivity. They cannot communicate with the internet. How about adding connectivity? So your smart contract can send HTTPS requests, and you can talk to any Web2 API or any internet protocol in the Web2 world. And the second part that we also need is the verifiable computation. Computation is super important, but as we just learned, it's mainly provided by centralized services. And we can verify we can verify the computation in an off-chain world, but send this information or save this proof on the chain. And this is what we have developed at Phala Network, and we call it Fat Contract. That's where the inspiration comes from the FAT protocol. So it's we actually adjusted it with the PH, so it fits into our branding with Phala. This is a contract. We call it an off-chain programming model that is run on our own infrastructure, on our own decentralized computation infrastructure. And FAT contract because it's a contract that's richer than a smart contract. We also like to say it can actually make smart contracts even smarter. So what can this FAT contract actually do or provide, especially for US dApp builders? The killer feature, so to say, is the internet connectivity. This contract is mainly runs in our off-chain network, and we actually have interesting architecture. I will show it in a minute, where we can provide secure verification, not direct on our chain, but in a separate layer. Based on this, because we provide most of this commutation of this contract in an off-chain environment, we can easily communicate with Web2 APIs or internet protocols via HTTPS requests. Omni-chain connectivity, very important, right? We want to communicate with several chains or have this contract actually not deciding if it's based on EVM or maybe also communicates with the substrate chain or similar. So we can easily use our internet connectivity to directly launch or connect to any RPC node on any chain. Functions feature is very nice because this contract actually on a very low level is written in Rust. However, we are EVM compatible, but not too many developers like this language. So we said, okay, we abstract all of this, and you can actually modify or customize FAT contract in JavaScript. And the fourth benefit is the verifiable computation. So based on the architecture, we can verify any information in the contract before we actually send this on-chain. What can we do with FAT contract? We are working very closely with the Web3 social environment, specifically with Lens. Who's using Lens? Lensstar? Cool, very good. Very cool protocol and a cool team also. We have developed a use case called Web3 social, actually the Lens API Oracle. Lens has an API, also an SDK, so you know. This API, however, is not decentralized, the Web2 API. And the dApp developers that want to communicate or send this information into their Polygon smart contracts can't do this. They do their own hand-rolled up oracles or whatever. So we created the Lens API Oracle, which runs on our contract. And here's just an example what this oracle or this solution can do. It's more like a intent or a connection. If you say, if you have followed this profile, then we can actually verify or see that you get rewarded in Matic. If you have mirrored a specific post, then you can be whitelisted. So it's an if-then connection that we can verify in the contract before you actually execute it in the Polygon smart contract. Yeah, I didn't want to do a live demo, so I just put some screenshots here from our of the UI. What I want to show with this is that we put a lot of effort, thoughts, and love, if you want to say so, into the UI and the developer experience. This is actually how you use the Lens API Oracle, almost no-code, or if you want to say low-code UI. We have here the infrastructure, just for this use case. You can pick the profile that you want to work with. On the left-hand side, you have the API data from the Lens API, and you can customize it in the JSON paths below as well. Then you can review everything, and then actually you directly deploy this kind of oracle. We use a stake-to-compute model because we have the computation in the backend. You, at the moment, still need a bit of our own native token, which is FAR, and you stake this to actually execute this contract. But whenever you decide to not use the service anymore, you can unstake, and you have actually kind of free compute. So in summary, we want to, or with this use case, we actually motivate or incentivize developers in the Lens ecosystem to deploy their own oracle in almost 5 minutes. They pick what they need, they customize it, and they deploy it. Fed contract is this contract that executes everything what I just explained in the backend. And the Lens API Oracle, what is this use case, is a specific blueprint. So we wanted to abstract it a bit and say, okay, we are building blueprints or want to inspire developers to build their own blueprints with it. And another use case or another blueprint that we have built is Fed contract plus AI. We just heard the nice speech also about the combination. And we built a Web3 AI agent, actually at East Global in Paris. More the engineering team than myself. But it was a very cool experience because we wanted to showcase how Fed contract can combine, or how we can combine the off-chain computation with the AI part. This is our product we developed there. It's called Smart Cookie. And it's actually a browser extension that helps you or refers you, provides you information based on your activity in your web browser, but focused on Web3 applications. This is actually how it works. So it's a Chrome extension. It runs on Fed contract, and what it does, it recommends you specific activities. If you go back, for example, you like or you buy an NFT collection on OpenSea, then you open maybe Lenster, and then you get the recommendation to follow the specific artist that you just bought the NFT collection from. Or you own a specific token, and then you also open your application on Lens, and then you say, hey, do you want to follow this person, this leader? It's actually his company that you just bought tokens from. Yeah, and here just, again, that you see we integrated also the different tech stacks, AirStack for the API request Lens, and communicate there through HTTPS requests. That comes from Fed contract, and Fed contract runs on our own blockchain network. Yeah, actually the first announcement, or I'm announcing it the first, we are launching in 2 weeks soon, Fed Contract 2.0, which is just a little upgrade in terms of like adding more features to the overall key features of Fed Contract itself. The main feature that we are adding is actually kind of like a functionality, meaning that we expanded the contract that you are able to call any Web2 API and push it directly in any kind of smart contract. With the Lens API Oracle, we were focused on the Lens API. Now we actually broaden up, and with the launch, I think we have around 5 APIs already that developers can choose and select, and there will be added more, so you can directly pick and choose the API, configure what you want to read from the API, and we push it through our Fed contract into your smart contract. Yeah, so this is the the most important part, actually. So it's nice and cool to hear about Fed contract, but how does it work in the back end? Why can we actually provide this verifiable computation? This is our pretty innovative, I like to say, infrastructure. We have a L1, which is our own blockchain. And the cool part is that we separate the consensus on the blockchain from the actual computation. So consensus is separated from the computation part. The computation is represented by the black layer, and this is the part where most of the contract also runs, but it's hosted or secured by secure workers. So everything that's executed in this layer can be verified, and then we just push the proof on chain. The fact that we have this computation part off-chain, we can easily connect to any EVM substrate chain or whatever. So this is actually the magic, how we can offer this Fed contract that communicates off-chain in a secure way. Yeah, and if you haven't heard about Phala Network before, now you actually know what we are doing. To put this into perspective, we are actually the biggest Web3 cloud, completely decentralized. We have almost 200,000 virtual CPU up and running. We don't own any of these nodes or servers. This is all community run. We have a pretty attractive tokenomics to incentivize all the node providers to provide their CPU. These CPUs, they are secured by the online workers, and then some more numbers on cross-chain transactions and on-chain accounts. And that's it from my side. Yeah, happy to answer some questions. Thank you so much.
Thank you very much, Zoe, for that wonderful talk. So if anyone has any questions, feel free to raise your hands. Yes, you, sir.
Hi. Thanks for the talk. Could you elaborate a little bit on the verifiable part, on what exactly do you mean by verifiable computation and what techniques do you use? Is it like trusted computing modules like SGX or some cryptographic techniques, or what is it?
Yes, everything you said. No, so as you saw on the infrastructure part, the off-chain part is secure enclaves. It is based on SGX, on trusted execution environments. So every node operator needs to secure or needs to provide an SGX node, right? We cannot use any other technology or hardware. And we have implemented like a performance test that we can ensure that these nodes are also, that they perform good, and a slashing mechanism in case they are up or down to actually ensure that they also execute what they in a good way, right? That these are good nodes. Based on this, because it's based on SGX, we can actually verify. But if you only would host this off-chain, you don't have the proof, because no one can access an SGX hardware, which is the good thing. So that's why we have our L1 to send the proof to the chain, and then you can verify with the proof on chain.
Yes. Did you have your hand? Sorry. Oh, yes.
Just, I guess I'm assuming this kind of works in a completely open way, since it's decentralized, so there's no privacy preservation, right? Are you guys trying to tackle that problem?
Privacy?
Yeah, as in like nobody can eavesdrop into the computation itself.
Yeah, actually, we actually just rebranded. Our old website actually said the privacy compute protocol. We provide this privacy, right, through the architecture. We just don't position it exactly like this, because we found out that the more interesting part for the debt developers is this automation contract, the Fed contract, with privacy included, right? They get it just add on, if this answers your question. Or what? So
you guys are working on it. What there is essentially, you can't protect essentially the data that you're computing.
Yeah, I mean, if you look into the architecture, it's set up with the privacy focus, right? It's a privacy computation, actually, architecture. But we are not, because there are other architectures now with ZK coming up, right? And people discuss, okay, ZK or TE, like we don't promote it as this privacy, but it is set up and architectured with a privacy intent, if this, okay.
Anyone else with questions? Then I guess that wraps it up. So yeah, thank you again, Zoe McBack.
Thank you.
Give a big round of applause.
We still have some time for the next talk. We'll be back in about roughly 7 minutes. Okay, welcome back, everyone. And up next, we have Fedor Kurbutov from Fluence, and he'll be talking about hacking decentralized RPC with Aqua and Marine. So everyone give a big round of applause.
Okay, so yeah, my name is Fedor Kurbutov. I'm from Fluence Labs, and today we are going to discuss the dApps and their dirty little secrets that, well, they actually use centralized infrastructure and are not fully decentralized. I'll talk a little bit about Fluence Network, what it is, what it is capable of, what possibilities does it enable developers to do, and I'll talk a little bit about FRPC, the decentralized RPC solution that you can use to try Fluence and to mitigate those centralization risks that are associated with centralized RPC providers. As Zoe correctly identified in the previous talk, the Web3 is not only about the blockchain, it's also about like general compute. But first of all, let's talk about dApps. So basically, a dApp is an app which uses blockchain as a backend, and it needs blockchain nodes to query them with JSON RPCs. So, and here is the usual like flow of data that is running from the front end to the JSON RPC provider to the blockchain. And hosting and basically the Web3 developers have two options. So they can either self-host the blockchain nodes, well, which is very difficult and very time-consuming, or they can use like centralized RPC providers like Infura, Alchemy, QuickNode, and other ones. And from the starting point, that might be a very easy and intuitive way, but it has some caveats. So yes, it is convenient, it is cost-effective, but it has certain centralization problems. Well, it's a single point of failure for the application. There is also a deplatforming risk. And of course, it introduces a significant trust component. So you have to trust your SaaS RPC provider. More on the deplatforming risks. So those service providers who provide the nodes are actually like just normal businesses, right? That they are essentially very similar to Web 2 platforms. So in case if the app has some limitations or there is some kind of legal caveats, those platforms can shut off any application for any reason in their multi-page terms of service contracts. And this leads us to a conclusion that, well, while our Web3 apps have those decentralization overhead and added complexity, they still pretty much carry the complexity and risks associated with the Web 2 platforms. So, what can we do with RPC centralization problem? And yeah, let's try to de-risk SaaS RPCs. But how can we do that? So, in a nutshell, there are two basic ways how to do that. So the first one is to just make your application aware of the fact that, well, there are multiple RPC endpoints and you can add that logic to your app. Well, or you can use some magic decentralized serverless and open permissionless platform to handle that for you. But more on that later. So let's explore the first option. The option to roll your own quorum or failover solution over multiple RPC endpoints. So what it gives you, yep, it gives you lots of control. You can write your dApp code to handle quorum, failover solutions. You can make it very complex. And in fact, it will solve the problem, but it will really cripple your app in the long run. So because it will be closely coupled to your DApp code. You will be tied to a specific Web3 SDK solution, and it adds lots of complexity to manage. So basically, you will spend a lot of time managing this solution rather than developing your app. Or you can use a decentralized permissionless open platform. Well, it's also a good solution. It gives you lots of control. It is decoupled from your DApp. So basically, you point your DApp to the simple RPC endpoint that you can run in a much more simple way than the blockchain node. And basically, you're safe. So what is Fluence and where it is in this schema? So Fluence is a centralized serverless compute platform. It is verifiable and trustless. It is unstoppable and censorship resistant, and it's fault tolerant. So basically, it's also a compute marketplace that replicates the cloud stack, and it allows you to build decentralized apps in an easy and convenient fashion. So you can think Fluence as a Filecoin in compute. And as it was correctly noted by previous presenters, the Web3 is not only about blockchain. Most of the compute is like general purpose compute. It's off-chain. It's non-deterministic, and it is the way the compute should be, like in most of the time. So why Fluence? We think of compute infrastructure as a public good, like internet or crypto, and we are trying to build lower cost, censorship resistant, and no vendor lock-in solution, basically where a marketplace where you can find different compute providers who have different offerings and have no cost of switching between them. We're also trying to build a solution that has zero trust security, that is open source, and that is permissionless. So no KYC and no identity is required to participate in it, both from the developer side and compute provider side. And we think that decentralized serverless compute is the next generation of internet computing. So originally, everyone is tied up to those big Web2 platforms, and we think that it is okay for some period of time, for some moment, but ultimately we think that businesses will tend to switch to decentralized serverless compute platforms because, well, they allow more flexibility. And creating a centralized compute platform is actually very hard. So we need to maintain the generalized compute compatibility. So it's not only like blockchain, not only deterministic compute, but general purpose compute. We need it to be verifiable, so that there is a way to verify that the actual computation has taken place. And we need it to be able to scale, so that your code that was deployed into the network can withstand a certain amount of load. And we actually had some really clever solutions on that. And we think that the competition for us is like something like AWS, but not blockchains and smart contracts. So we play on the general purpose compute field. So Fluence is a decentralized service compute platform. It's both a developer platform that allows you to deploy serverless functions and workflows on the network, and a compute marketplace where the compute providers can deploy their resources and make money with us, with Fluence. If we take a look at the traditional cloud stack, to the traditional solutions that are used by multiple projects, we can, for instance, take a look at AWS solutions like AWS Lambda. So in our world, AWS Lambda is marine. It's our WASM runtime that allows to execute WebAssembly files on our network. We have Aqua language that is an analogy to AWS step functions or Google workflows. And we have our CLI and web tooling that is similar to serverless.com or Cloudflare Wrangler. So right now we have a live testnet. We have deployed our decentralized execution protocol, Aqua. And by Q4 this year, we are launching our mainnet, verifiable computation, and we are onboarding compute providers with us. We're also launching DAO, so this whole protocol thing is managed by the community. But what actually is about de-risking the RPCs? So since like Fluence is the platform, we created a solution to demonstrate the possibilities of the platform. This is called FRPC. So what is FRPC? FRPC is a super convenient showcase of what's possible in Fluence, and it will allow you to try the network, try the developer tooling, and actually solve this RPC centralization problem. So you simply deploy a self-hosted RPC resolver that connects to the network, connect this to your DApp simply by pointing your DApp to this single RPC endpoint, configure a set of RPC providers. For instance, you can put several Infura nodes, our endpoints, several quick node nodes, some of your own nodes, and run different quorum, load balancing, or any other, or random selection algorithms so that all the calls from your DApp are proxied into the Fluence network and then to those RPC providers. And all this with really good latency and good throughput. And all this is available right now on Fluence testnet. So you can scan these QR codes. It will lead you to GitHub. There is a repository called FRPC Substrate, and you can use this repository as a starting point just to try Fluence, to try this FRPC, and basically solve this RPC centralization problem for your DApp. Right now, you can do it completely free, so it's on testnet. In Q4 this year, we are launching mainnet, so you can put it into production too. Okay, so how does it actually work? So there is your DApp front end that you point to a very simple self-hosted gateway. It's a very simple tool. It does not require you to do any complex stuff like running the full blockchain node. It's a very simple tool that connects to the Fluence network and uses the peers in the Fluence network to run to run quorum or round-robin algorithms over several centralized RPC endpoints. And in a nutshell, it just solves this RPC centralization problem for any DApp developer. Yeah, there is also a QR code if you missed it on previous slide. So, a short recap. So you can create and operate a centralized RPC solution as a decoupled middleware for your DApp. It's very simple, it's free for now, and you can try it. You can also utilize Fluence centralized serverless network and open source tooling to manage this single point of failure or these centralization risks. And you can actually use this example to see how Fluence Networks works, and you can also implement the backend for a DApp on Fluence. So if you have some existing code which is running on AWS or on some popular cloud solutions, you can try mitigating that centralization risks and also move some part of your backend code to our network. Yep, this is probably it. What else? So if you want to learn more about Fluence, you can go to fluence.dev. There are several manuals and books and intros that will get you up to speed with our platform. You can use Aqua language to audit, share, and reuse distributed algorithms. think of it as Amazon step functions where you can call different services and orchestrate them so they work together. And yep, so this is basically it. This is the demo that you can try to run maybe later this day. It's very simple. So you can use this command to just install our latest tooling and use the FRPC substrate repository that I covered earlier to try it and hack along. So thank you. We have like our website, Discord, Telegram, and the career website. So if you're interested in joining our team, please take a look. Thank you.
Thank you very much, Fedor. Quality stuff. Now, if anyone's got questions, feel free to raise your hands. Anyone? Well, I guess that wraps it up then. Thank you very much again, Fedor.
Thank you.
And we still have some time for the next speaker, so we'll be back in 10 minutes. Okay, and now we're back. Thank you everyone for waiting. And up next, we have the wonderful Tony Warstetter, and he'll be talking about ERC 5564 and how we get stealth addresses adopted. So everyone give a big round of applause for Tony.
Perfect. Perfect. Let's get started. Yeah, welcome everyone to my today's talk about privacy. My name is Tony Warstetter. I'm with the Ethereum Foundation, also with the Vienna University of Economics and Business, mostly focusing on privacy topics related to Bitcoin and Ethereum. And today I want to talk a little bit about stealth addresses, which is new. I mean, it's not very new, but it's a new proposal, an ERC, that we want to bring to Ethereum. Here on the slides, you can see the ERC document. So it's co-authored by Matt Solomon and Ben DiFrancesco. They are both with Umbra Cash and also with Vitalik. And today's talk will essentially cover everything we want to do with ERC 5564, which is called stealth addresses. Before we start into it, let me quickly define the problem that we try to solve by using stealth addresses. So on the slides, what you can see is we have two entities. It's Alice and Bob. And what they want to do is, more or less, Alice has some money that she wants to transfer to Bob. So far, so simple. So the problem there is, there are a lot of people watching them, because Alice and Bob are using a public ledger, like Ethereum, so everyone can more or less see the interaction between them. So if Alice.eth sends to Bob.eth, everyone can see that there is a public transaction ongoing. So Alice cares a lot about privacy. So she doesn't want to disclose the connection to Bob. So what Alice could do is more or less just reach out to Bob and ask Bob, hey Bob, could you please generate a fresh address for our interaction? Bob could be like, yeah, sure, let's do so. And then what they achieve is Alice just sends the funds to the new address, which is address C in this picture. And this allows Alice to not create a link to Bob. So Alice just sends the funds to address C, and in the end, Bob got his money, but not directly to his Bob.eth account, but to address C. And now, at this point, if they continue doing so, at some point, Bob would probably be like, okay, that was quite cool, but wouldn't it be easier or even smoother if we can do so without requiring any private interaction? Because in the previous example, Alice had to reach out to Bob, Bob had to agree, send the new address over, and then Alice could use the new address. But now we want to do the same without any prior interaction. And this is exactly what stealth addresses allow both parties to do. So Alice can use stealth addresses to generate a new address for Bob that only Bob can access. That's the important thing. So Alice generates a new address in the name of Bob and sends the funds to that new address. And then Bob can use his private key, his normal private key that also controls, for example, Bob.eth, to derive a new private key, which can then unlock the assets sent to the stealth address. For everyone else, it would then look like Alice just sent the funds to some random new address that has never been interacting with the chain before. And what they get is unlinkability. So they don't get untraceability, but what they get is unlinkability. And unlinkability means for two outgoing transactions, we cannot tell that they went to the same recipient. So for two outgoing transactions, we cannot tell that they went to the same recipient. That's more or less the common definition of unlinkability, while untraceability is a much stronger privacy property, which says for incoming transactions, we cannot tell who the sender was from the set of potential senders. So for incoming transactions, we cannot tell who the sender was from the set of potential senders. So far, so good. So what we get is unlinkability, but no untraceability. What you can see here on this chart is
on this table is different privacy technologies compared by their properties. As you can see, stealth addresses comes with more or less very weak properties. So with stealth addresses, we get unlinkability. For other protocols like coin-chain wallets that we know from Bitcoin, Tornado Cash, but also Privacy Pool, which was published very recently in Vitalik's paper, Zcash, Monero, they all come with untraceability. And untraceability always requires some mixing. And that's the difference to stealth addresses. Stealth addresses will never require some mixing, so you will never be commingled with funds from North Korea, for example. On this slide, you can more or less ignore the last column, which is undetectability, because for most of the times we have detectability. For example, Tornado Cash deposits or withdrawals are easily detectable because there's a call to the Tornado Cash contract. They read the Tornado Cash contract slots, and also there are events, of course. Same applies for stealth addresses, so we cannot hide the stealth address transactions among all transactions, but we get this property unlinkability, which is for many, many use cases enough privacy for users to be used already. And as you can see, the complexity also is very low, so stealth addresses don't require any CK tech or other very sophisticated technology like zero knowledge cryptography and stuff. Stealth addresses only rely on public an elliptic curve math. So it's really quite simple to implement. So how does it work? Let me quickly walk you through a very easy example. We won't require elliptic curve math here. It's actually quite basic. So what you can see here is Alice and Bob both have a key pair, which is a private key and a public key. So for Bob, it's lowercase b and uppercase b, and for Alice, it's actually not her real private key. It's just some randomly generated private key. So the sender of stealth address transactions just creates a random key pair. This is important. So Alice is not using her real key pair. She can just generate a random Ethereum private key and gets the public key to that. So how does it work? Alice, in the first step, takes the public key of Bob and then generates a shared secret together with Bob. So Alice multiplies the private key with the public key of Bob, and this allows her to create a shared secret between both, which she can then use to generate the stealth address from. Right, so Alice uses her randomly generated private key together with the public key of Bob and generates a stealth address from it. Then Alice can send to that stealth address while publishing A. So A was the public key derived from the randomly generated private key. So Alice publishes A, uppercase A in this case, while sending the funds to Bob. So at this point, Bob received some funds to his stealth address, but Bob doesn't even know that there is a stealth address that belongs to him, right? So what Bob must do is Bob now engages in some parsing. Bob parses the whole chain and checks all stealth address transactions. And then, by using his own private key, Bob can find out if there was a self-address transaction that belongs to Bob. And if so, Bob can use his private key to derive the new stealth address private key to then unlock the funds. So Alice uses her private key together with Bob's public key to generate this shared secret, which is then used to generate the stealth address. And on the other side, Bob can more or less do the same. He uses his private key together with uppercase A, which is Alice's randomly generated public key, to find his stealth address, but also to unlock his stealth address. So far, so good. What do we want to use stealth addresses for? Of course, as said, you don't get these very strong privacy properties that you would get if you use Tornado Cash or privacy pools, coin-chain wallets, and so on, because they always require some mixing. Stealth addresses can be used to protect both the sender and the recipient. For example, if you want to donate to, I don't know, to WikiLeaks, you can use stealth addresses, because then on-chain, no one can see that you just donated to WikiLeaks. Because for everyone else, it would look like you just donated funds to some random address, or you sent funds to some random address, which could also be you yourself. So it could also be the case that you just send funds to yourself. Of course, there are many daily applications like payroll checks that require some privacy. You might not want your colleagues to know how much you earn or other people to know how much you earn. Therefore, they can be used too. Private messaging. So we're already talking with Farcaster, for example, how staff addresses can be used to do messaging. Kind of I send a message to you, but not directly to your address, but to the staff address. The same applies to multisig's. Let's say you have a multisig. So I have a multisig, and 3 friends of mine are also part of that multisig, but I don't want my friends to know who the other signers are. Just for my own security, I don't want the other signers to have some incentives to corrupt, to find out who the other signers are, and then steal my money. So what I can do is I can give them signing rights to a stealth address of them that I generate, without them being able to know who the other signers of that wallet are. And the same applies to private POAPs and stuff. And as it says on the slide, but essentially every interaction that should remain private. So what we do is we have private interactions between 2 parties without any mixing involved. So let's talk about some challenges. So staff addresses come with a lot of challenges. And here on the slides, you see the major challenges that we currently face. Some of them have some very good paths how we can solve them, some not. So let's go through them. So stealth address users cannot pay for gas. That is a very common critique, which is very valid, because if I send DAI, for example, to a stealth address, then the user has no ETH on that address. So the problem is the user cannot do anything with that DAI. And the user would need some way to fund that address to do something, right? So the user needs some ETH on that address to do something to pay for the gas. Of course, there are some solutions. Account abstraction is a great solution, because account abstraction allows you to pay more or less through side channels and stuff, but also ticketing systems. So we have recently been hacking on a project which was called gas ticketing, which more or less allows you to set up a private side channel with builders, with searchers, to pay them through a side channel, and they will then include your transactions. So just Google for gas ticketing or something, then you can find this blog post. This is one solution, how you can already solve that problem with user not being able to pay for the gas. The next challenge that we identified is users having to manage many private keys. And this is, of course, a big problem, right? Because managing multiple keys, it's hard enough to manage 1 key or 2 keys, not even speaking of managing hundreds of different keys that you might need because you need a private key for every single staff address. But there's also a cool solution, Vitalik came up with it very recently, which is separating the logic from the assets. So what you can see here is a very naive implementation, which would never work because it's not secure. But in a very naive implementation, you would have a logic holding account and an asset holding account. And what you could do is, so the asset holding account would point to the logic holding account. And then you can provide your private key to the asset holding account. The asset holding account would forward your private key to the logic holding account. The logic holding account would verify that your private key, if multiplied by the elliptic curve generator point, matches to the public key stored in the logic holding account, and then he returns true. And if the asset holding account receives a true from the logic holding account, the asset holding account allows you to spend. But as said, this would never work. Of course, inputting a private key into a contract is also something that will never work. This is just to show you how we can easily split logic from assets. The much more sophisticated solution uses CK snarks. So what you can do with CK snarks is more or less you generate a proof over the whole Ethereum state. So you have a proof, and you prove that in the state of Ethereum, there is a certain contract, and in that contract, there is a public key that I know the private key of. And the whole system then looks like the following. The user generates a proof against the whole state. The state, in this case, just displayed as a Merkle tree. then the user can provide that proof to the asset holding account, and if the proof is successful, the user proves that he knows the logic from the associated logic account without connecting both. That's important. So we don't want to create a link between the asset holding accounts and the logic holding account, because as soon as we create a link between both, you can cluster a user. You can cluster a user by all his addresses. So in this case, we don't have any link in between those wallets. Right, then the next challenge is recipients can destroy the sender's privacy, which is a very valid point. If I send to your stealth addresses twice, and you to different stealth addresses of one entity, and this entity then commingles the funds at some point, then you would know that it was me, right? So if, for example, if 10 people donate to WikiLeaks and WikiLeaks then cashes out using Binance, then Binance knows all the donators, which is of course a big problem, especially when you use a centralized exchange. But as we have seen in CoinJoin wallets, for example, that they suffer the same problem. A great UX that more or less doesn't allow you to ever commingle funds can solve this problem. Of course, if a user wants to do raw transactions, he can still commingle the funds, but using a great UX, a UI, we can do a lot. And then, of course, fragmentation, because of many different stealth address protocols. Stealth addresses can be generated through more or less every elliptic curve. So you can use SEC256K1 curve, SEC256R1 curve, and there are even more different possibilities how to create stealth addresses. And the last problem is exactly what the ERC 5564 tries to solve. Essentially, we try to create a standard for stealth addresses. So let's look at it. As said, stealth addresses are not equal to stealth addresses because there are many different protocols that you can use to generate stealth addresses. For example, as said, SEC256K1 and so on, but there are also elliptic curve pairing-based stealth addresses, lattice-based stealth address protocols that are already quantum-proof resistant and stuff. And the problem here is the recipient, if he receives a stealth address transaction, the recipient must do some parsing, right? And for that, the recipient must know which stealth address protocol was used. So I cannot just use some random elliptic curve without telling the recipient, because otherwise the recipient would have to try out every possible protocol. Just to give you a rough sense of how many stealth address protocols there were, so this is just a shortened list with all the stealth address protocols academia came up with very recently. So you can see stealth address protocols being based on standard elliptic curve, as we know and love them. But there are also stealth address protocols being based on lattice-based cryptography or even elliptic curve pairings. So what ERC 5564 now tries to do is create this common basement for stealth addresses where you, as the sender, you can indicate to the recipient which stealth address protocol you used. For example, if you use stealth address protocol X, then the recipient knows, it was stealth address protocol X, and I will do the parsing that stealth address protocol X requires. So going deeper into the ERC, it's actually very simple. So everyone who knows Solidity can already see that's the whole contract, by the way. So the contract is very, very simple. The contract allows you to do one thing. You can execute one function, which is called announce, and this function will emit an event. And this event is exactly the information we talked previously about, this uppercase A, that the recipient needs to find his stealth address. So we have a contract that does nothing else than emitting an event containing the information required by the recipient to find the stealth address. There are also some other arguments that the contract emits in the event, but they are not that important at this point. Right. Then ERC 5564 also comes with its own address format, because previously I said you can use the public key from a user to generate stealth addresses from. The problem is the parsing cannot be outsourced, so the user has to do the parsing himself, and in order to allow the recipient to outsource that parsing process, for example, to let some centralized party do the parsing, we require two public keys, more or less, on the recipient side. So the recipient can just generate a stealth meta address, which is more or less nothing else than 2 public keys concatenated. So we have 2 public keys, they are both compressed, we just concatenate them, prefix them with ST, ETH, and so on, and then the user can simply publish his stealth meta address, and everyone can then use this stealth meta address to generate as many stealth addresses from it as desired. And users, so the stealth meta address itself is not something secret or something that the user must keep private. So the user can even publish it in his Twitter bio or put it into another contract which is done by EIP 6538, which proposes to have a central place on-chain for the stealth address management. Right, so that's essentially all. On the slides you can still find some further links. For example, there's a proof of concept just to show you how it works. Then there's a tutorial. If you want to use stealth addresses already today, then check out umbra.cash. So the Umbra guys, they are already working on that for 2 years, and they are live on mainnet and some layer 2, so you can use stealth addresses already today. Compared to the ERC, it's a little bit less efficient, but they are already live, so stealth addresses can be tried out already today on the mainnet. And there is also a paper, so we recently wrote a paper about stealth addresses. It's called Base SAP, so kind of the base layer for stealth address protocols. And you can also find that paper, which also covers everything I said in much more detail. Yeah, that's essentially all. Thank you very much.
Thank you, Tony. Great stuff, great stuff. Right, we have some time for questions, so if anyone has any questions, please raise your hands. Yes, you, sir.
Hi, thank you for the talk. Amazing, amazing topic. I have a few questions, but I guess the main one is that this scheme where Alice announces on-chain that she's sending to a stealth address, doesn't this erode some of the privacy? Because if I want to hide the fact that I donate to WikiLeaks, as far as I understand from the scheme, I reveal the fact still that I donate to some stealth address because I'm using this protocol. And like, is this the case? And how can it be overcome?
Right. Yeah, it's actually the case if you do everything in one transaction. So if I send you some funds, and in the same transaction I emit that event, then everyone can see, I just did a stealth address transaction. The thing is, you could also do it separately if you care about that. So you could send the funds to the stealth address and in another transaction, or even from another account, emit the event. So you can then use the contract to just say him, okay, I just want to emit some information while doing nothing else in that transaction.
Yes.
Thanks for the presentation. So I have a question, I guess, in a similar direction. So you explained that you cannot use actually the private and public key for Alice account, and that you actually have to generate an ephemeral pair every time. So the first question is, why is that the case? It's not clear to me. And in case you could, let's say, just use public information, then you could avoid this problem of announcing, I guess, right? Because Alice public is already announced in a sense. And then the question is, could you use maybe, if you can't just use the public key, some other public information as, I don't know, public key and nonce together so that it would generate every time something different?
Right. Yeah, that's a very good question. The thing is, why we use a random keeper instead of Alice keeper is more or less, so let's say I send to your stealth addresses 10 times, right? So I would more or less generate a new private keeper for every single transaction, and then I would have 10 different stealth addresses. So kind of every transaction that we have would be completely unlinkable. Of course, if I want to, I can also send to your stealth address twice, but that unveils a little more information.
And then you could use something mutable but still deterministic as the nonce or some other parameters from the blockchain.
That's a good idea, yeah. I think even some of the papers I just had on the slides did exactly that. So for example, our first interaction requires, let's say I generate a stealth address for you, and then I send to that stealth address, and then we can say, okay, as soon as we have the first interaction between us, we just increase a nonce. That would work, yeah.
Okay, thank you, Tony. Sorry, I'm afraid we're running short on time. So yeah, give a big round of applause to Tony again. And now here's up for our final speaker. We saved the best till last. We have Federico Kunze Kulmo from Evmos, and he'll be talking about dynamic IBC, the new wave of DApp composability. So everyone give a big round of applause for Federico.
Perfect. Hi, good morning. Good afternoon, sorry. I'm Federico. I'm the founder of Evmos, and today I'm going to be talking about dynamic IBC and how it's going to unlock the new wave of DApp composability. So first, a little bit about me. I've been a Cosmos core contributor since 2017. I started working as a full-stack engineer and then made my way into working on core protocol, worked on the IBC interoperability protocol that makes today Cosmos famous. And then I transitioned into building an EVM on top of Cosmos with full interoperability, which is what Evmos offers today. So the main question that we want to answer today is like, why is interoperability relevant and how does it affect developers and also users in terms of user experience? So the main thing that interoperability provides is it allows you to use DeFi Legos. So right now, when we think about Ethereum and different virtual machines, you have different smart contracts or decentralized applications that you can use to leverage one another and build on top of that. So that's what we mean by composability. So you can build a lending protocol by using an oracle and so on. But what happens when you don't have those DeFi Legos is when it becomes problematic today that you need to reach through interoperability to another protocol or to another EVM chain in order to start using those DeFi primitives, those DeFi Legos before you get to start building something. And ultimately, this is a big problem because it's not only a technical problem, but it's also a business development problem because today we have many applications that are deploying on different EVM chains, and that also adds cost to the foundations or to the core development teams that need these basic primitives in order to start building. This happens when you don't have interoperability in place, and that's why interoperability is very important to be able to compose between smart contracts. Then the second major point of why interoperability is important is because it provides access to liquidity. So today, there are more than 160 EVM-based chains deployed in production, and they have the vast majority of the TVL, the liquidity available in the blockchain ecosystem overall. So what happens today when you have USDC that is deployed in multiple chains? Sometimes you have to reach that liquidity, so that's why today we think that the concept of TVL, the total value lock for a single chain, is not accurate anymore, that we need to expand this terminology to be able to account for all the liquidity that is fragmented and available in other chains and other ecosystems. So interoperability is important to be able to reach that liquidity in the first place. And finally, for composability that I mentioned a little bit before, but also for user experience. So today you have multiple accounts in different networks, different types of EVM chains, other types of VMs, layer 1s, layer 2s, even layer 3s. So interoperability can also provide as a mean to managing different accounts on other networks by composing with one another and being able to, at the end state, send instructions to accounts that you manage from a single main account, so to speak. So that's why interoperability, if we're thinking about the end state of user experience, interoperability is really important to get us there. And so we talk a little bit about the importance of interoperability and how it also relates to user experience, right? So I want to talk about also how interchain user experience today really sucks for end users, and how it's really hard for mainstream users to get onboarded to crypto, especially when they have to onboard to different ecosystems that don't have the interoperability in place, or they have to manage multiple accounts. So I'm going to provide a few examples of why this is the case. So the main thing that you've probably seen when interacting natively with different decentralized applications is this, having to change from one network to another, even though you have the same EVM compatible chain and the same address derivation, in this case, the Ethereum types account, or in the case of Cosmos as well on the right side, that you have multiple chains. And this is kind of like, for crypto natives, we're used to that. But for someone that is coming from the Web2 experience or from a banking experience, maybe even from a neobank, this is completely, like, it blows their mind and they don't know how to get to there. Like, I, as a user, should only know that I have tokens that are located somewhere, and the wallet should be smart enough to be able to understand where to transfer them to. So abstracting that functionality is really relevant when it comes to user experience. And yeah, this is the phase that they come when they come to this environment. They download MetaMask, and it's a pain in the ass for them. So the other thing that I just briefly touched is the token fragmentation. We have different interoperability solutions with different layers of securities, different levels of decentralization, different levels of governance. Some of them are multi-sigs, validator secured, consensus secured, plain multi-sigs, and also like client base, like protocols, like IBC in the Cosmos ecosystem. So that naturally leads into token fragmentation. So in terms of, if we're talking about interoperability US, this is one of the main pain points for the end user. And as I said before, the user should only care about having USDC or having USDT and not having the single, like every specific denomination in their wallet. And then we get into different formats, right? Like, we talk about native tokens, we talk about ERC20 tokens, and then there's different standards in like Tron, etc. They're different. So how do we make the tokens compliant with each other, and how do we create interoperability so that it supports, like, ideally one standard or one specific format for the tokens? And then, don't get me started with NFT, and that's also like a different point. I'm not sure, for example, in Cosmos that we've come with a specific standard for that yet. So then the other main problem is, like, when it comes to, and there was a talk right before this downstairs about the standard for custom messaging interfaces between EVMs. So trying to standardize the different bridge implementations into something that is more, that can be abstracted, and so that we can provide better user experience overall and better developer experience, so that we can share this implementation overhead. But the reality is that it's not, there's not a standard implemented. If we look at the reality, there's like the race, as I call this race of application specific interoperability that was supposed to, I guess, try to solve this issue by having CCTP, CCIP, wormhole, Axelar GMP, so different implementations of bridging technologies. And so for some time, there was hope that applications will come to terms in sort of like leveraging each other's technology and leveraging each other's open source code to create a real standard for interoperability, or for bridging at least, in the EVM world. But if we start looking at the different implementations, we can see that, for example, wormhole defines a target chain, a target address, payload, which is the data that we're calling on the counterparty chain, receiver value, gas limits, and it returns a sequence. Same with CCIP from Chainlink, receiver data, fee token, extra arguments, and also with Circles implementation. It's more or less the same, but you can already see the similarities between these different implementations for sending a cross-chain message. But the problem is, like, first, they cannot even agree on the single type for addresses or payload, or even the arguments like order that will create a different function signature on Solidity or in the AVI. So this creates a lot of complexities even for full standard to be implemented, because like even the ordering is different, it's going to create a different AVI signature. So like there's nothing else to say that, well, how can we create a better interoperability protocol, or how can we create a better structure that is able to provide with better security, with better governance, with more outreach interoperability, etc., that can abstract the different application-specific interoperability into something that is more robust and more secure. And just to highlight again, this is not a technical problem. This is a business development problem more than anything else. Because the standardization is something that we need to agree off-chain, and it's not something that can be implemented in one way or another. It's a business development problem. But Cosmos is here to help us, right? There's like this amazing standard called Inter-Blockchain Communication Protocol, or IBC, that is able to, via light clients, generate miracle proofs of inclusion of the transaction, receiving acknowledgements, etc. So what about IBC? So IBC, for the ones that are not familiar with it, basically works under two different layers, which is IBC transport, which here it's represented as TAO, or transport authentication and ordering layer, so that you can provide the clients, the connections, and the channels, and then you can order the channels accordingly. And then you have the application layer, basically what you built on top. So the end user applications, or the application-specific logic that is interoperable via this protocol, that relies on this transport, authentication, and ordering. So in reality, it looks like this, but this is really complex already for an Ethereum developer for an application, because you need to define IBC clients, basically maintaining the light client state and the consensus state for the counterparty chain. Then you have the connections and the connection between the two chains, and the channels that define the connection between the specific parts of the state. So it's smart contract with smart contracts, not only chain with chain, which is what connections abstract, what connections define. So at this point, I lost most of the Ethereum developers when I try to say this, because all they want is something that they can define and is fully abstracted for them, so that they can define send packet or send an arbitrary message to a destination chain with a recipient address and some payload data. So this is a visualization of how IBC works. Basically, you have like a module, or in this case, in Cosmos, a part of the state that it talks to another part of the state, and for this you need encoding. Basically, the message that you're sending cross-chain needs to be encoded and decoded to be able to understand the logic behind it and be able to define the conditions for it. So, for example, if I'm sending a transfer between chain A to chain B, I'm sending a payload defining the sender, the recipient, a token with a specific amount, and some fee, if necessary, to the one relayer, which is this actor that is maintaining the light clients updated. But what about developer experience? I mean, we've talked a little bit about how IBC is one of the most robust interoperability protocols in the ecosystem today, but it hasn't been able to reach to the developer, like application developers. It's only able, right now it's mostly applicable to chains interacting with other chains, like layer ones with layer ones, and not layer ones with smart contracts, or vice versa, or smart contracts with smart contracts, like to have full interoperability across the multiple layers of the state. So I want to leave this feedback here that Adi, who is one of the main researchers from Informal Systems, one of the main contributors to IVC, left in this forum, that these IVC abstractions are really relevant. So maintaining the likelines, because they're relevant for the security guarantees of the IVC protocol, but they demand too much effort for developers to understand, to start building, and they're right now they're necessary before you can start shipping something. So it's not like on smart contracts or in DVM that you can build a smart contract, deploy it, and the chain while the chain keeps running. Here, in order to build an IVC connect or an interoperable application, you need to build an entire module, perform an upgrade, and then launch your logic. What about having these interoperable smart contracts be able to be shipped faster and accelerate the piece of innovation when it comes to interoperability? So for this we are introducing dynamic IVC, which is this concept of having dynamic packets so that smart contracts can be able to send cross-chain messages with the same security guarantees as the most popular interoperability protocol in the ecosystem today. So basically what dynamic IVC includes is sending the packet and receiving the packet logic. I'm going to go into that in a second. So why is dynamic IVC important to the ecosystem? So it provides complexity abstraction for the end developer so that you can just define the same packet data as what you can find on traditional bridging structures. It can accelerate the innovation of interoperability and composability. It can provide better user experience by accessing DeFi Legos, building composable dApps, and abstracting all these end user complexity in order to build better user experience and better products. It provides the security guarantees of like client proofs, and you can also, applications can be built that are fully interoperable, which was something that was not possible until today. So in terms of dynamic IVC, there's the main parts of dynamic IVC is be able to send a packet with some data payload that the application itself, the smart contract, defines, and then callbacks. So being able to receive the data, to receive a packet coming from another chain, and being able to decode it into something that the application can interact with. So for this, one of the main critiques to the IVC protocol and interoperability protocols in general, to be able to have native interoperability between different EVMs, or different VMs, sorry. Some of them support interoperability encoding via JSON, and some of them support AVI encoding, RLP encoding, JSON, gRPC, etc. So the encoding format is relevant for the applications to be able to abstract this functionality and create and understand the logic that is being sent or received. So we're introducing, as part of dynamic IVC, JSON EVM extensions to be able to connect, for example, EVM smart contracts with Cosmos Wasm smart contracts, which is one of the other main VMs available in the Cosmos ecosystem, and also AVI to AVI encoding to be able to have true interoperability between smart contracts on the EVM layer. So going back to the issue around different interoperability implementations, different bridge solutions, is that all of these can be abstracted with dynamic IVC. So you can build the same packet data, so target chain, target address, payload, receiver value, even tokens and fees, abstracted into the packet data. So everything that we have here can be built on top of the basic interoperability layer, which would be dynamic IVC. So this will make it easier for developers to onboard, easier for application-specific interoperability, bridging solutions, etc. that are already built, that are used by major institutions like Chainlink or Circle, and can be abstracted in a way that applications can define their own interoperability logic. So I talk a little bit about the sending logic. What about the receiving logic? So the callbacks functionality is related to the actor functionality in that basically you allow the contract to receive the encoding data and abstract the functionality, run the execution for the packet data that is received, and then return a value. So this basically what it enables in concrete terms is that you can compose with other chains and being able to handle the acknowledgement so that success or receive acknowledgements from or even timeouts are properly handled on the application layer. So no matter if the cross-chain interaction is successful or fails, you can even handle those cases. So, and this also is built on top of our EVM extensions, which are stateful precompiled contracts that are able to define this functionality and have smart contracts interact with native code in Go, and that we are already using on mainnet to interact with the staking logic, and we're also building other cool functionality to interact with cross-chain applications or cross-chain application-specific blockchains. So at Evmos, we're building the interoperability layer, these interoperability solutions as a way to provide a better user experience and composability, being able to provide better onboarding and being able to provide more usability for applications than what other EVM-compatible chains provide. So, and a main point for this is also being able to have omni liquidity. So applications being able to talk to one another and reach liquidity that is not available on the native chain, but they can interact with a DEX that is, for example, deployed on Osmosis or another EVM-based chain, and swap and then get the tokens back. So this is crucial for user experience so that the user doesn't need to change their wallet or doesn't need to transfer the tokens to the chain that hosts the DEX, perform the swap, and then transfer the tokens back to the originating chain. These can all be abstracted for the user and built using a single transaction with the same user experience that they're used to in EVM-compatible networks. So Evmos is trying to deploy all this functionality in order to become the Ethereum canary chain, offering all these amazing user experience and interoperability solutions so that developers can try out without any risk all these new features that we're deploying for them. So account abstraction, passkeys, interoperability solutions, and dynamic IVC, of course. Thank you very much, and I think we have 1 minute or so for questions.
Okay, thank you very much, Federico. Yeah, we have roughly about 3 minutes for questions, so if anyone has... Yes, you, sir.
Thanks for a great talk. I think important topic of interoperability. I had a bit more precise question about your IBC. So I imagine you are somehow trying to connect the, let's say, Cosmos mainnet main chain with the Ethereum main chain.
Mm-hmm.
And for the IBC protocol to work, you need to align somehow the validator set, the authorities who are finalizing the blocks, let's say. So how do you do this in practice if Ethereum has so many validators and so on? So
there are different teams that are building light clients for Ethereum that can basically provide the same Merkle proofs as that IVC requires. But for that you need, as you said, economic finality in order to do that, to be able to verify the light client proofs, etc. So there are different. The team that is working on this is called Polymer, and basically you define different security guarantees for your light client configuration, whether or not you want checkpointing or economic finality. So how many validators have committed to the recent round, etc. So that you can basically parameterize the light clients in order to, according to your risk profile.
Thank you. Any other questions? Oh, yes. Go ahead.
So on the same subject then, how expensive it is to validate a light client proof on Ethereum from Cosmos?
I don't have the data of how, because it hasn't been implemented yet on mainnet. There's only been a few testnet integrations, but our goal right now is to try out this technology in the Cosmos ecosystem. There are many EVM-compatible layers, EVM-compatible networks that we're going to be trying to partner with, specifically because we built the EVM for Cosmos. And trying to build out this technology, there's also Agoric, which is building a JavaScript-based VM, Cosmos Wasm that we mentioned before. There's an Avalanche-based implementation that we can also talk to, and being able to compose across the different chains. And then once we have interoperability solutions with Ethereum mainnet or even layer 2s, because there's being a new request for proposals from the Optimism team to being able to implement IVC for the OP stack. So that will also bring interoperability to layer 2s directly with IVC.
Okay, I think that's all for time. So once again, give a round of applause for Federico. Yeah.
Thank you very much.
Yeah, and thank you all for coming. That's it for today. So hope you all have a lovely day, and we'll hope to see you again tomorrow. Thank you.